morning, everyone. Welcome to day 5 of the Traders Conference. This has been an amazing week of learning and of education. Hope you have been able to be here throughout the week to learn from our great presenters. We have got another great lineup coming up today. I will go through that in just a few minutes. But first, we are MetaStock. We are hosts of today's Traders Conference. So welcome. My name is Kelly Clement. I'll be your YouTube host. I'll be the one in here in the background making sure everything's running and you're seeing what you're supposed to be seeing and hearing what you're supposed to be hearing. So if you do have questions throughout the day, make sure to put them into chat. We love questions and interaction so we can get those questions over to presenters. But first of all, I'm just going to quickly introduce you to MetaStock. I'm going to show you a quick video and then I'll be back with you to go through today's events. So stay tuned.
Indicators and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in marketing.
Hi there, Greg Lewis, MetaStock Software. As the marketing director, I get asked all the time, what is MetaStock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you.
MetaStock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of MetaStock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love MetaStock's OptionScope. OptionScope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And MetaStock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar Oscillator System, or simply known as the RMO. And as you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about MetaStock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
Okay, there was a quick video introducing you to MetaStock, who we are, what we do. But today is all about the trading conference and talking about trading stocks and options in 2023, excuse me. We are going to be talking about futures, options, Bitcoin, crypto, whatever you want to talk about today. So as we go through the presentation, make sure you're asking questions, make sure you're engaged. You are here to learn, and we want you to be able to interact with the presenter. So go ahead and ask questions, everything throughout the day. We are going to just show you quickly what is coming up today. The easiest way to do that is I did put a link in the chat. If you go to metastock.com/traders-conference, you will see today's schedule. You can see that here by going up to metastock.com. Click on this live now, day 5, register to watch live. Just click on that link. Takes it just a second. And here is today's schedule. We'll be starting here in just a few minutes with Kevin Nelson. He's going to be talking about trading with the Supertrend indicator. And then we'll have Adrian Manz talking about trading by the numbers, the strategy and discipline of the master trader. And then we're going to have Jerry Allison. This is also always a fan favorite in the conferences. He'll be talking about trader tax status versus investor, what it means to you. Then we'll have Dan Passarelli and Marco Gomez, and then Ken Calhoun. Down here at the bottom is where you can register to win any of the prizes. Go ahead and put your information in there, click submit, and then you'll be registered to win prizes throughout the day. So that is how you register. I'm just going to go do my final quick checks, make sure everything is ready to go. But as you come into the room today, say hello, tell us who you are, where you're coming in from. We're here in beautiful Salt Lake City, where we're buried under about 12 to 15 inches of snow. So hopefully it's warmer wherever you are, but I'll be right back with you, make sure everything's up and running. Okay, done our final checks. We are all set, ready to go for the day. So enjoy today's Traders Conference. Steve, thanks for saying hello. Welcome from New York City. Glad to have you here. Let's go ahead and get the conference started.
All right, good morning, everybody. Jeff Gibby here. Good morning. I hope you're doing well. It's good to see you again today. Let's start here. Before I read the legal disclaimer and all that kind of stuff, I want to give YouTube a chance and GoToWebinar a chance to guess or pick a winner. All you have to do right now, we're going to start today off by giving away a free book. This is Around the Horn by Adrian Manz. It's a book that's $95 in value. And what I need you to do is pick a number. And that number can be anywhere between 1 and 12,977. If you pick a number, I'm going to pick one of the numbers that comes in through either the GoToWebinar chat or the YouTube chat. And somebody is going to win this book right now if you're feeling lucky. So let's go ahead and guess that number. And in the meantime, let me go ahead and read this legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock should have no liability for any investment decisions based on the use of the software.
any trading strategies or any information in connection with the company. Hello, Felton. Welcome back today. Hello, Ammon. Ammon guesses 147. Priscilla does 8039. Oh, lots of guesses coming in. Good morning, Santosh, Ammon, Salim, Greg, Steve from New York City, Raphael, Kumar. Good morning. Welcome. Thanks for saying hello. Like to see it. Okay. Before we kick off today, I want to say thank you to a couple of sponsors that have been sponsoring our event. Stocks and Commodities is a fantastic sponsor of MetaStock, and they've been sponsoring the Online Trading Summit since we started doing it 11 years ago. So it's a great magazine. They've done 17,000 different trade articles. They've got 1.3 million subscribers, and they've been making magazines since 1982. We really appreciate Jason and Sean and Ed and all of the guys that kind of help us. Barbara at Stocks and Commodities. It's a great team of people. One of the things that's really cool for you is if you do a subscription to MetaStock today, they're going to give you 5 months for free. And if you spend $300 or more, they're going to give you 2 years for free. This is prizes that we don't pay for them. They just give them as part of the sponsorship package. So good morning, Neil. Good morning, Denise. It's good to see you. Hello, Priscilla, John, Lou. As you're coming in, say hi. We'd love to see it. Okay. The next group is CMT Association. If Tyler came in last night and he spoke about CMT and the CMT Association, if you have interest in learning about technical analysis or risk management or portfolio behavior, their CMT programs are excellent, top-notch. In addition, they have an accreditation program. So if you're interested in trading in finance, or if you work for a bank, the letter CMT at the end of your name can be really, really helpful for that. So if you want to find out more about that, cmtassociation.org is a really, really good place to go. All right. Hello, Peter. Hello, Stoya. Hello, Steve. All right. Of course, we are MetaStock. We help you test trading ideas, scanning, forecast. 30 years in a row, we've been rated #1 by the readers of Stocks and Commodities. And I've been saying this all week. If you pay for a month, we're going to give you a second and third month for free. Our pricing starts at $69 a month. So for $23 a month, you can try the software that's been rated #1 in its price category for 30 years in a row. So if you have any questions today, if you want to chat online with us, if you want to get an order placed, whatever, if you want to even see just like a chart example, get in touch with us. You can call us at 800-882-3040, metastock.com/sales chat or metastock.com/comp-promo. All right. Now it's time to give away this book, and then we'll get on with the speaking. A sheet? Yes, I'll take care of that for you. But okay, let's do this. Okay, the number that we're going to go through, Peter T in YouTube, just guess the number 1111. That's the number we're going to go with. Let me go ahead and go to my sheet here, and we will find out who that represents. And then we'll get on with the day. 1111. Okay, and that would be Raymond A. Raymond A. With a Hotmail address. So careful not to give out last names. Kelly doesn't like me doxing people on the internet. Anyway, Ray A. We'll reach out to you to make sure we have a good address on file for you to send you this book. So congratulations for the winner. Our first guest today is Kevin Nelson. Kevin actually hired me. He hired Kelly. He was initially the person that actually was the sales manager for MetaStock when I started. In the last several years, he's been doing a company called LearnMetaStock.com. It's a really, really good site. On it, you get like 3 live webinars a week about MetaStock, and there's hundreds of recorded videos. Today, he's going to talk about the Supertrend filter. So let's go ahead and get you talking. Kevin, how are you?
Great. Thanks, Jeff. I appreciate it.
Yeah, of course. Let's go ahead and I'm going to make sure we can see things or see your screen. I just sent you the invitation over.
All right. So let me see here. We want to share that one. Tell me when you can see that.
I see what I can only assume is an expertly designed website.
Good guess.
It's all you, man.
All right. Hey, thanks again. Yeah, so Jeff mentioned, I actually worked for MetaStock there for a number of years, back in, wow, I started a long time ago. But anyway, in 2008, I left the company to start a training company. One of the things that a lot of people were just asking for was just more help with the program. And so what we did is we started a company called LearnMetaStock.com. And the only thing we really do at Learn MetaStock is just try to help you with your program in whatever way, shape, or form that we can. And we do it a number of different ways, but what I'll do here is I just want to get into the presentation now, and I'll show you, I'll give you a quick blurb about the website here at the end of our presentation. So what I'd like to talk about today is actually an indicator that was suggested to me by a customer. And this, by the way, this is the way that I get most of my ideas of what to present and so forth. They're just requests from different people saying, hey, take a look at this trading strategy and see what you think about it. So what I'll do is I'll typically, go out and research it. And if it's a published idea, then I'll try to duplicate it inside of MetaStock, and then I'll share all that information, with all of our subscribers. So this particular indicator is called the Supertrend indicator. And at the time last year when the customer asked about it, I really didn't know much about it, but I went out and did a little bit of research on it. I was kind of surprised that actually this indicator has actually been around for quite a while and is really popular. So actually going through a lot of the different training, I thought, oh, well, this will make for a great class. So the nice thing about the Supertrend indicator is that it's a trend following type of indicator. And the idea is that it's only going to trade in the direction of the overall trend. Number two, it's actually really easy to interpret. And once I actually show you how the indicator is actually plotted on the chart and how to buy and how to sell based off of it, you'll agree with me about how simple it really is. And the nice thing about it is that it actually adjusts for volatility. And one of the indicators that it uses in its calculation is what's called an ATR, or an average true range. And what the average true range is that it'll actually take a look at the prices, how much they're moving, and then this particular indicator can then be adjusted to any time frame that you want. So it's extremely customizable for whatever it is that or the types of markets that you're currently trading. And another nice thing about it too is as I was saying before, I found a lot of training available for it, out on the internet. So you can take a look and see what I've got. And again, there's a lot more available there for you. So let's go ahead and jump out into it. I'm gonna go ahead and just open up a chart and I'll show you how this works. So this chart here that we're looking at here is just an ETF of the S&P 500. The symbol is SPY. And I created a number of different things for this particular add-on here. And one of the things that I created was an indicator that you can actually plot directly on your chart, in addition to an expert advisor, excuse me, 2 different system tests and an exploration. So first of all, what I'll do is once you go up to the Learn MetaStock website and you install any of the formulas that we have up there, for this particular one, what you'll do is that you'll scroll down through your list of indicators here. And what you want to look for is a group of indicators that all start with LMS for Learn MetaStock. And inside of that group, you'll find the indicators from our site there. Now, the one I'm going to go ahead and plot here is just called the LMS Supertrend indicator. And I'll just drag it directly on top of the price bars and then let go of my mouse button. Now, what'll happen is it'll ask you for the calculation periods that you want to use of the average true range. The first thing it'll ask is for the number of periods that you want to use. And then the second box is asking for the multiplier of the ATR. So you'll see the default when it first pops up is just going to be 7.3. So we'll go ahead and use that to get started, and we'll click on OK. When this box pops up, it's really important when you plot it on the chart to make sure and merge it with the scale, whether you have your scale on the right or the left, but make sure and merge it with the scale, and then click on OK, and then that'll plot our indicator. Excuse me. So the way that you interpret this indicator now is you're just looking to see what the prices are doing in relation to it. So long story short is that if this indicator is above the price bars and the price bar closes above that indicator, that's a long signal. So at that point, then this indicator then acts as, for example, like a trailing stop. And then vice versa, for a short signal, the indicator you'll see will be below the price bars. And when the price bar closes below that lower line, that's a sell signal. And then vice versa, this is looking at a short trade, and you're using this now as a trailing stop to exit out of that short position. So as you can see here on this chart, when the prices tend to trend, for example, you'll see that this indicator appears to do a pretty nice job. And the nice thing about this is, again, as I was saying before, is that it's totally customizable. So you can make it any length or sensitivity that you like. And all you really need to do is you can actually do it a couple different ways. But number one, for example, is that you can double click directly on the indicator, and then you can change these parameters to anything that you want. So that's one way to do it. Now, another thing that I created is I created a couple different system tests. And when you install the system tests, again, what you'll find is that they're all going to be stored with the first few letters of the system test that begin with LMS. So what's really nice in version 18 is that they added this search feature. So I really like this because that'll allow you to jump down to the systems that are of interest to you. So I'll go ahead and put in LMS. And then inside of here, these are the different systems here that I've got here on my system right now. But you'll see that when you install this, there's going to be two different system tests here. There's going to be a Supertrend system test and also one with OPT, which is an abbreviation for optimization. So that's the one we're going to look at first. So I'll go ahead and open it up or double click on it. And you'll see underneath the general tab, there'll be a quick explanation about what the system is and so forth. And as a side note, one thing when I was creating this strategy, it's again, a really simple strategy, but it is fairly complicated. And one thing I did do is I did reach out for help on it. And the formula that I'm going to be showing you today was actually provided by William Golson. So really appreciate that. So underneath the buy order here, you'll see the different formulas for the buy condition, the sell condition, and so forth. And up here at the very top, these are what are called the optimization variables. So over here on the right-hand side, if I click on this, what this will allow you to do is if you're not sure what length ATR and what multiplier to use, you can use what's called optimization to find those values. And this will run through literally as many tests as you want it to run through, and it'll come back and tell you. And then, of course, then you can sort on that information there, that data. So for the first thing, what it's going to do, it's going to run or basically test the multiplier of the ATR anywhere from 1 to 10 periods in steps of 1. And then for the length of the ATR, it's going to test anywhere from 2 to 40 in steps of 2 for a total of 200 different system tests. So this is per security. So one thing is that whenever you run any type of optimization or something, you do have to be careful because you can end up tying up your machine for quite a while. But what I'm going to do is I'm going to go ahead and run this, for example, on the SPY. I'll go ahead and put in my symbol of SPY. I'll tell it to test going long only over the last 1,250 records, which is approximately about 5 years of end-of-day data. And then for my trade options here, I'll go ahead and click on that. And I'll just show you how my system test is set up. So what I'm going to be showing you or testing is what's called a points only test. So this is just going to test a raw, or basically return back a raw number of points that were gained or lost in the system test. And for the broker, you'll see that by choosing a points only test, it takes out of the equation any type of interest rates or margin requirements. And I've got 0 set up for my commissions. And then lastly, in the trade execution, I've got everything set to trade at the opening with a 1 period delay. So what that means is that for every trade, say, for example, I get a trade on Wednesday night, then this is going to simulate that I get into the trade on Thursday at the opening. And then vice versa, if I get an exit on Friday, this is going to simulate that I get out at the opening on Monday. So we'll click on OK. And then I'm going to go ahead and just start this system test. So I just click on the start system test, and then down here at the bottom here, you can see the actual progress, or how it's actually going through this. Now, what I'm again running here is I'm running what's called an optimization. And for those of you who are newer to MetaStock and technical analysis and trading and system testing, with system testing, the whole idea is that it allows you to go backwards in time and test a trading idea on a historical set of data. And what optimization does is it takes it one step further, and it says, hey, I don't know what length moving average to use, for example. Let's try, anywhere from 10 to 200 periods. And then what I want to do is I want to see all the results, and then I want to sort on those results. And so that's exactly what we're doing here, except, of course, we're doing it based off of the ATR length and also the multiplier here. So you do have to be careful with optimization, because again, what the problem with a lot of people run into is they typically just run or basically use the most profitable ones all the time. And unless your future data set behaves exactly like what you tested on, you're probably not going to be real happy with the results. So again, there's a lot of different things different ways to look at this information. And then of course, the important thing is to try to be as objective as possible. But once you come up with a report like this, then of course you can sort on the data. And again, what I ran this on is I just ran this on the SPY, which is a symbol SPY. And you can see what the different results are. Now, over here at the very top here, you can see that the top one generated 134 points. It had 9 trades over the 5-year period. So there were 4 winners and 5 losers. And the average profit to average loss was 4.44. Now, what this means is that for every point that I lost on a losing trade, I made almost 4.5 points on a winning trade. And this is the kind of thing that I think is actually really important, because if your average winning trade is substantially larger than your average losing trade, you can be wrong a lot more often than you're right and still make really good money with that particular trading strategy. But if you come closer to like a 1-to-1 ratio where your average loser is about the same size your average winner or even less, then you're going to run into problems. And statistically, if you trade something like that long enough, that will wipe out your account. So just be careful of that. And one way to stay ahead of the curve is, again, like I say, if your average winner is typically substantially larger than your average loser. Now, to figure out what length of the indicators and multipliers, then you can look in these last 2 columns here. So for example, this top one came up with a multiplier of 5 and a length of the ATR of 38. And if you want to take a closer look at it, you can just double click on it and then go right into the report of it. And you can see exactly how, the different results for the system test. So for this particular one, it generated 134 points. The buy and hold, as you can see, is 119. So it outperformed the buy and hold. And what the buy and hold means is that if I were to purchase this security on the very first data point that I loaded on the chart, I'd be up 119 points after holding it for 5 years. But if I chose to trade it, I would have been up to 134 points. And you might say, well, okay, well, that's okay, but, is it really worth it to trade it at that point? Well, before you can answer, those types of questions and so forth, you have to look at quite a bit of other information. But, one of the things, again, like I say, I really zero in on is the average profit to average loss here. And this is where you can see exactly what those numbers are. So, for example, the average profit was over 46 points, and the average loss was a little over 10.5 points. And then the other thing I like to look at too is this number right down here at the very bottom. And this is saying that the out of market timing was 488. So what does that mean? Well, remember that there's approximately about 250 trading days in a year. And so what this is basically saying is that you were out of the market almost 500 bars, which is almost 2 years of time. So what this is saying is that in order to generate this number, you're exposed or you're in the market approximately about 3 years of time. But to generate 119, you were fully invested for the full 5 years. So that's a whole different thing to also look at as well. And another thing I like to look at is this equity curve up here at the very top by clicking on this equity tab. And what this will show you is what your account started off with, in this case, a value of 0, and then of course where you ended up. Now, what you're generally, trying to accomplish here, or what you want to see, is generally as smooth of a line as possible from the lower left to the upper right-hand corner. And everywhere that the line goes flat, that means that you're out of the trade, or there's no trade being on at that point. And anytime that the account kind of dips down, that just means that it's going against you at that point. So what we're looking at here is at the very bottom, this is a time scale. And again, if there's 250 trading days in a year, you can see that at this point right here, this is about 1 year of time. You can see that the trading system really didn't do a lot. At 500, this is at 2 years. You can see it started to do pretty well. And then at 750, this is 3 years. This is 4 years, and then of course 5 years. So you can kind of see how it did during these different periods of time there as well. So there's a lot of different ways that we can go about this, but let's just kind of keep pushing forward here based on the time that I have here. And then lastly, what I really like to do is I like to plot it on the chart. So for example, I'll click on the plot on chart down here at the bottom. and then close down these dialogues. And then I'll close down. This is our equity curve up here at the top. So I'll go ahead and close that down. Right. And then if I zoom in here, for example, on this chart here, I'll go ahead and grab the slide bar over here, drag this over. And what we're looking at here is to make sure that these buy and sell signals make sense, that this is buying and selling where it should be. Now you see that these signals really don't look like they make much sense. And the reason being is that these aren't using the same periods as this indicator. So what we need to do is we just need to click on the indicator, for example, and then adjust it to whatever length that you want to use. So in this case, for example, I'll use 38. And then for the multiplier, I'll change that to 5 and then click on OK. And then, of course, that will adjust it. So then what we're looking at here, as we're kind of looking at these different trades and so forth, is we're looking to make sure that when the price trades above that upper line, 1 bar after that point is where you should be getting that entry signal. And then vice versa, when it trades below that lower line, that's where you should be getting that exit signal. Okay. And as long as you can verify that, then you know that the system actually is doing what you want it to do. And then, of course, you can move forward with it. Okay. All right. So let's go ahead and close that one down. And let me show you something else here. So we'll go back into our system tester here. And again, I've got 2 different system tests here. The other one you'll see is just called the Supertrend system test by itself. Now, if I open this one up and go to the buy order, for example, if you want to play around with specific levels, for example, like you want to set the multiplier and the length of it to one particular level, this is the system that you want to use. But one thing I always recommend that you do is that if you choose to modify a system that's already in your MetaStock program, for example, I recommend that you make a copy of it and then make your changes to the copied version, so you always have the original to fall back on if you make too many changes that you can't get back. So let's go ahead and do that. I'll make a copy of this one. And what you do is just right-click directly on it and click on copy. And you'll see that I now have a system called the Supertrend System Test-Copy. So I'll go ahead and open that up. And here is where we can change those fields to whatever we want. So what I'm going to do for this example is I'm going to change that multiplier, for example, to 5, and then I'll change the length here to 38. And then I'll make sure and do it on the sell order as well. So I'll go ahead and change the multiplier to 5 and then the length to 38. All right. Now, what I'll do next is let's go ahead and run this on a little bit bigger database. So what I'll go ahead and grab this, for example, instead of just running it on one security at a time, now I can choose, for example, like a group of securities. So to do that, I'll go down here to my index constituents folder. And here I've got a folder just called the Dow Industrials, which are 30 stocks. And I'll keep the same parameters over here on the right-hand side, and then just click on my Start System Test. And then this is going to system test that 5 and 38 parameters of the ATR on just those 30 securities there. All right, we'll go ahead and let this run through real quick. And then when it's finished, just click on your view results. And then this will show you, for example, like, you know, how those parameters then worked on those 30 securities. So keep in mind what I just did here. What I did, first of all, is I ran an optimization on the SPY. And then what I did is then I just took one of the parameters or one of the system test results, and now I'm testing it on the Dow 30 stocks just to see how that would do on these 30 securities. So for example, then of course, then I can open up a security like this, open up Caterpillar, and I can see how those results actually performed on each one of these securities there as well. So Caterpillar, as you can see, the buy and hold was 80 points. This one generated 112 points with 8 trades. The average winner was over 52.5. The average loss was about 9 points. And we scroll down, you can see that we were out of the market 500 periods. So what that means again is that we generated this in about 3 years of time versus a buy and hold of 5 years to get 80 points. So that's what I'll do is I'll just kind of go through these different securities like this, and I'll open them up and just see how they did. Like this one, Microsoft, it didn't actually beat the buy and hold. It actually underperformed it. But if we go down and take into account that we were out of the market 571 bars, then that obviously could adjust this number based on that. So again, I just kind of go down through each one, for example, and take a look at them. So here, for example, is Nike. It did 74 as opposed to 52 and so forth. Now, the other thing that I, tend to notice too is, let's say, for example, that we want to go back into that report and I closed it down. All you have to do to go back into it is just right click on it and click on report, and you'll be right back to where you were there. So I'll click on view and that'll open it up. So as you can see, it doesn't, this system is a trend following system. And a lot of times what will happen is that you'll come across securities where it doesn't test well. And then the question is, well, what do I do about those? Well, the point is that a lot of securities will fit a particular personality. And if you're trying to use a trend following system on a security that's not trending or gapping one way or the other, then maybe that's not the right system for it. But if you want to keep working with it, there are different things that you can do. So for example, like Boeing, for example, you can see that this one underperformed quite a bit. And if we open it up, you can see that that this system, for whatever reason, just did not fit the personality of this security. And then the question is well, is there something that I could try then to maybe see if I could use a system on Boeing, for example? And the answer is yeah, there's actually quite a few things. And what we could do, for example, is you could, of course, go into it and you could try different lengths of these indicators, for example. You could also do an optimization just on that one security and see if maybe that might give you some ideas. And the other thing you could also do too is in the system tester, you have this other field, which is called stops. And there's 5 different types of stops that you can work with. And there's a lot of different things that you can do here. I mean, you can try profit targets or maximum loss. You can, again, set it to however you want. And what a lot of people don't know as well is that if you want to do optimization on these levels, you can do that as well. So for example, like if I wanted to do a profit target and I wasn't sure which profit target to set, I could do an optimization on this particular field by just entering in the optimization variable here, and we could test that as well. So a lot of different things that you can do here. Just because a system doesn't perform well on a security, again, you can take a look and see if you can make some adjustments to it that can help you there as well. Now, in addition to that, what I've also done too is I've also created a number of different things that you can work with this as well. But before I get into that, one other thing that I want to show you how to do in addition to this is that when doing the research for this particular trading strategy is there was a lot of different ideas about combining this indicator with other indicators, like adding another indicator with it. Well, maybe the indicator isn't performing that well, on its own. What if I combine it with a moving average, for example, or a MACD, or whatever the case may be? So if you want to combine this strategy, for example, with another indicator, what you could do is the way that you do it, for example, is underneath the buy order is this last line right here. This is going to give you the buy signal for this strategy right here. So let's just say hypothetically that what I want to do is I also only want to buy this security, for example, if the MACD is bullish or above its trigger line at the exact same time. How would I add that to this formula? Well, to do that, all you have to do in this case is type the word "and" at the very end, and then put in your criteria of whatever that second criteria is, whether the closing price is above its moving average or whatever. But let's say, for example, that I want to test where the MACD is above its trigger line, for example. What I could say there is the way that I'd write this formula is MACD, open and close parentheses. And this is going to give us the value of just the MACD by itself. And if I want to know if that's greater than its trigger line, I'd write that as greater than, and then the moving average of the MACD. And the way you write that is move, open parenthesis, MACD, followed by the number of periods you want to use, and then the type of moving average. And if you plot the MACD just on its own with its default parameters, that line, that trigger line that you see on the MACD is a 9-period exponential moving average of the MACD. So in other words, what this second line is saying, it's saying, tell me when this is true and when the MACD is above its signal or trigger line. So then what you can do, of course, is then to test that, just go ahead and click on OK. Select it again. For example, I'll go ahead and select that. And again, if I want to run it on the same group of securities, just click on the Start System Test, and then again, run that one. So now again, it's running the two different criteria. It's looking for the ATR, the 538, for the security to trade above that line, and also the MACD to be bullish. So we'll click on view results. And again, you can sort on these, and you can combine or basically create any type of system you want. Go ahead and plot it on your chart, and you can go ahead and put these here. And to plot that, I'll go ahead and drag the indicator here. Whoops, go ahead and grab that and plot it here on our chart. All right, and we'll change that, for example, to 38, change the multiplier to 5, click on OK, and make sure to merge it. And then to also plot the MACD itself, you can just drag that MACD up here to the very top. And then if you want to use just the defaults again, just click on OK, and that'll plot your MACD. So basically what this is doing now is that you're only getting a buy signal here when the MACD is also in a bullish type of situation there as well. So again, a lot of different ways to combine this to help you out. And again, you can combine it with any type of indicator that you want. So now, in addition to that, I also created, for example, an exploration to help you go out and search for these different situations as well. So again, I'll click on the Explore button up here at the top. I'll type in LMS to get all my formulas together. And I'll select the Supertrend exploration. And this is a really simple exploration. And all it's really going to return back is, you can see in column A, it's going to give us a closing price. Column B is going to give us a date. Column C is going to give us if the security is a current buy signal. And column D is going to give us a sell signal. And if you want to adjust the length here, again, what you do is, again, just make that change right here to those different levels. So for a multiplier of 5, and again, I'll just go ahead and change that to 38. And then again, do that again on the sell side. So I'll make that 5, and then the length here to 38. And then, of course, to run that scan, we'll click on OK. And what I'm going to do in this situation, I'll go ahead and run it on the S&P 100. And I ran it earlier and I didn't get any hits. So I'm going to unselect the filter. If you have the filter selected, then what will happen is the only securities that are going to come up in the report are securities that are meeting the criteria that you're looking for. If you want to see the results on all the securities, then make sure and unselect the filter and then click on your Start Exploration. So this is one thing that I've found over the years as well, is that a lot of times some of these explorations are so restrictive, a lot of times you might not get the hits that what you're looking for. So to check to make sure that it's working the way that you want it to work, what you can do is unselect the filter, and that way nothing will get rejected out. And then what you can do is then you can, for example, like select a security like 3M, for example. And over here on the right-hand side, if you click on this Inspect button, then what you can do is this will open up a report and show you all the results, for example, on 3M. So down here at the very bottom, this is our most recent date down here. And then what we're looking for is over here on the right-hand side, there's a buy and sell column. And what you're looking for is a 1 in one of these columns here. So for example, as I go up, there's one right there on February 1st. Whoops, not there. Actually, there was, I thought I saw one earlier, but I'll kind of scroll up here a little bit. But what you, again, like I say, is you're just looking for a 1 in any of these columns here. And so there's one right there on October 28th, for example. So one of the most recent buys, for example, on 3M was October 28th of 22. So you can close that down, and then you can open up 3M, and then close down these dialogues. And then again, same thing. What I'll do is I'll grab my Supertrend indicator, I'll drag it here on my chart, and change those parameters, for example, to 38 and 5. Click on OK, and merge it with a scale. And then what you can do, and also in addition to that, what I've also created is an expert advisor. So if you click on the expert advisor, this will also give you the buy and sell signals here in your chart as well. So go ahead and select that. And again, I'll scroll down, find the LMS indicator. And where is it? There it is, Supertrend Expert. Open this up. And underneath the symbols tab right here, you'll see that there's a buy and sell signal created there for you. And all you have to do is in here is then adjust these levels to, again, whatever levels you want. So for example, for the multiplier, I'll change that to 5, and then the length here to 38, and click on OK. and then do the same thing for the sell side. So again, one more time, I'll go 5 and then 38. Click on OK, and again, click on OK. We'll attach this to our chart, close that down, and that'll also give you those buy and sell signals there in your chart. So for example, that buy signal that we saw in that report here was on October 28th right here, giving you that buy signal. And the most recent signal is the sell signal here on January 24th. So as you can see, I mean, this is super customizable. You can use it however you like. And as I was pointing out, it's a trend following type of system. So when your securities are trending well, this is actually could be really beneficial there for you, to say the least. All right. So that's kind of what I've got here for you. I hope that's helpful. What I'd like to do now is just tell you a little bit about what we offer here at Learn MetaStock. And if you go up to the Learn MetaStock website, you'll see that this is our homepage here, but we can help you in a lot of different ways. And one thing that we do is we do live classes every week. And we do up to 3 live classes per week. And here, of course, is our schedule. And once you're logged into the Learn MetaStock website, at this time of a class, then just click on the Join Live Class, and that'll get you right in the classroom. And if you can't make that, then you can click over here on the video library. And in the video library, what we do is we record all of our live classes and then put them up here on this page. So for example, if you can't make those live classes underneath the live class recordings, you'll find the most recent classes that we've recorded and put up on the site here. Now, in addition to that, you'll see we've got a lot of different types of category training, or a lot of different categories of training that we do offer. General how-tos, introduction to technical analysis, and so forth. And one thing I recommend is that if you're brand new to technical analysis and just getting started, this is where I'd recommend you get started here, is just go ahead and click on, for example, Intro to Technical Analysis. And then this, of course, will bring up our video. And what we also do, of course, is that if we create any type of formulas or anything else, like, for example, like here's a quiz that you can click on. And what our quizzes will do is they'll help reinforce, what we taught you in the video. So again, it can be just a great learning tool depending on the type of information that you're looking for there. All right, but I'll go ahead and scroll back here. And for anybody else who's just kind of getting started with MetaStock, a great place to first start off here is underneath the Getting Started section. And what I recommend for just about anyone, no matter what level you are, is watch these first 4 videos right here, the part 1, part 2, the next step in the MetaStock Advance. This will give you a really good basic understanding of the program and some of the capabilities. So therefore, after that, then you can jump out to anywhere that you want. Whether you want to get into system testing or formula writing, maybe learn more about the expert advisor and so forth. And you have a lot of different choices here. But as you can see, for underneath each category, we've got quite a few different training classes available here for you. And if you're one of the areas that I'd recommend a lot of people kind of go into and learn more about is our formula writing, because everything inside of MetaStock is derived off of these formulas. And the more that you understand about it, the more you're going to get out of it. In addition to that, we've got videos on the RMO, trailing stops, for example. These are a number of different types of stops you can work with, indicators, and trading strategies is probably one of our most popular sections here on the website. And as you can see here, this is a copy of the Supertrend class of what I was just showing you earlier. But the most recent one that we just created was one done on flags and pennants. And what this will do is it'll go out and find those types of chart formations for you inside your MetaStock program. And again, what we do is when we create these different trading strategies, you can download the formulas and they'll be associated with that video. Just make sure and watch the video, download the formulas, and you can follow along literally step by step. In addition to that, we also do a lot of product reviews. We recently did the latest version of FIRE, which is a very good, powerful program to say the least. And I've got quite a bit of information on that. I'll go ahead and go back up here. And for those of you who are real-time traders, we've got a number of videos just on Zenith. And another area that might be of interest are the interviews. Every now and then, when I come across a customer who's been trading for quite a while and has an interesting story, this actually can be really good. For example, like this most recent interview we did on Chuck Rademacher. he has got a great story, and I would highly recommend that you watch this one. I think most people get a real big kick out of that, to say the least. So, and then lastly, up here at the very top, kind of in conjunction with what MetaStock with version 18, is that if you're searching for help on a particular indicator, you can just type it in up here, click on the search, and then that'll bring up the associated videos with that as well. Okay. So that's, again, what I've got for you. I hope that that's helpful. And if there's any questions or anything else that I can do, I'd be happy to help anyone out with. So, Jeff, are you there?
I am here.
Okay.
Yeah. Hold on just a second for me, though.
Okay, good.
Let me kind of get set up. Let's see. We did have one question that came in, and I was actually typing up a fairly lengthy response to it, but we can go through it together.
Okay.
So Brian wants to know, hey, I've asked these questions before. How do you reference a chart with one time from another chart from a different time frame for the same symbol? So I'll go ahead and take I'll take that part of the question. You can't reference another time frame with a security function, but the security function is a pretty good way of doing that. If you, Brian, if you look at some of the indicators that are built in there that are called, there's an indicator called Pivots Daily, and Pivots Weekly that are referenced to look or designed to look at higher time frames. That'll allow you to kind of get an idea of how we look at like a simulated daily bar from intraday. But we can always help you with that. That's a fairly big question. The other question that he had was, can you hide bars on the chart just to see the indicators only? And you can actually do that. In 18, what you want to do is set them to basically like, I think there's an option to set the chart to invisible, but if there isn't, you can actually set it to the same thing. So thank you for those questions, Brian. John says, impressive presentation. I'll finish typing that answer in just a second too for you, Brian, so you can kind of have an idea. Doug wants to know, can the videos be downloaded, or may they be viewed online? Sorry, can he download the videos from learnmetastock.com, or is it online only?
Yeah, the learnmetastock.com is a subscription. So as long as you're subscribed, then of course, then you have access to literally everything on the site. But unfortunately, no, they can't be downloaded and then stored separately after that. But the good news is that, again, as I was saying before, is that whenever we create the formulas and so forth, and we have them along with the videos, anything that you download from our site, then of course is yours permanently in addition to that. Go ahead.
And one of the things I think is really, really cool about Learn MetaStock, in particular, it's all the formula functions and the stuff that's included was part of that. And I'll talk a little bit more about those, but yeah, the videos you do need to be online to view. It's a really good question.
Yeah, and one other question that I do get quite a bit too is like, do I offer any other type of training in addition to that? I do the 3 live classes per week. Then the majority of our customers spend time, of course, in the video library. And then, of course, you can call me or email me with questions and so forth. But in addition to that, one other thing that I do offer is I do offer private one-on-one training for those that have kind of gone through maybe more of the basics, but they just want to go down one particular area and maybe putting a particular system together and so forth. And if something like that is of interest to you, just contact me and I'll be happy to give you the details on that as well.
Okay. Well, thank you, Kevin. I don't see a lot of other questions coming in, aside from Ed, and I think he said this is impressive. I might have said that already. So I appreciate your coming in and spending a little bit of time with us. We do have a special offer that I'm going to talk about, but before I kind of let you go, Kevin, I wanted to say thanks for spending some time with us this morning.
Well, thanks again for having me. Appreciate it.
All right, very good. Prepare to be ejected. All right, here we go. Let me go ahead and do this as well, and I'll just go ahead and show my screen here as well. And what I'm going to do is just kind of come into the PowerPoint and talk a little bit here about this. As Kevin kind of discussed, you got the learnmetastock.com. He does 3 live classes every week. In addition to that, there's basically hundreds of instructional videos. You got 21 that are basic MetaStock videos, 4 expert advisor videos, 3 system tester videos, videos on stops. There's just so much. There's hundreds of videos up there. There's tons and tons of stuff to go through there. And one of the things that I say a lot when we're talking about MetaStock, I've been saying it all week, is MetaStock is a product that we've been working on for 20 years. There's so much stuff that you can do in there. It's a toolbox, is the way we like to say it, right? And like any toolbox, the better that you understand how to use those tools, the screwdriver, whatever it might be, the better it's going to work for you. So I love Learn MetaStock. I love all of the training that it gets. And we really push Learn MetaStock. It's a good thing that's for new traders, because it really, really helps them kind of figure out everything in the toolbox and understand how all those tools work and the scanning. And it really, really is a great thing to pair with your extended trial of MetaStock. So in addition to that, the other thing that I like is, like, as part of a Learn MetaStock subscriber, he actually has a lot of formulas that he's put together. Like he just talked about the Supertrend filter, but there's 21 complete systems that are in there, 9 templates, 62 indicators, 14 expert advisor, 28 system tests, and 13 explorations. So all of that is part of your subscription to MetaStock. That's just $99 per month. So, and that's the price of LearnMetaStock.com. It's just $99 per month. If you're new to LearnMetaStock.com, and especially if you're new to MetaStock, what you can do is you can do a 3-month special. That's where you pay for a month of Learn MetaStock, and you get the second and the third month for free. That gives you a lot of time to go through all the videos, look at the formulas, go through kind of a lot of the training that Kevin has put together for you, and really, really understand. Because, like, the bottom line with MetaStock and trading software and trading services is, if it helps you figure out what stocks to trade at the right time to trade and all that kind of stuff, if it helps you be successful, it should pay for itself. So with this 3-for-1, even if you've been using MetaStock for a while and just think, hey, I don't really know how to system test, maybe I should learn about system testing. Well, if you do a 3-for-1, this is going to be $33 a month, and you can go through all the training that you want with it. So you can find out, you can sign up for this 3 months of access at metastock.com/learnmetastock. You can give us a call at 800-882-3040, or you can visit us online at metastock.com/saleschat. And I said this earlier, but if you do have any questions, if we're showing something and you just want to see, well, I wonder how this looks on S&P, and you can chat into our sales team, and they'll pull some charts and send them over to you. Doesn't take them very long to do, and they're happy to do it. So, or if you have questions, anything, feel free to reach out to them. One of the things that Scott kind of talked about the other day is how good our support team is, and they're fantastic. They do a really, really good job of helping you. I also our sales team is also very, very good. I think one of the biggest advantages that you have as a MetaStock user, if you haven't been using MetaStock, is the people. The people at MetaStock, because they do such a good job of kind of, I feel, of supporting the customers. If you're a customer, hopefully you feel the same way too. So in any case, if you have any questions for us, you want to get in touch with us, 800-882-3040, and you can also visit us online at metastock.com/saleschat. So there you go. Anyway, let's do we do have a little bit of extra time. So let's do another prize drawing. What I want from YouTube and go to webinar, I'm going to kind of throw a little bit of a shout out to, like, some of our sponsors, but I want some more numbers. So the numbers, the rules, everybody that registered, of course, got put on a big list I pulled this morning from our database. What I need from you is any number between 1 and 12,997. That'll give me, I'm just going to pick one of the numbers you pick. So pick a winner for me, and I'll tell you what the prize is in just a second. I put this slide next because MetaStock is great. And it's if you haven't done MetaStock before, I would recommend you do this with MetaStock. You do the Learn MetaStock, but MetaStock has been rated #1. Vivek's like, I picked me. No, you have to pick a number, and hopefully it's you. 30 years in a row, it's been rated #1. It helps you test trading ideas, scan the markets, do forecasting based on probability. Scott did a really good demo on that. I love the real-time commentary and alerts almost as much as I like the signals. So everything starts at $69 a month if you're in the US, $59 if you're outside of the country. You can also do that with a Learn MetaStock subscription. If you want to do that, metastock.com/conf promo, metastock.com/sales chat. Thanks for the number, Ray God. Or give us a call at 800-882-3040. David also gave me an option. John gave me an option, and Priscilla gave me an option. So I'm going to take a, and maybe Steve. Steve had a comment in here. Oh, yeah, it's a number. Okay. Let's talk a little bit about our sponsors since we just have a few minutes before our next speaker. I do want to say thanks to Stocks and Commodities Magazine today. If you do a subscription to MetaStock or Learn MetaStock for that matter, you're going to get a 5-month subscription for free to technical analysis of stocks and commodities. If you spend $300 or more on anything over the course of this week, you're going to get a 2-year subscription for free from them. They've also been great sponsors. It's a great magazine. I get a copy. I've been getting a copy delivered to me every month for like 26 or 7 years now. It's a great magazine. You know, as part of your membership, if you sign up for just Stocks and Commodities, you have access to all of their trading archives, 17,000 articles. You can join one of the 1.2 million subscribers that they have. They've been making that magazine since 1982. Thanks for all the numbers, Randolph. And yeah. All right. The other sponsor, since I haven't given away a winner yet to Vonda, but it's coming right up. The other person I want to say thank you to is CMT and the CMT Association. CMT, Tyler came in. He did a really good talk about technical analysis. Shows a really good graphic about how if you're trading professionally, a CMT designation might be helpful for you. And if you have assets under management, if you want to get more assets under management, that can be really, really extremely helpful in terms of pulling those in and getting them available. The CMT, they do accreditation. They work on risk management, systems development, portfolio management, and behavioral finance. So there you go. Okay, cmtassociation.org. You can also call them 646-652-3301. Now, one of the questions that actually, Kelly, you have access to all of the numbers that have been due, and we have a lot of really good numbers. David, John, Priscilla, Randolph, Ray God, Steve have all given us numbers. What I would like you to do is pick one. Okay. Just making sure I have enough 10,000s to enough zeros in 10,000. Okay, that would be VSUD. And with that, that's a Hotmail account. And that's how you registered VSUD. So I'm going to go ahead. I'll add you to the prize list. If you're VSUD and you're interested in what you win, me too. Let's find out. Let's go over to the prize table here, and we'll just go with some of the prizes. Okay, this one is actually this is the only prize like this that we're giving away, and it's actually a $2,700 value, and it's actually a 12-month. Here, let me go ahead and kind of put your name here before I 12-month mastery course, an online certificate from the IOTAF. So we do have somebody from IOTAF coming in and talking. But this particular price, the Master in Trading Certificate, is a 12-month online program where you'll learn to trade stocks, bonds, Forex, commodities, and crypto in the stock futures options market. It includes 80, and then I can't read the rest. Sorry. No, I'm just kidding. Let me expand this. It includes 80 online classes as well as access to daily live classes, strategy sessions, group mentoring sessions, and live trading classes. That's 1 year of access to 80 classes, all these live classes, everything like that. So congratulations. That's a really, really good prize. What will happen is if you've got the right Hotmail account, we'll be reaching out to you on terms of how to get access to that prize. So there you go. looks like I did a pretty good job of kind of covering a little bit of the gap. Thank you for the numbers, everybody. Let's talk about a couple things that are questions that always come up while we're getting the next presenter ready. One of the questions that we always get is, are these sessions recorded? We have been broadcasting this all week to YouTube, which if you've been watching us in YouTube. But what'll happen is if you're in a GoToWebinar, about 1 hour after we conclude today, you're going to get a copy of the recordings. So there you go. Comment from Haiti in Texas, or Sandra in Texas. Sandra in Katy, Texas. Here all week except Monday. All great presentations. Thanks, Jeff and MetaStock. I'm glad you're enjoying it. Thank you for the kind words. Brian has another question. Good time for a question. I have another question. Can you plot volume on the y-axis, i.e. volume versus price level? Brian, that's a really good question. That's something that we'll be working on. I don't have any kind of deliveries in terms of what that is. If you have MetaStock real time, you can do it in Zenith. But what you're talking about is volume at price. That is something you can do in MetaStock real time with the Zenith charting. And it's something that we are working on putting together for MetaStock. Mark wants to say, can I avail even if I'm a newbie? So one of the things I like about MetaStock, I know one of the things that I personally talked about was the RMO system. There's a reason I like to talk about the RMO system in particular. I think it's something that's very simple. It's objective. It has money management stops in there. And yeah, I think there's something that you can take advantage. The thing I like about MetaStock is I would say it's fairly approachable, right? Like we designed it to look like one of the things that I remember hearing for 26 years, even when Steve started, was like the biggest thing we want to do when we're designing the software out is to make sure that you can focus on the interface, on the trades and not the interface. I almost said that backwards, but it's focus on the trades and not the interface. So we designed it very much to be like a drag and drop, click and pick, to work like your other like Office applications, so that's fairly approachable. Now, the other thing that I like about MetaStock is you have to keep in mind with MetaStock, it's a very mature program. We've been working on it for 30 years now. And with it, you will have the ability, what I guess I'm trying to say, and I lost my train of thought in the middle of a sentence, which isn't uncommon, but what I'm trying to say is that the more you learn about MetaStock, the better it's going to work for you. It isn't a program that you're going to invest in and then like 6 months later going, oh, well, this is just a moving average product that just gives me buy and sell signals. As you learn more about the market and different things, it's something that's going to fully adapt to you. So there you go. Let's see. Vivek says, hopefully that's helpful, Mark. If you have questions, and also along those same lines, we include a ton of training to help you get started. We have that one-on-one session that's going to help you. They're going to sit down and make sure you understand anything. If you are brand new to the markets, learn MetaStock could be a good idea because he's got all the lesson on the risk of ruin and what is technical analysis and that kind of stuff. But yeah, if you're a newbie, that just means you haven't developed bad habits yet, like the rest of us. So yeah, it's definitely something that you should be able to take advantage of. Vivek says, Jeff, awesome work this week, bringing all this content to us. Thank you, Vivek. I'm glad you're enjoying it. I think it's gone great. I want to say thank you for coming every day. I've seen you here every day. For everybody that's come in and participated in the event, for all of our great speakers. It's been awesome. I really appreciate it. In any case, I stalled for 20 minutes. So there you go. Adrian is our next presenter. Adrian is a good friend of mine. I've been giving away his Around the Horn books. I love the methodologies and the visual nature of the patterns that he likes to talk about. A great technician, partner and friend of MetaStock for, geez, longer than my hair went away. But he's been decades partners with MetaStock. Let's go ahead and bring him on here and talk to him a little bit. Adrian, how are you doing?
I'm really good. Are we?
That's good. I can hear you.
Webcam here. There we go. So it's a trading day. So we're sitting here, slumming it in sweatshirts and such in the office. But it's good to see you. I appreciate the kind words. And yeah, we've been we've been MetaStock fans. It's going on 20 years. I'm gonna say it's been at least 20 years. So that's
Cool.
been fun.
I just sent the screen share over to you. I can see it. You sound good. No
All
problems
right.
yet. Let's make sure we can see your screen, and then I'll get out of your way. Okay, I can see it. Everything looks good on this end. I'm here if you need me, Adrian. The floor is yours.
All right. So I will turn the camera off for a minute just so that it's not distracting, right? And then we'll turn it back on again if we do questions or whatever. This time, I left a lot of room for questions at the end of this thing because it's happened before, right? That I run out of time and then can't answer questions, and you know, I think that's worse than having just a little bit less on the content side. Today, I'm doing something very, very different from what we normally do in these sessions. So normally in these sessions, I talk a lot about the plugins that we've got for MetaStock, which are fantastic, right? So if you run my around the horn stuff, the patterns, I'll talk about where those come from in a second here. But if you run those in MetaStock will pretty much spit out a picture perfect representation of what each one of those patterns should look like on a daily chart. And then you can go and drill down and trade them either intraday, or you can trade swing trades, right? We do mostly day trades. We are active traders. We don't hold anything overnight. But MetaStock does a great job in the module, in the around the horn module, of going and finding the patterns that I trade. They're all going through and pretty much tracking order flow, tracking money flow through the markets, figuring out where the money's going, where the money's been, following the footprints of money as things move through the markets. And today, what I'm going to do is something more sort of nuts and bolts. This is going to be, how do you take the numbers that are right in front of you and interpret those in terms of what's going on right now in the indices, and then trade those indices using either stocks or options or futures. This is very applicable to what most of you do. I know a lot of you trade options, a lot of you trade futures, guys like the leverage. Julie and I, we pretty much trade the stock, right? So we trade the ETFs, we trade the stocks, we trade opening gaps. You guys have all seen my opening gap seminars that we do. Today, let's focus on trading the indices. So here we go. Okay, so that is the lovely Julie and me. We are at the New York Stock Exchange there. That is sort of where we made our home for a lot of years. We only traded NYSE listed securities. We were down on the floor of the exchange quite a bit. We spent all sorts of time analyzing data when we were working on our PhDs that came from the New York Stock Exchange. So the reason for this was we're both psychologists. We both have PhDs in psychology, and we were very attracted to the fact that on the other side of every single trade that happens on the New York Stock Exchange is a single human being. So that single human being used to be called a specialist. Now it's a designated market maker, and gave a personality to each and every stock that they traded. So when, I think I'm in front of the Barclays booth with Julie. That would be Jason, our friend Jason runs that booth. It would be Michael Kors. It would be Harley Davidson. He traded Disney, right? He traded, so the things that he traded had a very specific way of trading that we were able to identify, and that then you could go through and you could sort of replicate the psychology yourself of, all right, well, here's what's going to happen if it gets to level A. Here's what's going to happen if it gets to level B, if it goes up, if it goes down, right? He's going to keep it sort of bracketed up in whatever region he's got it in. And that's where we cut our teeth. I mean, this is how, we figured out what trading was going to mean for us. over the years, this focus on decided it's time to go and trade NASDAQ, trade ETFs. That was mostly a function of automation. So NYSE became a place that was no longer so driven by the specialist system. It became a place where ARCA, the archipelago, the order routes began doing automated trades. Things that were less than 1,000 shares were going through ARCA were automatically routed to the most efficient order route. So it wasn't so much anymore reliant on that one guy. So we opened it up. We started trading the NASDAQ. We started trading, as I said, ETFs. We started making the move into sort of a broader trading business. And over the years, this thing has developed into something of a phenomenon, because we still do what we did at the very beginning. So we are still trading those patterns that we traded at the very start. Things that are around the horn are still the patterns that we trade. We still focus on the psychology of what each trader is doing. And it took off and get a lot of people interested. And now we've even got a TV show about it called Trader Nation, which is going to be airing, I think, in this spring or this summer, and will be on a Scripps network, probably in wherever you are. And what we do here is we go back to our basics, and we're going back to those. We do a deep dive with trader psychology. We're going to focus on, like, I think the first episode was all about the gamblers. So we've got traders who, I heard Jeff talking about, the habits that people get into and the things that get people sort of in front of opportunity in different ways, right? So the gamblers are guys who, in this case, one of them is a guy who likes the action and suffers because of it. And another one is a guy who likes the risk, but likes to control what's in front of him and does very well because of it. So how do those people work with their psychology? How do they get around, the things that might hold them back? How do they turn things into opportunities? How do they overcome the problems that are sort of inherent to the way that they think? And it's going to be an interesting show. If you'd like to submit a question for the show, you can just send me an email with a video of yourself on a phone. Right, do an iPhone video. It's for the America Ask segment, and it's just Adrian@traderinsight.com, and just ask a question, and we'll try to get it answered on the show on TV when we do this thing live. So it's all fun. It's all good stuff. I'm just telling you about this because it's exciting for us. It's changing up the way that we do things, or changing up some of what we do, and it's when you've been staring at these screens for the last 20, 25 years, it was a welcome change for us. So we spend a lot of time, Julie and I, sort of in and around the market. That's our son Connor. He's, he lives and breathes the market. He's in the middle there, sitting on the bull, obviously. We spend a lot of time still involved with the New York Stock Exchange, still involved with the things that were our roots. And, over the years, what we've come around to is, people want to overcomplicate this thing, this trading thing. They want to come up with a way to trade that handicaps everything out of the trading day and makes it possible to not really think about what's going on. You're trying to take the emotion out of it. You're trying to create an algorithm most of the time that will tell you what to do. And then the reality is that most people who apply this kind of method wind up not doing the thing that they're told. So that gets into your psychology, that gets into your sort of self-image as a trader. It gets into this entire notion of, who are you, and what exactly are you doing here? So we've written a ton of stuff about this. So we've written a lot of articles for magazines, for journals, talking about not just the technical side of trading, but also the psychology of it. What is it that is going to make it very difficult for you to trade? What is it that's going to make it very easy for you to trade? What are the things that are going to create the interplay that's either going to give you a successful career as a trader or hold you back? And most of what we found out is, as Jeff pointed out earlier, you will wind up being your own worst enemy quite a bit. The biggest roadblock to your success is between your ears. And I've got people who I trade with every day. We have a trading room, and our clients are in there. So we do these boot camp things, and those guys wind up trading with us for years. And we'll see them every day. And every day what they do is fall into the same patterns of just the psychological stumbles of their system tells them to do one thing, they don't do it, then later they regret it, so they jump on the next opportunity even though it wasn't as good, and then they wind up losing money, and then you see, I told you I wasn't good at this, and this goes on and on and on, right, over time, where they'll continually second guess themselves and then always wind up in the position of losing even though their instincts were correct to begin with. And so a lot of this stuff that I wrote in these magazines talks about the different patterns and things that I look for, but it also talks about the psychology that's necessary to get yourself in front of opportunity and then to act on the opportunity and do it consistently across time. And that's the strategy that we're going to talk about today as well. These are the books. I wrote Around the Horn was the first one, and is still the cornerstone of everything that we do. MetaStock has given away a lot of those books over the years with the module that searches for the patterns. The patterns are fantastic. The most important thing in that book, of course, is that you understand why the analogy to baseball is there to begin with. There's a bunch of things, right? It's the psychology of Around the Horn is really about moving around the horn with the market, going through the cyclical nature of markets and when are stocks being accumulated, when are they being distributed, when do you have consolidations going on, and how do you react to each one of these phases? And then at the same time, do you have the psychology necessary to step up to the plate each time and have a fresh look at the market, to not remember the time you struck out, to have a fresh perspective on the next swing that you're going to take? Are you focused on the time that you knock the cover off the ball and hit a home run, or are you focused on hitting singles? And really the important thing is that my psychology is going to square up with what's actually going on in the market. So that book is representative of pretty much everything that we do. It was, I wrote that, the first edition of that was, I think, in 1999 or 2000, and it was the groundwork for everything that we've done since. So really nothing has changed. Julie and I are still stock traders. So as I said, I know a lot of you trade options, a lot of you trade futures. We do what we have done since the beginning. We don't hop around. We don't, there's never been a period where we traded FOREX. There's never really been a period where we traded options. I've got lots of clients who trade options. We sort of tweak things to help them figure out how to apply this stuff to options, how to negotiate the spreads that have to happen in options trading, how to negotiate the slippage that happens when you're trading options. But Julie and I, we focus on those core stock trades. So as we go through today, and I talk about this pretty straightforward, simple kind of a strategy that I'm going to show you, remember that it all emanates from something that we developed in graduate school in the 1990s and have used ever since. And I think that's really if we've got something we can point to as our biggest strength, it's we've been doing the same thing for 25 years now, and it still works for us, and we're still doing it. And you're not going to hear us talking about some newfangled system or some new scan or something that we just developed that's going to make you 1,000% return tomorrow. It's always about this basic methodology that led to all the rest of this stuff. So World Cup trading, that is obviously the Italian version of around the horn. So we took that baseball metaphor, the baseball analogy, turned it into soccer, and the rest of these things beat the street. And Trade Secrets over on the right there, those are the international versions published by Harriman House of the core books. So the core books are still Around the Horn, Trade Secrets, and Tricks of the Trade. So what do we do with all this stuff? We broke it down into a learning system. So a lot of people came to us over the years and said they'd like to learn how to do what we do. They want to learn how to trade. We are, of course, as PhDs, you know, we always look to be educators. We thought that someday we would be teaching at a university. Instead, we are teaching at our own sort of university. We go out and we train people twice a year. We don't do a bunch of this stuff because our core business is still trading. But we do this income trading academy that is then paired with our live boot camp. And that then gives the guys all the fundamentals in what we do. We do it with 20 people. We do it twice a year. We get about 600 people who apply for this thing. We try to make sure that the psychology of the applicant is going to be suitable for sort of what we do and how we do it. And then we narrow that down to 20 people who are going to come and work with us. We usually do it in Miami Beach because it's not very easy to do things here in Los Angeles because of the time zone and everything. And then they work their way through. So you can see there's a trader work environment scale and a trader type inventory that are available on our site. If you guys are interested in taking those, they're free. You just go to traderinsight.com and well, send us an email. Send Julie or me an email. It's either julie@traderinsight.com or adrian@traderinsight.com. Let us know you want to take those inventories. Those will give you some insight into how you work and how you do things. And also give you a feel for what's actually suitable for you. And then if you find out that you want to work with us, you know, you can sort of start the process of, you know, do I want to go to boot camp? Do I want to work through these other courses that these guys do? These are all things that we do to make a living. And if you're a good psychological match for the way that we do things, then they might be a good fit for the way that you can make a living going forward. If you look around those tables there, if you look around that room, these are all people who have committed at this point to, you know, what we think is a year-long adult learning process, winds up being more like a 10-year program because they never go away, because we all wind up being very close friends. And the thing to focus on as you look around the table is, you know, next to me there in the bottom photo, there's a guy who ran a chemical manufacturing company. There's a guy who was a cop. There's a guy who is a cop, trades from his patrol car in Michigan. There's a guy who's a farmer. There's a guy who's an attorney. There's a guy who's owns a plumbing supply company. And, you know, you can go right around that table, and what you find out pretty quick is everybody is, you know, from a different walk of life, but everybody is very much the same in that they want to conquer this thing trading. What they have to overcome in almost every case is their own psychological demons. So you've got your relationship with money. You've got your family. You've got all sorts of pressures on you each and every day that say, am I smart? Yeah, I'm smart. All those guys in that room, very, very smart guys. Am I competing with myself in terms of my psychology? And what is it that I'm going to do to temper that psychology then and make it possible for myself to make a living trading. And that is part of what we do, you know, when we're working with these guys one-on-one, or when we're working with them in that room there, right? We're going around, you can see everybody's got their computers, everybody's trading live, you know, they're all successful to some extent in their trading business. They all want to be more successful in their trading business, more consistent, right? Consistency is always the big thing that comes up. And the way that you get consistent is you know yourself, then you know the material, then you get actively involved in the business of trading, then you look for the feedback that you get from these people who are around you, and you practice, right? So I put these guys in front of a ton of simulation. You know, we go through and we say, you know, you've got to go and simulate the trades, go through with MetaStock, do the scans, go through, find the patterns, and then day by day trade them out in a simulator and find out, you know, what's it take to really make a living doing the strategies that Julie and Adrian have developed. So with that, let's talk about the strategies, and you know, we're going to talk, like I said, one strategy in particular and what it takes to get in front of an opportunity and then capitalize on it. So ask yourself, look through this list of things here, and ask yourself, how many times have I failed to pull the trigger on a good setup? So how many times do you sit in front of the screen and you see the opportunity, it's coming right to you, and then you don't do anything with it? And then it comes back a second time, and maybe you don't act on it again. And then when it comes back the third time, you go and you act on it, and then you wind up losing money on a position that made you money the first two times that you didn't take it, and you start questioning your ability as a trader. How many times have you been in a position and it was going against you and you moved the stop, or you didn't have a stop to begin with? How many times did you say, you know what, this is, you know, maybe the stop that I have set here is too tight, so I'm going to give this thing room to breathe. And then when you give it room to breathe, you're like, well, I'm already down this much, so here's what I'm going to do. I see this other level. Let's treat this like it's a new trade, and let's move the stop to this new level, and let's see if, you know, maybe we can recapture some of what's gone wrong here and sort of get things going in our favor. That's a function of, we don't like to lose, right? So we don't like to take the loss, because when we're in the loss, it feels bad, or when we finally take the loss, it feels awful. And taking a gain feels good. That's a win. Americans in particular are super focused on winning is good, losing is bad, right? Winning, I'm winning. Well, what happens then is, every time you have a small win, I've got a guy who trades a strategy we're going to talk about today, and, you know, I'll tell him, you know, our target here is $1 or $1.50, and, you know, he's trading it in the options market usually, and I'm trading it in the stock. And I'll say, all right, I'm out at the target, and he says, oh, you know, I got out with 20 cents, or I got out with 30 cents. So why does he do that? It's because getting the win, booking the win, feels good. Booking a loss feels bad. And, you know, you go right down this list, and, you know, you can see these are the habits of traders across the board who we run into. They'll add to losing positions. They're going to dollar cost average, right? Which is never a good idea, especially when you're trading actively, when you're trading intraday. They have big profits in the morning. So John, who you'll see on the pilot of our show, he's a gambler, and he makes big profits in the morning, because we've got a lot of strategies that focus on the open, that focus on, you know, booking some big wins first thing in the morning. And then he gets pretty loose and decides he's going to spend the rest of the day trading because he had a good morning. And by the time the afternoon rolls around, he's got himself in a deep hole. He'll take a $5,000 gain in the morning and turn it into a $5,000 loss, which is a $10,000 turnaround, right? And then spend the rest of the day trying to get out of the hole. So by the end of the day, his big success is he's back at zero, or he's back where he made a few $100s, where the reality is if he would have just stopped trading after the morning, he would have been profitable for the day. Taking unplanned trades, holding them for home runs, right? These are obvious problems that we've all seen ourselves get into. And then also reducing position size after a loss. So you had some losses, and now you tell yourself, well, you know what, I'm going to cut my share size down to 100, and or 50, or 1, or whatever you're cutting back to. And then once I get consistent, I'll up the share size. That's an inability to focus on your relationship with money. And what it does is it says, you're going to cut this back until it feels like it has no impact on your life, or it has no impact on your finances. And then once I get good at it, I'll up the share size again. And what really winds up happening is you get good at it pretty quick, because it really doesn't mean anything to you. And then as soon as you raise your position size back up again, you wind up in the same place of, holy smokes, wait a minute, I'm down $500 here. I don't have a P&L on any stock that I'm trading ever. So I don't have a thing up that shows me how much I made, how much I'm losing. All I know is I've got a plan. I've got an order out there. I'm going to let the order take care of itself. And at the end of the day, I'm going to find out, did everything go according to the plan? Did my trades go off the way that they were supposed to? And the way that I measure my success is, did I do what I was supposed to do? Yes or no? And it's not about, did I make money? So these are all things that you can think about. I mean, ultimately, you have to make money, right? It's a business. But the path to that particular freedom is you have to stop focusing on the end result and focus more on the process. So we've got lots of stuff. I'm not selling you anything here today. I just want to tell you that, we've got different strategies for different times of the day. A big part of our business is focusing on workflow. We've got a NASDAQ strategy that's all about trading volatility. So I've got a strategy here that goes and says, I've got, usually it's Apple, it's Microsoft, it's Netflix, it's Tesla, or it could be NVIDIA. But there's 4 stocks on this scalping setup that I do. And they're not really scalps. I mean, they're more volatility band setups. And what they do is they focus on, how can we get in front of the order flow from yesterday, the thresholds that gave us big moves in the prior session, and when those thresholds are hit today, how can we get in front of that order flow so that if it reasserts itself, we can go for that same ride? So the scalps there are really, you're looking for anywhere from 60 cents to $2 in terms of the range that you're looking to track. Then I've got an opening gap strategy. And the opening gap strategy goes through and it handicaps. It says it's that second thing there with the red and the green zones on it. It says if you're in the S&P 500 or you're in the S&P 400, then did you gap by 2 standard deviations of the volatility that we expect to see in whatever the stock is for the day? And if you gap 2 standard deviations, then are we looking for a reversion to the mean? So are we looking for a fade either to the long side or to the short side based on what just happened in the pre-market, in the overnight session? All of them are focused on gaps that are either in the news or are driven by earnings. So we focus almost entirely on run-of-the-mill news, run-of-the-mill earnings stuff, and did that gap push the stock further than you would expect it to be pushed statistically? And if it did, then we look to fade it. I've got this fastball XRV strategy. That is another order flow strategy that we use. Goes through, finds out based on what happened yesterday, Is the order flow likely to reassert itself? Was there something happening that an institution was doing that didn't get finished over the course of the session? And if it winds up being the case that it pops up on our nightly radar there, on our nightly scan, then we put it on for the next day. I've got 1 or 2 of those almost every single day. Those are pretty much $1 moves. We're looking for a move to a pivot line, and it's completely automated. So I'm just putting that in ahead of the market. I'm saying, get me in at a threshold, get me out at $1, get me out for $1 loss over the course of a year. That thing puts up about $10 per month per share traded. I know exactly how it performs. I don't need to interact with it during the day. I can take myself out of the equation. And it's the same thing with the around the horn trading plan, excuse me. So the around the horn trading plan, those are the things you can scan for with MetaStock. You set those up ahead of time. You set those up with conditional orders, with bracket orders. They go, they execute, and they replicate all of these patterns that I've got in the book here. And what they do is they just go through. A fastball is an expansion of range, expansion of volume, looks for institutional order flow. Infield fly, that's an exhaustion after a big move to the upside. These things represent the market cycle. I'm not trying to fight the market, right? Almost every cycle starts with a fastball move. Almost every cycle is going to have an infield fly set up. The line drive is a gap and go. The 3-2 pitch is a reversion back down into that expansion of range and volume move that I call fastball, right? So it's like a fib pullback, but it's not necessarily a fib. It's just driven by order flow. Backdoor slider is an inside day on the heels of a fastball before a cycle continues to move. Switch hitter is a Fibonacci retracement, right? And double header is like a kings and queens kind of a setup, something that reverses back into the trend, takes you back down towards the dominant trend, gives you the opportunity either to go long, to go short. But all of these things, when you look at them, represent your cooperation with the market instead of you trying to beat the market. We're never trying to beat what's going on. Every single thing that I do, everything that I look for in these MetaStock scans is focused on how can we figure out what the market is currently doing, what the most likely reaction of the market is going to be over the coming days, and then how do we capitalize on those opportunities. So if you don't have it already, I assume most of the people here, your MetaStock users, you probably already have the scans. But if you have them, use them, right? Because they're incredible tools. I use them every day, right? And I literally wrote the book. So it's a great tool to have in your belt and to put to work for you each and every day. So our big thing is we plan everything. So what you're looking at here is, my personal, these are gouge sheets that we have for our trading plans. You can see there on that particular day, right? It doesn't really matter what day it is. It's what's the symbol, what's the setup. So just by looking at this, I know without having to look at a chart or anything, I've got Dick's Sporting Goods, DKS down there on the stocks to watch. It's a switch hitter. That means it's a fib retracement. I'm looking at an 89.90 entry. I'm going short the stock. I've got a maximum stop up around $90.80, $90.78, 50% of the distance to my profit target, $89.24, and the actual target, $88.58. That tells me everything I need to do to set the trade up in the morning and let it go. So I don't have to interact with this stuff. I don't have to second guess anything. Abercrombie and Fitch, you see there, it's on that day, it was a switch hitter setup again. That's a fib pullback. I've got my entry, I've got my direction, I've got the stop, I've got the target, I've got 50% of the distance to the profit objective. That's where the stop gets moved to break even. Everything in my trading software can be automated so that I don't have to fool with this stuff over the course of the day. This is where I do the analysis. So as I said, I'm not looking at these and saying, gee, how's it going right this minute? Because what that does is introduces this problematic psychology of you're evaluating and reevaluating everything that you're doing all the time. What Julie and I have found over the years is, you are really not going to be the best manager of your psychology if you're trying to influence yourself over the course of every trading session. What we do instead is we look at this particular spreadsheet daily, weekly, monthly, right, quarterly, and we get a good analysis of what's going on. So I see, how many times did I identify a pattern? How many times did that pattern trigger? What was the profitability of that pattern? What's the overall profitability? How many times am I long? How many times am I short? And what I try to do is put this stuff up against the metric of, okay, and what was actually going on in the market? Did I introduce some sort of selection bias when I was setting up these trades? Did I favor, say, the fastball trade when it didn't trigger that often, but I was out there looking for it? So I can look at those pies up there and just say, you know what? Pretty much the number of times that I identified it were the number of times that it triggered. All right, was it? So if I got myself into that trade very frequently, did that trade wind up being very profitable over time? And then I look at my pattern profitability and I say, yeah, it did, right? So I didn't have a bias in selecting the trade. The trade selected itself based on what was going on in the market. And over time, over the course of a year, right, there's a day trading account allocated out at 4-to-1 leverage, right? How much did a $100,000 account return? And I can see, okay, well, the return on equity, it's a job, right? This is not investing. This is a job. You have to go out there and earn. And the more money you're trading with, the more money you should be making in that account if you're doing things right. So this gives me the metric to go through and evaluate, all right, what happened last year? There's last year. What's happening this year? Right? Where are the patterns? Where's the profitability? What are the things that are making money? What are the things that are not making money? How much is represented by the things that are losing? You see there's 2 patterns this year that haven't come through in terms of profitability. That was infield fly and double header. Then you go up and you look at how many times that those patterns present. Oh, not very frequently, right? So I'm not worried about their performance because they represent this tiny little piece of the pie. Then I can go over and look and see, oh, infield fly has only been 5 times for the year and double header was only once. So right now the data is insignificant. So I'm not giving myself this emotional beatdown that people do of, oh, you know what? Every time I get in front of that position, I wind up losing money. So I'm just not going to do it anymore. Right? What I'm doing instead is giving myself a very objective, analytical framework to say, I'm not going to damage my own psychology. What I'm going to do here is look at what actually happened and give myself a fair evaluation of my skills as a trader or my skills as an analyst. So I think that's really in a nutshell, in a big nutshell, right, is what you need to do in order to foster your own success going forward. So we tend to trade pretty heavily around the open. That's where we've got our discretionary trading. And even when you've got a lot of discretion in what you're doing, you need to be aware of your strategy, your discipline, your psychology. You need to have all these things in place. You need to have everything lined up so that you can go and give yourself an objective framework to work in right around that opening bell. So if you're a day trader and you want to get out there and show the world what you can do, then what you need to be aware of first and foremost is, what's the strategy, say, I have to do in order to succeed? What's the discipline that I need to put in place in order to succeed? And what's the psychology that I need to use to avoid beating myself up, to avoid putting myself in this bizarre position of constantly second guessing, how do So this is my workflow. It's not necessarily what it's going to be for you or for anybody else, but when we do these, like I said, we do these boot camps, and I talk to these guys about workflow. And then we go and we do a bunch of ski trips. As a matter of fact, we're going this weekend. We're going to Mammoth. If any of you are going to be there, shoot me an email if you happen to be going skiing. I love talking trading on a chairlift. And a lot of what we talk about is how do you organize your day so that you know what it is you're going to be doing, and you don't feel like there's some sort of random walk going on as you're trying to organize your trading. Well, in the pre-market, what I do is I program up those fastball XRV trades. I program the trades from the MetaStock scans, right? The around the horn trades, the New York Stock Exchange trades. Those are all NYSE, right? That I scan for. And I pre-program those, and those are set up to go, and set it and forget it, just let it take care of itself. Then at the opening bell, I execute the NASDAQ opening trades, the Apple trade, right? So we look for certain levels that occur on the exchange, on Apple in particular. So we try to get a pre-market feel for where the inflections are going to be. We go and we time those, we set up the trades, we get those going right at the opening bell. Once the 5-minute mark hits, we focus on those 2 standard deviation opening gaps. So we do that from 6:35 in the morning Pacific time until 7 in the morning. And the reason for that is that scanner finds a distribution that has moved 2 standard deviations away from its average. And over the course of the first 30 minutes, we've got a 95% expectancy that this thing is going to revert to the mean. After the half hour is over with, we've got a very high probability that if it hasn't reverted, the distribution has shifted. And if the distribution shifted, it's no longer a valid setup, right? So we've got like the time slots filled where we know exactly what's going to go on. After the market closes, I go through, I do my analysis, I figure out what we're going to do the next day. But it's a very straightforward setup where what we're doing is figuring out what's the workflow going to look like, and then we're just going to go and capitalize on automated opening trades, 2SD gap trades, and then the super cap volatility band trades. And that's the one that I'm going to talk about here in a second. Is how do you go through and identify where that order flow is going to be and capitalize it over the course of the day. So again, strategy, discipline, psychology, those things have to interact in a way that is going to make it possible for you to get in front of the opportunities and actually then cash in on them. So the first thing you're going to do, plan the trade. I'm going to show you my scalping strategy for the triple Qs here in a second. And what you're going to see is I set it up and I let it come to me. I'm very much about, I'm a trapper. I'm not a hunter, right? There's a good article about me in it was SFO, Stocks, Futures, and Options magazine, and they said hunters versus trappers. Well, Adrian is a trapper. He has the price has to come to him, and what he wants to do is set the thing up to snare it, and then other people focus on, they want to hunt, they want to chase momentum, they want to, that's not us at all. We are very, very focused on let the price action come to us. We have logical stops based on support and resistance. So you've got a target that's based on support and resistance. You have a stop that's based on support and resistance. And if it hits those inflection points, you're out. You're not trying to hang on to it. You're not trying to move the stop to give it more room to breathe. You've got everything in place in a very, very objective manner. Makes it very easy for you then to go through and actually do what it was you said you were going to do. And this should always be your evaluation of your success or failure as a trader. I'm not going to say failure, your success or your need to foster some more success as a trader, right? So when we trade our plan, everything is done automatically. Everything is done with the benefit of trade automation, and we get in, where we're going to get in, get out where we're going to get out. And as my son used to say, you know, he's 15 now, so he didn't say it anymore, but he used to come into the boot camps and he would just say, guys, they're going to go where they go. So with that said, let's talk about your relationship with money, right? So I think personally, you should have your P&L off the screen when you're trading. I don't think that it's ever useful to have a running indicator of whether or not your current position is profitable. You need to follow through. You need to, so if you take those assessments that we have at Trader Insight, if you take the psychological assessments, what you're going to find out is, you know, based on the test, based on my answers to some questions, how good am I at the follow through? What's your relationship with risk? So when we look at these charts in a second here, think about, you know, how comfortable would I be trading with that amount of risk on a position? What if it starts going against me? How am I going to feel about what's happening in the trade? And then how do I deal with boredom? This could be a lot of time sitting in front of the screen doing nothing at all. So this particular strategy that I want you to think about in terms of, you know, how do you relate to it as a trader, goes and tries to identify institutional order flow. So what I'm looking at today here is the triple Q. Triple Q is going to be a good proxy for just about everything, right? Just about everything technology oriented. And it's an easier place to identify order flow. It's an easy place to identify the trends. So you're not trying to drill down into a particular stock or a particular sector. You're looking at the comp. You're looking at the NASDAQ 100. You're trying to figure out, right, what's the trend in the overall market. Then you're going to look for confluence. And I'm only showing you two things that I look to for confluence today. There's more, right? So we're doing an event in Vegas where in front of the Traders Expo on April 23rd, we're doing an event that we call Super Vol Sunday, right? So Super Volatility Sunday, where I'm going through and showing guys exactly how to find all the different confluences that tell me that a trade is going to be a good one. How do I plan the entries and exits, right? And how do we then get in front of these opportunities? And how do we wind up profiting over time from the strategy and this discipline? So what you're going to do in the case of this simple setup is you want to identify the opportunity. You want to go through and confirm the opportunity. Confirm it, I mean, look for confluence, look for things that are lining up. We want to set up conditional orders to put up bracketed trades and then not fool with them. So we want to be able to put trades together and put them together in a way that allows us to just automatically execute and have them go off with our allowed slippage. So what I do is a stop limit order where the stop is the desired entry price, the limit is the maximum amount of slippage that we're looking for, and then the brackets are the profit objective and the stop loss. And once those things are in, we don't touch the trade. So as long as everything is lined up, the discipline says we want confluence. We want to make sure that we're only entering when we're moving in the desired direction. So in the case of the triple Qs, right, I want to know is the instrument net positive or net negative on the day? Is the trend established? Are things moving in that trending direction? And then what I'm doing is I'm waiting for pullbacks to the levels that I want to trade. So I start this. If you look here, you guys should be familiar with this. If you're not, shame on you. You should be pulling up your MetaStock charts and looking at dailies every night to see where are the likely travel ranges going to be. So here I'm looking at a daily chart of the triple Q. This is from, this was the setups for yesterday's trading. And you can see that I go back and I just do a very basic analysis in this case of the order flow. And I'm trying to figure out when price got to a certain level, where did it inflect, right? Just basic support and resistance stuff. And you can see that prior to yesterday's session, we were able to predict with real stunning accuracy where the big inflection was going to be. And this is based solely on what did the price do when it got there before. And I get guys who come to the boot camps and they're like, well, you know, do I need a crystal ball to be able to do what you're doing? Because it seems like, you know, sometimes I feel like they think I should be sitting in a Zoltar booth somewhere, you know, dealing the the cards because I've got some ability they don't have. The reality is they have it, they just don't see it, right? They don't want to look at this thing and say it really is that simple. When you get to a point that was an inflection in the past, excuse me, the most likely thing that you're going to have there is an inflection again. So look back to the left. When price hit that level, that bottom line, what happened before, and then go to the right and say, you know, what happened on the day that we're planning our trade? Well, it did it again. So obviously, you know, today we've got a day where, you know, we're moving lower again and getting down into the range. I can tell you, you know, where I think the market's going forward, but that doesn't really matter. What matters is what's happening right now. So find that support and resistance on the daily chart, then you drill down into the intraday. And you can see here, right, that, you know, one of the things that I look for during the day is volume by price, so sort of the levels that things are happening at. That's while I'm trading live, while I'm actively doing this stuff. But what you see here is just the basics, right? I can guarantee you the volume by price is going to line up with those levels as well. As you go down and you ratchet into each one of these levels, you can see the previous day we had support. Today we have resistance. The previous day we had resistance. Today we have support. And as you go through here, you can identify the levels where you might want to take a trade if price gets there again. So a lot of the morning we spend doing nothing. So as price is moving down, we're waiting for that trend to establish itself, because at the open, you're thinking this market's going up, right? On the triple Qs, what I do is I let it settle in. I let it settle in until about 8:30 Pacific time, so about 11:30 Eastern time, and then I say, where's it been? Where are the footprints? What's the market doing today? And then what I see are these very clearly derived levels of this is where the order flow was. This is where, if price gets there again, if I'm headed down, if price comes up, then what I expect to see happen is I'm going to get an inflection. It's going to drive price lower. If it drives up again, I'm going to get an inflection. It's going to drive it lower. And if you look at the area on the chart that's about 12:15, 12:30 in there somewhere, you see that's where we had the bulk of the trading that we did in the triple Qs over the course of the session. And it's, you know, 1, 2, 3 trades, all for a profit, all for about 60 cents a piece. That's $1.80. You know, do the math on 1,000 shares, $1.80 gives you a really good return for just sitting on your hands. You're using your hands as a seat cushion for most of the morning when you're doing these volatility band trades. But when it gets into the range that defines your expectancy, what are you doing? You're getting in front of the opportunity. So I'll go through. I identify the support and resistance levels. One of the other things that I use when I do this are fib retracements. So I'll go through and, you know, there's a bunch of stuff. So if you're coming to Vegas, if you're already booked for the, I think we're almost booked up for that thing, then, you know, you already know there's layers that I put on top of this thing that handicap it and tell me, right, that right at that level that I just said we're looking to go short from, we've got a fib retracement. So that's an additional level of confidence. I know that a lot of people follow fib zones. A lot of people follow the inflections. A lot of people follow the retracements, the projections, all that stuff. So I know there's a self-fulfilling prophecy that revolves around where those lines are going to wind up on a chart. I know that if those lines happen to overlap with the support and resistance that I've drawn, that tells me that I'm in front of an opportunity that makes sense. If I go through and I plot, you know, say you're using Zenith or yeah, I think MetaStock also has the ability to do it natively, the VWAPs, right? If you're plotting the anchored VWAPs and you're saying, well, where's the volume weighted average price of a leg of a trend? Where's the volume weighted average price of the entire trend? And that winds up overlapping with that same data. You've got that much more confluence. You've got that much more confidence then in the fact that what you think you're seeing is actually what you are seeing and something that you can act on. So, as I said, you know, this is not exciting stuff. This is not, you know, it's not going to get your gamblers excited. It's not going to get your, the guys who are looking for action, the guys who are looking for momentum. They're not going to be super excited about trading these things. But what it does do is put you in front of, 1, 2, 3 opportunities. Usually I tell people third time back to the well is the last time for these things, because go back to the well too many times, you don't know what somebody's done in the well. This is the way that we define the opportunities over the course of the session. And this is the way that we wind up with more winning trades than trades that wind up going against us. So hopefully what you see there is, it's pretty straightforward. If you want to join us in Las Vegas, it's April 23rd. It's live or live stream. We're going to do a live stream version of the event so that everybody can do it from home if they don't feel like going to Vegas. We're also going to be at the Traders Expo in the following days, the 24th through the 26th. We're doing a bunch of sessions they've hired us to do for them. We're doing a mastery class at the Traders Expo. I'm going to be talking about the MetaStock add-on at the expo, and I'm going to be showing you how to use, if you already have that add-on and you're using it in your trading, then I applaud you. If you have it and you're not using it, then you need to give me a call, or you need to send me an email and just say, hey, I would love to put the add-on to work. What is it that you do with this thing, or how is it that you use this thing? Because it's super powerful. Jeff developed that with us almost 20 years ago. And like I said, we still use it today. And the guys who are using it, they really love the mechanics of it, and they love the way that it finds the patterns. All right, so I'm running out of time. I'm going to say that if you want to ask me any questions, I look about like I feel today. But if you want to ask some questions, I've got time here for a couple questions. And then if not, you can also email me, Adrian, Adrian, @traderinsights.com, or you can send me a text message at 310-804-2248. That's usually the best way to reach me. And I'm always happy to get on the phone and talk to somebody about trade. I love trading. It's our passion. It's our life's work. We've been at this a long time, obviously. And as I said, I think the feather in our cap is we're still doing it the way we were doing it. Things here don't change every day. Things here are all about the consistency and the reliability of what we've done. All right. So hopefully, Jeff, I didn't go over, I don't think. But if anybody has some questions, I'd be happy to answer. And like I said, you can always email me if I ran out of time.
Questions? We've got some questions and a couple comments that I thought that were pretty interesting. Vivek says, "Wow, so many books." So there's a comment a little bit earlier about how many books you've released. Brian wants to know, with respect to order flow, do you analyze quotes for selling to bids and buying from the offers?
So with respect to, when we do the order flow analysis, I mean, a lot of, you can see our trading rig behind us here. We're evaluating, we are evaluating the tape. We do scrub the tape to try to figure out, is there an order flow imbalance? Is there more happening on the bid, more happening on the ask? That is much more frequently the case when we're looking at individual stocks than when we're looking at something like the triple Q or the spiders, diamonds, Qs. All that stuff is so liquid that really whether it goes off bid side or ask side isn't going to matter. The bid ask spread is a penny. But when you're looking at individual securities, if we're looking at at Kellogg, or if we're looking at Lowe's, or we've got a couple of things up here today, or national retail properties we had up, we've got Hyatt up. Those things are trading thinner, 200,000, 300,000 shares so far today. There you can go and you can pick the tape apart a little bit and say, how much is happening on the bid side of this thing? What's the spread, right? When it's 2 cents, 3 cents, it's not going to really make a difference in terms of the order flow. You can't do the analysis the way that you did, 20 years ago, because you're not talking eighths and quarters. You're talking pennies. But right around the opening bell, when we see the opening gaps, we do quite a bit of analysis then on what's the bid-ask spread and what's going off on the bid versus what's going off on the ask.
Nicole wants to know, is this Adrian Manz.
This is Adrian Manz.
This
The
is
one and
the
only.
real Adrian Manz, yes. Let's see. Renesh says, can you repeat your number?
Yeah. So if you want to send me a text, it's 310-804-2248. Always send me a text first because I get a lot of spam calls. So I like to make sure I'm actually going to be talking to a human and not a not a real estate salesperson or something. Somebody wants me to sell my house. But send me a text, 310-804-2248, and I'll be happy to get back to you and talk to you about trading.
All right. One more, because we're out of time. But Lon wants to know. Lon actually said, I created an excellent trading system, but procrastinate when it comes to pulling the trigger on YouTube. Do you have any advice for it?
Automate. So automate what you're doing. So when you have a trading system that works for you and you're unable to go and do the executions yourself, the best thing that I've ever found in terms of getting our guys, like I said, we train about 40 people a year, getting them to go and act on the opportunity is really all about set it up before it gets to the price so that you're not making the decision when it gets there, because you're always going to second guess it. You're always going, well, I've sort of seen that, well, what's the market doing here? I've seen this kind of thing before, and it went again, oh God, look at this, now it's going in my favor, and it's I'm not in it. So the best one to talk to about that is actually Julie. Julie focuses very heavily on the trader psychology stuff. So we're both psychologists. I love the psychological component. Julie lives and breathes it. So she talks to our Eric, if you're here, I'm going to pick on you, our sort of problem clients who let their psychology get in front of them and block them from succeeding. And she'll talk to them and just really, really push, automate. If you know what you're supposed to do, then, and that your problem is actually going and doing it when you're sitting in front of the opportunity, it's not that you're procrastinating, it's that you have the feeling that this time is the time it might not work. And that's always going to get inside your head. And once it's in your head, the people ask us about our war room, and how do you set it? I tell them all the time, the war room, right here between your ears. That's the war. You know what you're supposed to do. If you've been doing this for a while, go tell your software to do it for you.
Let's see. Then Lon said, love it, will do. To me, this is the most important webinar of the whole conference. So I'm glad you enjoyed it, Lon. Thank you for the compliment.
Well,
I'm glad Adrian appreciates the fact that you enjoyed it too.
I do. I'm a ham. Right. I enjoy presenting. I wish we were live, all of us together somewhere. I prefer to be in a room with a couple hundred people, and I always go over my allotted time. Everybody's always pissed at me, but I just love talking to you guys about trading. Again, send me a text, send me an email if you have any questions, and I'm happy to answer.
All right. Let's see. Thank you very much, Adrian. Appreciate it. I got the chat in I got the website. I got the address in the chat, and I want to say thank you for coming in and spending some time with us.
Excellent. So happy to see you again. So hopefully I'll see you in person sometime soon, Jeff. We're going to be in Utah. We're going to ski. We're going to Park City. So
we know a really good Thai place if you like Thai food, or Mexican, or actually we know where all the good places are. Stop by the office when you're in town.
That would be wonderful. That'd be great.
All right, very cool. See you soon. Thank you very much.
Thank you. Thanks, guys. Thanks for coming.
Cool. All right, let me go ahead and do this. We'll go ahead and just move this along here. All right, very cool. And as Adrian had mentioned, we are going to do a prize list. Yes, it's time for some prizes in just a second. So it looks like I need to adjust my brightness. The sun's coming in, and I look really, really bright. And I'll do that in a second. Not a big deal. Give me a number, 1 through 12,977. And help me pick the next winner. Very good. Nicole says, oh, the schedule said 12. Can I get the recording? We will send a copy of the recording for all 5 days right after the event. And I also pasted one in there. So there you go. Nicole says, great. Thanks for the presentation. Janice says, thanks, I enjoyed it. And I think that catches us up on comments. So I am waiting for numbers. Nobody's going to get a prize if you don't pick a winner. So, I mean, it's out of my hands. Pick a number. In any case, while you guys are getting a number in, let me go ahead and talk a little bit about his add-on real quick, and we'll move on to the other speaker. 1542, that's a good one. Nicole, you can actually, if you go to metastock.com/traders conference, you can see the schedule for today. I'll put this link in the chat as well. So we started with Kevin. We just did Adrian. Coming up next is Jerry Allison. He does a really good job. Like, I just did my taxes, like literally 2 days ago. Would I have been better if I would have been a business? He's going to help me answer that question. After that, we got Dan Passarelli at 1 p.m., Marco Gomez at 2, and then Calhoun at 3 p.m. So here is the conference schedule. There you go. Oh, here. Okay, lots of numbers too. Okay, good. Thank you for all the numbers. All right, let's kind of just talk real quickly about around the horn. Adrian talked about his patterns and kind of how he uses them. This is a really, really cool add-on, and it identifies all of his patterns: the fastball, the line ball, the backdoor slider, the double hitter, the infield fly, the 3-2 pitch, and the switch hitter. Okay, and with it, you can scan. It'll give you an exploration. You can do scanning. You can find any of the stocks that have actually any of those patterns on there. This add-on is underpriced. It's only $399. It's a one-time cost. Here at the conference, it's $299. And with all the other add-ons, we're going to give you a money-back guarantee. And if you don't have access to our award-winning MetaStock software program, we'll give you a free trial of that as well. So to take advantage of that, give us a call at 800-882-3040. Visit us online at metastock.com/saleschat or metastock.com/conf-promo. So there you go. We're going to draw our prize. But first, I want to say thank you to CMT Association for supporting and sponsoring the events. I've talked about all the time about how well they do and how great of an association it is, how well respected it is, how having a CMT accreditation after your name can help you if you're trading in finance. If you want to find out more about that, cmtassociation.org. You can also give them a call, 646-652-3300. We're moving a little bit quicker because we are a little bit behind. Jerry, I know we're coming right up on you. I don't want you to worry about that. We can run a little bit behind today. It's a bit of a shorter day. Before we get to Jerry, though, we're going to talk about who won a prize. Nicole, 11,921 is the number you gave me. That's the number we're going to go give a prize to. So let me go ahead and do that. Let's see, what was that number again? 11,921. We are rewarding somebody for registering late. So the prize winner is going to be Obaking M from South Africa, and with a Gmail account. So if your name's Obaking, and I know I said that perfectly, you just won a prize. Congratulations! Thanks for registering for the event. If you haven't registered yet, make sure you register. I'll pull the list again for the next couple of prizes, but make sure you register so you can be in the prize pool. What prize did you win? Well, that's a really good question. The prize that I'm going to give you is going to be 1 year access of the Disciplined Traded Mastery Program by Norm Hallett. Norm Hallett came in. He spoke a little bit earlier. He did a really good job about talking about trading and discipline. Discipline is so important when you're trading. You have to respect those entries and those exits. Kelly talked about it too. Congratulations. You won that 497 course. I'm going to put you down on the list, and we'll contact you within the next week or so and tell you how to claim your prize. So there you go. Thank you, everybody, for your participation today. I think this is going great still. And we have another good speaker coming right up here. Jerry Allison is our next speaker. He's going to talk about traders and tax accounting and how it might be beneficial for you to have a tax status. So, Jerry, how are you doing today?
I'm doing fine. How about you, Jeff?
I'm good. I can hear you. Oh, I can see you. Let me go ahead and make you the presenter.
All righty.
And then I'll make sure I can see the screen. I know we are running about 10 minutes late. That's not uncommon.
Okay. Not
Don't
a problem.
stress about it. Don't worry about bringing us back on time. We'll just do what you need to do.
All right. I just clicked on show my screen. Can you guys see the presentation there?
We can see it.
Okay,
And we can hear you. I'll get out of the way. Your turn.
All right. And just to kind of get started here, I was watching part of what Adrian was having to say, and he said you need, one of the points he brought up in a few, have a relationship with your money. You know what's going on with your finances, and taxation is certainly part of that. What you do not want is to be worried about taxes while you're trading. So it's a good idea to have your strategy set up. You need to have everything laid out, particularly this time of year, because we're all thinking about this. And I did put a link in the chat already. This is something that I'm going to mention here in a little bit so that you have that. But you need to have this planned out so you're not worried about it, because people either get to trading and then they have a disaster afterwards, or they get to worried about taxes while they're trading, and then that just messes everything up. So we're going to talk about some strategies today. This is brand new presentation for 2023 because we have we're looking at new things to help traders such as yourselves maximize the tax code for you. And once again, I am Jerry Allison. I'm a CPA with Traders Accounting, and also do these webinars and some consulting as well to help traders along. So before we get going into the presentation, I do want to do a disclaimer to make the lawyers happy. So to the best of our knowledge, the information in this presentation is accurate. Matter of fact, I updated this yesterday just to make sure everything was okay. And so tax changes do happen constantly. So make sure that you, before using this information, you talk to a tax professional. You say, well, Congress hasn't passed anything lately. Well, no, they haven't passed anything lately, but sometimes the IRS commissioner has the ability to change things alone, so that you still want to check on tax laws and make sure that something has changed. The presentation does not establish professional or confidential between you, me, or Traders Accounting. And Traders Accounting is not a law firm, so the information provided here should not be construed as legal advice. That is particularly true if you want to get in-depth legal advice about the LLC information that we are going to be talking about. So having got that out of the way, let me put this contact information here in front of you. I will come back to this at the end of the presentation and leave it on the screen for a little while. Now, I put this link into chat because it is a complicated link. You can click on this and go get a free ebook that talks about a lot of what I'm going to be putting into the presentation here. It goes a little bit more into some other things, but that's certainly free. You can go there, download it to your computer, and certainly read through it. If you want to contact us, the phone number is 800-938-9513, and our email is learn@tradersaccounting.com. So let's go ahead and start here. Let's talk about some basic information. And I've got here on my slide Business 101. You're thinking, well, I'm trading, I'm not doing a business. Well, and really you are. If you're trying to make money and you have some expenses, you already have a business whether you want to realize it or not. And so if you're serious about this, then you've got to treat trading like a business. And this is where a mindset comes into to play. We have to change certain people's mindsets in certain cases. So one thing, you've got to be concerned about your cash flow. You guys go through these trading education areas. You've got charts, you've got all the stuff, and you are concerned about getting cash in. A lot of people ignore the cash going out. That becomes a very big problem because you can earn $5 million a year, but if you're spending $5 million, you just lost money. So you have to be concerned about the cash going out of your business as well as coming into your business. So you have to be concerned about that, and part of that is what we're going to talk about today. Also, do not make financial decisions based on your business needs, not the tax code. I referred to this a little bit ago when I mentioned Adrian's point. When you get trading and you start trading based on the tax code, you're going to mess yourself over. Another thing that people want to do is at the end of the year, December, I see it a lot. They say, oh, I've made all this money. Now I need to go out and buy some asset, something that I can depreciate to reduce my taxes. That is a horrible move to make. I'll tell you a story. Years ago, I did some accounting for an auto mechanic, and he had a very successful business. He was doing really well, and he had a great year. And we came to the end of the year, and he said, I want to buy this $20,000 tire machine. I said, okay, why? He said, well, I need the tax write-off. I thought, okay. So you're going to spend $20,000 to get $6,000 back from the IRS. Okay. And then I asked him, I said, are you going to use this thing? Well, maybe once or twice a year. And the more I got into it, he was buying this thing, this tire machine, for just the tax write-off. So he's going to spend $20,000 to get $6,000. So he lost was going to lose $14,000. It's never a good idea to make business decisions based upon the tax code. You need to set up a strategy for your taxes, minimize your taxes, but don't go around just making automatic and instant decisions to save on taxes. It's not going to work. Now, I want you to be aware of all your tax and protection options, and we're going to get into this in this presentation. It's going to be brief. I hope, matter of fact, I know Jeff is getting this filmed. You'll need to probably go back and look at this if you're not familiar with this information already, because this is cram-packed today. So we want to make sure that you have an opportunity to go back and review this, because I'm not going to be able to linger on it. We will probably have time for a few questions, but this is a jam-packed presentation. And what we're going to get into is, first of all, is trader tax status. This is something that the IRS allows for every trader. Doesn't matter if you're doing stocks or options, or if you're doing Forex, or you're doing futures, or you're doing cryptocurrency. Doesn't matter. You can utilize trader tax status if you meet the qualifications. Then we're going to talk about entities. You probably read a lot about setting up entities. When does an entity make sense for you? When does it not make sense for you? So we'll talk about that in depth and the type of entities there are out there. And then for stocks and options traders, we're going to talk about the mark-to-market. This is the time of year where things get really interesting, because traders are doing their taxes, and those who haven't made the mark-to-market election are finding out how nasty wash sales are. And wash sales are deferred losses. And basically, the IRS has set up a system where if you lose money, let's say in 2022, that loss gets deferred to 2023, and you have to pay the taxes for 2022. You probably read horror stories about people who actually lost money in their account, but due to wash sales ended up paying taxes for that year. The cure for that is the mark-to-market election. So let's go ahead and get into the meat of this thing. Let's talk about trader tax status. Now, trader tax status is a choice. You get to choose this, and it can allow any entity, including an individual, so you can do this on an individual level, you can do it on an entity level, to deduct trading expenses provided the criteria are met. So this is a way to get money back from the revenue agencies, state and federal, so that you can deduct your trading expenses. So you were talking about margin expense. We're talking about data feeds. We're talking about education. We're talking about seminars. We're talking about all this stuff that you do for trading. You can deduct it if you meet the criteria. And then, of course, you get the refund back from the IRS for it and the revenue departments. Now, one of the problems with trader tax status, and I'll tell you right up front, the key publication from the IRS is Publication 550. Publication 550 talks about all kinds of trading. I mean, it goes into bonds, OIDs, interest, dividends, futures, everything is right there. It's a big document, but you can go to the IRS website and you can download this thing in a PDF format, or you can just read it on screen if you'd like. But the Publication 550 talks about how if you're going to deduct expenses, then you have to treat your trading like a business. We go back to that business aspect again. And really the criteria is the IRS wants you treating it like a full-time business, but they never define how. It's very gray and very nebulous. So we have to go to court cases. And here's the court cases that have provided some guidelines on what we know will qualify for trader tax status. First of all, there need to be 700 trades per year. So if you qualify, if you're making over 700 trades in a year, you meet the first qualifications. And for a lot of people, that's nothing. Some people who aren't trading as actively, that could be rather problematic. But 700 trades in a year is very important. There's also, you have to be trading in over 75% of the trading days per year. So let's say there's over 200 trading days for the year. You need to be trading probably close to 180, 190 days of those years. I don't know exactly how many trading days there are in a year. And so these two things actually are very important that you make sure. The idea, again, is that you are heavily invested in this business. And that concept keeps coming back to mind. So both of these can be proven by giving the IRS your trading statements, your monthly statements, your 1099 that comes at the end of the year from your brokerage, and say, here to it, here's what I've got. And so they can dig through and decide certainly whether you've got over 700 trades, and they can decide if there's more than 75% of the trading days per year. The third one, and the last one that I'm going to bring up, is there have to be over 500 hours in trading, research, and education. So there's a lot of things here. Certainly the time you're spending here today qualifies as part of that 500 hours. And since this was a week-long session, that's a lot of time there. Now, the way to prove this, you cannot use your trading documents, because your trading documents, your statements and that, don't list how much time you're doing in research. They don't list how much time you've got spending in education. So it's useful to keep a log to prove to the IRS that you do meet those requirements, that you're getting those 500 hours. I realize it's a pain in the neck, but it is something that if they ever did come back in and they said that, well, you're not trading 500 hours a year, then that could be rather problematic. Remember, we're trying to prove that we're treating this like a business. And that's really where publication 550 goes. Now, let me emphasize here. These three criteria, we know if you're over those, you don't have a problem with trader tax status, because the court has said, the tax court has shown that these qualify. If you're under these things, we don't know. And if you're willing to take it to court, if the IRS ever came and audited you on this, by all means, we can maybe set up a new court case and have some new criteria. But you're going to have to go to court to do it, and that gets rather expensive. So, having said that, the tax savings of trader tax status depends upon your current tax bracket. So if you're in the 35% tax bracket, for every dollar you deduct, you're going to save 35 cents. If you're in the 24% tax bracket, every dollar you put on your tax return, you're going to save 24 cents. So that gives you an idea, but it depends upon your tax bracket. So that's trader tax status. As I mentioned, this is a choice. This is not something that you have to file with the IRS. You can still do it for 2022 if you haven't filed your tax return. As long as you meet these criteria, you can go back and you can deduct expenses on your tax return for trading. And so that may help some people be able to recover some of the money from last year. Okay, however, there is a warning here. And of course, anytime you talk about the IRS, there's always traps. And there's a huge trap here in using trader tax status. And first thing, a person, we're not talking about an entity now, we're talking about a person, an individual, deducting trading expenses on their personal tax return must use the Schedule C. Now, the Schedule C is a special form, not just for traders, but it's for a small business tax return. So if you have, let's say, a small restaurant, or if you have a tire rotation business, or you have something else, any other business, you would use this if you were just a sole proprietor, a single owner of the business. And so you have the Schedule C, but the problem is putting the Schedule C on your tax return. So this happens as an individual. Here's some of the following issues. One, your audit risk is increased. The IRS, for whatever reason, well, I know, because Schedule Cs have been abused for years. people have tried to deduct everything they can on a Schedule C. And so tried to use that to get back all their taxes, whatever they've paid in, stuff like that. So the IRS naturally just pokes its head up anytime they see a Schedule C. Now, that doesn't mean you're guaranteed to get audited, but it's like if you're in Vegas rolling craps, you're going to get snake eyes eventually. So your audit risk does necessarily get increased. Number two, there is no home office deduction if you take trader tax status on your personal return. Now, I know you read, well, if you do a Schedule C, you can take a home office deduction, but there's a little glitch here. See, the home office deduction is actually a separate form to the Schedule C. And part of that calculation of those home office deductions asks, did you have a profit on the Schedule C? Traders never have a profit on their Schedule C because they're only listing expenses there. Because the income for trading business goes on Schedule D. So now you've got a Schedule C for traders with all the expenses, no income on Schedule C. And so you always have a net loss. So there's no home office deduction. Now you'll find out on the internet, well, you just reclassify some of that income from Schedule D to Schedule C. Don't try that. The IRS doesn't like it when you start reclassifying income. It's like saying, I got a W-2, but I don't want to put it in the W-2 slot. I'm going to put it down where it's more tax advantageous to me. They're going to come back and change that. So for all intents and purposes, for a trader who's an individual deducting expenses, you cannot use the home office deduction. Three, there may not be any asset protection. As an individual, if you're trading and you get sued, let's say you get into an accident and your insurance doesn't cover everything, or if somebody gets on your property and has an accident, whatever, the idea you get sued for something, if you don't have a trust already set up or your assets aren't in an LLC or something like that, then when somebody sues you, your trading assets are now exposed. So now you've got exposure there and you don't have all this stuff protected. And most people, most of their livelihoods, most of their net wealth is in their trading assets. Number four, this is a conflict that has been created with by the IRS. When somebody has a W-2 job and they're claiming to be a full-time trader on their tax return, the IRS has a problem with that for whatever reason. They don't think you can have two full-time jobs, at least not trading as another full-time job. Remember, we're trying to treat this as a separate business. So you have this W-2 job and you have your own business. The IRS doesn't like that. And so they can come in and they say, well, you got a problem here, and they will question it. So there's issues there. So these four things actually create issues if you're going to do this personally. So what's the remedy for that? Well, that's where entities come into play. Excuse me. Entities can get around some of this stuff, and I'm going to talk about some of this, but there's several different types of entities that you can create. A sole proprietorship, that's actually just the Schedule C we were talking about a little bit ago. That's where you're saying your trading is a business and you're going to deduct expenses on Schedule C. Single member LLC, that is forming an LLC in your state. You are the only owner. Problem with that is that's a Schedule C on your tax return again. It doesn't really solve anything for traders. Then we have a general partnership, a limited partnership, multi-member LLC, S corporation, an LLC S corporation, a C corporation, and an LLC C corporation. We are going to limit it really to the LLC stuff. And the reason for that is the LLC gives you asset protection. So you've got that the LLC can help you. And as I've mentioned, the sole proprietorship, the single member LLC do not do much for a trader at all. Matter of fact, they allow you to deduct your expenses, but they increase your audit. So we generally don't recommend that. We do have clients that do it, and that's fine. That's a choice they want to make. It's not a choice necessarily that I would like to make myself. The type of entity that's right for you depends upon your situations. Now, we generally lean towards the LLCs. because what's nice about LLCs, we'll talk about that in a little bit. There's a lot of flexibility with LLCs, a tremendous amount. So we lean towards the multi-member LLC or an LLC S Corp or even an LLC C Corp. Excuse me again. We don't recommend the others because the partnership and the limited partnership don't really have much asset protection there. There are issues that can happen legally that can come in and really destroy the partnership. C Corps are really difficult to work with and difficult to get money out of. But there may be situations where you need an LLC C Corp or an LLC S Corp or something like that. Now, what we recommend generally is a multi-member LLC. Now, that starts off as a partnership. And it's the simplest form there is. It does several things. It gets it off your tax return and a bunch of other things. Now, I'm going to go through those pros here in a minute. But I want to be honest with you and tell you there's some cons as well. First of all, there is a yearly LLC fee with your state generally. There are a few states that don't have a yearly fee anymore. Arizona and I think Minnesota is one. Once you set it up, you pay to set up, there is no more yearly fee. You just have to file the report every year, which is actually very nice. So that gets rid of that. Tax prep fee. It is a separate tax return to get that off your personal return and reduce the audit risk. So you may be talking $600 to $1,000 there to actually prepare that. Doesn't matter whether it's a partnership return, an S Corp return, or a C Corp. But the idea is to get it off your personal tax return so you can reduce the IRS scrutiny. Now, there's some good news coming up about that here in a little bit. And you have to set up a business trading account. You cannot just convert your personal account into a business account, and you can't trade under your own social security number and have it count for the LLC. That won't work. You've got to have a new account with the EIN from the IRS for the business. So you do have increased broker's fees. There's a couple ways to get around some of that too, but we can talk about that at another time. Now, the pros. By my opinion, the pros far outweigh the cons of a multi-member LLC. First of all, you get the asset protection. Once you put your assets, your trading stuff into an LLC, nothing outside or very difficult for anything outside to influence it. So you experience a lawsuit, or maybe you have another business or something and get sued. Generally speaking, they cannot come in to this LLC and touch the trading assets at all. Second of all, this is a nice one that a lot of people don't realize. When you form an LLC, and this includes the single member LLC, you have a choice in taxation methods. Now, if you form a single member LLC, that defaults to a Schedule C on your personal tax return. If you form a multi-member LLC, that defaults to a partnership tax return. However, you can choose within 75 days of creating it to be taxed as an S corporation or a C corporation. So you can when you want to be, and that's why LLCs have a lot of flexibility. And not only, this isn't a one-time choice. You can choose later on, and it's got to be done at the beginning of a year, but let's say you choose to be taxed as a partnership. You got a multi-member LLC, you want to be taxed as a partnership. Next year you say, hey, I want to be taxed like an S corporation. We file the election. And now you're going to be taxed with the IRS as an S corporation. And then next year, conceivably, you can say, I don't like that. I want to be taxed as a C corporation. We could file that too. And if you want to go backwards, say, I'm done with those. I want to go back to a multi-member LLC. We can revoke those elections and go back to being a partnership. That's the beauty of LLCs, is that you have a choice in how it's going to be taxed and you can change it. So if tax laws start to change, you've got some flexibility there on choosing the best possible way of doing things. Number three, I've already mentioned this. By forming a multi-member LLC, really S Corp or C Corp, by getting it off your personal return, you reduce the IRS scrutiny. For whatever reason, the IRS, when you get this stuff off into that individual or separate tax return, the IRS doesn't seem to care as much. But that personal tax return, they have issues with, and they scrutinize. That's probably because people have tried to do all kinds of wacky stuff over the last decades, several decades. So anyway, so you reduce your IRS scrutiny. Number 3, remember I mentioned if you deduct your expenses on a Schedule C, for all intents and purposes, you can't utilize the home office deduction. That deduction opens up if you form a multi-member LLC or you have an S Corp or a C Corp. Now, this is actually somewhat important. You say, well, I don't have a lot of deductions. Well, what we do is we take the percentage of your office in your house and divide it by the percentage of the square footage of your apartment or house. That gives us a percentage. And then we can write off a percentage of mortgage interest, real estate taxes, rent, insurance, utilities, HOA dues, repairs and maintenance, just about anything that goes into your living house or apartment, we can take a percentage of it and deduct it. And for a lot of people, that can be $1,200, $1,500 a year. And you say, well, that's not much, I guess. Well, it depends on the tax bracket you're in, but hang on to that number. Let's say about $1,200 to $1,500 a year. I've seen it a lot higher than that too. But under most people they can get around $1,200 to $1,500 extra bucks to deduct just from their home. Hang on to the home office deduction. I'm coming back to it. Number 5, setting up this multi-member LLC solves the W-2 trading issue. Remember I mentioned a little bit ago how the IRS doesn't like you having a W-2, a full-time job, and having a full-time trading company, if you will, or business. This solves that problem. By getting your trading off into an LLC, you can still have your W-2 on your business or your personal return. And then it looks like you've got this other business over here that you're investing in and that you're running. IRS doesn't have a problem with that. Now, number 6, and this jumps ahead a little bit, but it solves the mark-to-market long-term, short-term dilemma. Let me explain that to you. For stock and options traders, you can make the mark-to-market election. However, mark-to-market doesn't work well with long-term holdings. And so if you make the mark-to-market election for your personal side, and you've got long-term holdings, there's always a possibility the IRS is going to come in and try to put your long-term stuff under mark-to-market, which means you're going to pay tax on the unrealized gains in those long-term holdings. We don't want that. So by doing this as an entity, we move all the short-term stuff over into the LLC, and you do your short-term stuff there under the mark-to-market election. You keep your long-term stuff on the personal side, and that gets the two of them separated, and the IRS won't question it. Now, number 7 is a very interesting one that I've come up with, is the tax savings can pay for the LLC, the multi-member LLC. Now, remember, we're not talking about single member, because that really doesn't work unless you elect to be taxed as a S corporation. I'll get back to that in a little bit. Now, how can I get the refunds, or how can I get the government to pay for my LLC? Well, here's how. If you already have yearly trading expenses, the refund you get from deducting those expenses could pay for the yearly LLC fee and the tax prep fee. Now, in most states, you have a yearly fee of usually about $100 to $200 a year that you have to pay to keep the LLC licensing. And the tax prep fee could be, let's just use a ballpark number, $800 right now. So, that's $1,000. You can get enough in refunds back by deducting your trading expenses to cover those additional fees. Now, let me give you an example, because people always do better. There's some numbers here, so stick with me for a minute. Assume a person lives in Indiana. The yearly LLC for renewing that LLC is $50 per year. And let's assume the tax preparation fee is $700 per year. So a total of $750. So this person that's forms an LLC in Indiana now has an additional $750 in the state of Indiana that they have to pay. So I said, it's kind of one of the cons of setting up an LLC. Well, let's assume the person is in the 32% tax bracket, and Indiana has a flat tax of 3.23%. So let's assume a total of 35.23%. Now, remember what we're trying to do. We're trying to find expenses that we can pay for the LLC. And I want to pay for that $750, but I want the government to pay for it. So here's the conclusion, and then I'll prove it to you. This person needs about $1,279 in trading expenses to get the government to pay for the LLC. You say, wait a second here, that's a lot of money. Remember I was talking a couple minutes ago about with a multi-member LLC, you get the home office deduction to open up for you. That's a new deduction that you can't take on the individual side. That's usually between $1,200 and $1,500. That home office deduction in a lot of cases can pay for your LLC. And so that covers the tax prep, it covers the LLC fee each year. Let me show you how it works. Here's my proof. First of all, let's go back to our basics. The trader has $750 in additional LLC expenses. $700 for the tax return, $50 for the LLC fee every year. And they got a tax rate of 35.23%. That's state and federal combined. Now, here's the calculation. Let's take our total deductible expenses. Now, the tax prep fee and the LLC fee are also deductible, so they're going to be deductible. The additional $1,379, let's just say that is home office deduction. It could be anything, but home office deduction. That gives you $2,129 in expense deductions on your tax return. What does that mean? Well, this person, remember, is in the 35.23% tax bracket. And so if you take 35.23% of the $2,129 that your tax savings, that gives you a refund of $750, which is the extra costs for your LLC. So we just figured out a way to get the government to pay for our LLC. And most of that is done by, well, that could be done entirely by home office deduction. So the LLC, the multi-member LLC, can pay for itself. It is a great way to go. Now, some of you may be wondering about S corporations. Well, I'd like an S corporation. Let me briefly tell you about S corporations. Because some people like to say, well, I'll form a single member LLC and I'll let's go elect S corporation. With an S corporation, you have to pay yourself a reasonable salary, which means W-2 stuff. You've got to have a payroll company. You now need to pay FICA. You need to have other withholding. You need to have state and federal unemployment, and you have to file quarterly reports as well as year-end reports, including creating the W-2. There are expenses there. Now, I'm not saying there are not reasons to go to the S corporation. There are, but I suggest strongly that you go to a multi-member LLC first because it's the simplest form so that you can establish your trading pattern. Once you get a trading pattern established and you know it's going to provide income to you, then we can talk about moving to one of the other forms. Again, we have that flexibility with the LLC. Now, so we've talked about trader tax status and expensing things that we pay for the trading. We've talked about LLCs, and again, the type of entity that's good for you. We need to discuss that because that is something that may not work for you. It may be a C corp. It may be going straight to an S corp, something like that. But you need to have a discussion about that with a tax professional to figure out which entity is best for you. Now let's go to mark-to-market election. This is a money-saving election for stock and options traders only. It does not work for futures. It won't work for FOREX. There's a possibility you might get a benefit for cryptocurrency, but for anything else, you can't do this. Talk about stocks and options right now. Any business entity, including individuals, can make the election provided the trader tax status requirements are met. Now, as an individual, you have to meet those trader tax status requirements that we talked about first. So you got to be able to deduct expenses before you can make the mark-to-market election. very important. As far as an entity goes, an off return, like a partnership return or S corporation or C corporation, it doesn't seem the TTS requirements are as stringent. The IRS doesn't seem, in my opinion, this is my opinion right here, the IRS doesn't seem to care about those with an entity so much. So you probably should stick close to them because we don't have any court cases dealing with entities. And so this is something that you can use your judgment about. But if you do form an entity, you can make the mark-to-market election as soon as you form the entity. For individuals and for existing entities, you have to make it within the first, for individuals, it's got to be before April 15th of the year you want to start. And for pass-through entities, it's got to be by March 15th of the year you want to start. All right, now what does it do? I've got to go ahead of myself, but this election eliminates wash sale losses. In other words, you're going to pay taxes on what you earn. You probably have read the horror stories out there of people who lost money in an account. And so let's say 2022, and some of you may be experiencing this. You lost money in 2022, but because of the wash sales, some of those losses get deferred to 2023, and now you're having to pay taxes on stuff on an account that you actually lost money in. Mark-to-market gets rid of that. You pay tax on actually what you did. Now, mark-to-market looks at your account, and it takes the value of your account at the beginning of the year and your value of your account at the end of the year, and you subtract them. In the simpler way, it's basically if your account went up, that's what you pay tax on. If your account went down, you write that off. Now, you have to adjust for money you put into the account and money you take out of the account, things like that. There have to be some adjustments there. But the concept is simple. You're going to pay tax on what you actually earned, period. There's none of this loss deferral or anything like that. Also, this election eliminates the $3,000 loss limitation. Under normal cash accounting, if you lose money, if you have a capital loss in a trading account, then you can write off a maximum of $3,000. And this is a net loss, so you add everything together, all your gains and losses. So for example, if I lost $20,000 last year as a capital loss, I could only write off $3,000 of it, and I got to carry the remaining $20,000 or maybe $17,000 forward to use another $3,000 the next year or use it against capital gains. With mark-to-market, pull $20,000 off, period. So that's a huge advantage. I've seen people write off $200,000 in a year, and then whatever they don't use, it gets carried forward to the next year. That can go against their W-2 wages, 1099-Rs, anything else you have sitting on the tax return. So mark-to-market is actually very beneficial, tax-wise, very beneficial for stock and options traders. Almost always it will save you money, and definitely in the long run, it will save you money. So here's the key, though. This election must be made at the beginning of the year. So as an individual, I mentioned this earlier, you've got to do this by April 15th. If you have an existing entity like a partnership or an S corporation or some other entity, you have to do it by March 15th. However, there's an exception. New entities, if you create a new entity, then that entity can create the mark-to-market election immediately. And in fact, you could choose that, tell your broker. The actual paperwork doesn't have to be filed with the IRS until you file your first tax return or the extension, whichever comes first. But you can do that. And how is that helpful? Well, I just talked to somebody about an hour or so ago, hour and a half ago, and he is having a lot of losses in his account, but he's going to be making money. His strategy is turning around, and right now he wants to be able to take and get rid of the wash sales. He's really concerned about wash sales. So I said, okay, start an entity, start a multi-member LLC, and let's say by the end of February, could be, or in March, whatever, we start this entity, and at that point we elect mark-to-market. So we move everything over under the business trading account, and then we can elect mark to market. So everything you do then at that point is under mark to market. And then your personal account, which is now had all the cash sucked out of it, it's gone into the LLC, your personal account is going to sit dormant. And then for the next 30 days, you don't do anything. Those wash sales that you've accumulated this year become regular losses. And so that is a strategy to get rid of those wash sale losses and never have them again. You may be wondering, well, what about if I make the election, or what if I about to create an entity later in the year? Let's say September. If you create the entity in September, then you can do mark to market for the entity in September and start trading at that point. It begins when you start with the entity and you get everything moved over to the entity. So really there's no time frame starting an entity, although I would recommend it to be done as soon as possible, because it's very important to save the taxes on there and get those deductions. Now, let's kind of wrap this up a little bit before we get in to start taking questions and things like that. We covered trader tax status. Trader tax status allows you to deduct trading expenses if you qualify. Now, remember your qualifications. You've got to have at least 700 trades a year. You've got to be trading at least 75% of the trading days per year. And you need to spend about at least 500 hours each year doing trading, research, and education. Second of all, forming particularly a multi-member LLC provides asset protection, decreased audit scrutiny. It could be free, and it also gives you some flexibility as to taxation methods in the future. That may be a huge benefit coming down the road. We don't know, depending on how they change tax laws. And then finally, the mark-to-market election allows stocks and options traders to pay tax on what was really earned or write off entirely what was lost. That can get you, it almost always results, if you have a gain, a lower gain than what's showing on your 1099-B. And so you pay less taxes if you have a gain. And if you have a loss, the loss is usually bigger, and you get to write it off now and get your refund back from the IRS now. So you can take that money and plug it back into trading or whatever you need to do at the moment. All right. Contact information. I put this up earlier. That link to our website is already in the chat. Excuse me. You can click on that, get that free ebook. If you want to make an appointment with us, our phone number is 800-938-9513. Let me tell you a little bit. Excuse me, I'm taking a drink of water here real quick. Let me tell you a little bit about what we do. First of all, we can set up the entity for you. We have agents in every state of the United States, and we can set those entities up for you. We also have a bookkeeping service that can keep track of what happens monthly. It can create a financial statement where you can see what you gained and lost during the month, as well as the expenses compared to the expenses. We also have a tax service where we prepare the tax returns for individuals as well as for the entities themselves. Matter of fact, we're hot and heavy in that right now, and that's what I'd be doing right now if I weren't here. So we can do all those tax returns, and we also do consulting. If you say, well, I just want to do my own tax return, but I need some answers, you can pay for some time to sit down and have consulting service, and we'll be happy to sit down and talk to you and answer your questions regarding taxation. So that is what we've got right now. What I'm going to do is I'm going to open this back up to any questions that the audience might have, and I'm going to take this off the screen, and I think Jeff's going to come back in and maybe help me out with questions.
Yeah, I'm ready. We have tons of questions. So I think first of all, we'll give the email address. If we don't get to your question, I'm sorry, we just have a lot of people here, but learn@tradersaccounting.com. Lots of really good questions. The first thing I wanted to say, though, is Lon M out of YouTube said, wow, never thought about this before. This stuff is really important.
It's far more important than people realize. And unfortunately, after working with traders for the last several years, people get into trading almost by accident sometimes. Matter of fact, the last guy I talked to consulting, He said, it was just, I started trading and it was something, and then I got into it and started doing it. And now it's gotten to be this big monstrosity. And so it's something that you really have to take time before it gets out of hand to think about. One of the issues that I really have that has hit me personally, those of you who remember back in back in 2021, everybody remember the AMC and GameStop stuff. People made a fortune in December of 2021. And as a consequence, the 1099s were prepared and they owed tons of money. But the problem, those people kept gambling with it in January and lost everything. So now they had this huge tax bill, but they had nothing to pay it with. And so that goes to show that they never sat down and really thought about the tax consequences. And that is something you have to get set in stone. Not that you're thinking about it trading. You want to get this stuff set so you don't have to think about it while you're trading. So yeah, this is a great thing that I would sit down, take a weekend where you're not thinking about trading and concentrate on setting up a tax strategy.
Penny wanted to know, also out of YouTube, does the MMLLC still require the partners to meet a minimum number of annual trading and research time requirements?
That is it's a gray area. There are some people that will tell you yes, because we don't know what would happen when the IRS came in. And the reason it's a gray area is because there's no IRS guidance and there are no tax court cases at all. So some people who are risk averse would say, yeah, the LLC would have to meet those. There are other people who say, and I'm kind of leaning towards that you don't have to meet those quite as much because the entities have expenses. I mean, it doesn't matter what business you have, you're going to have expenses. And so you're going to write those off. So the TTS requirements are not as stringent, I don't think, as what they are for individuals.
All right. Greg wants to know what constitutes trading expenses for deduction purposes, meaning what are the real expenses you can deduct to make it worthwhile?
Okay.
That's a good question.
Yeah, short answer is anything that helps you trade or helps you trade better is going to be deductible. Now, let me give you a longer version of that. If you go to an education class or you go take a seminar like you're right now, these fees are deductible. Let's say you go to Las Vegas and you attend one of the conferences there on trading. Your fee to get in is going to be deductible. Your travel expenses there, your hotel, meals, all of that's going to be deductible. Now, we'll caution you, the IRS is funny about travel, and you need to make sure you keep a log about what you're doing, just to make sure you can prove it was business related. You don't want to go to Las Vegas for a 3-day conference and spend 2 weeks there. That will raise all kinds of questions. Your computer is going to be deductible, your office furniture, data feeds, if you have subscriptions to software, all of that stuff is going to be deductible. If you buy books or if you buy magazines, if you belong to chat rooms where there's a cost to get in, that's going to be deductible. So anything, if it's related to trading, you can deduct it. Don't try to write off a car or an airplane. It's just not going to work very well.
Okay, cool. Kenneth asks, do I need to meet all 3 criteria or just one of the 3 to qualify for TTS?
Good question. You really need to meet all 3 of them if you're going to do it personally, particularly. All 3 of those have come out of court cases. I think a couple of them actually came out of the same court case. So it'd be good to make sure you meet all 3.
Earl on YouTube wants to know, what is the minimum account size you need to do mark to market? Good question, Earl.
Actually, there is nothing in the court cases or the IRS code that specifies you have to have a minimum. But I mean, if you're going to be making 700 trades a year, you probably need a fair amount of money in there in order to make that happen, or else you're going to kill yourself with the broker fees. So I haven't seen anything. I know there's stuff running around on the internet that you got to have $20,000, $25,000 in there, but I haven't encountered anything as far as a minimum.
All right, this is probably the last question we have time for, and we're going to do a three-fer. I'm going to combine 3 questions into one mega question.
Okay.
This is from James, Bob, and Ravi. They all have questions about MMLLC. How many members are needed? Do I need a partner? Does my wife qualify?
Great questions. Okay, yeah, I'm glad you put all that in one question because they do relate. Multi-member LLC, you do need a second partner. You cannot do it by yourself. Wife does qualify. We have a lot of husband-wife teams. Or if you're a female, then your husband would qualify because we have wives that are traders as well. So that would work. The second entity or the second part doesn't have to be a human being. Now, if you want it to be, you could have a relative that will take 1% and you own 99% of it. That's some people do that. The second partner could also be a trust. Some people like to set up a family trust, or it doesn't have to be family, but you have this trust that's where some other person is the beneficiary of the trust if something happens to you. And so that trust gets 1% of the income, and it's all on paper. It doesn't have to be moved into there until you pass away, and you still get 99% of it. So now you've got yourself and the trust as partners. If you already have another business, like another LLC or an S Corp or a C Corp, they could be a partner in the multi-member LLC. So there's a lot of different ways of doing it. And you say, well, I'm a single person and I don't have any of those things. We have figured out how to get it to work for single member, for individuals, that we'll figure out a way to create that second member so that you still have the multi-member LLC.
I lied. I found another question that I wanted to ask.
Okay, that's fine.
Dave D wants to know, the self-study, reading, attending great online workshops like the one I'm at, I might have added that part, count toward the education requirement?
Yes, they do. And I would definitely put that into a log. And I've talked to people about watching YouTubes on video. Certainly this one, if you're reading a book or a magazine, keep track of that time just so that you have a record of it, and that would qualify.
All right. That's it in terms of what we have time for. There are a few questions that we missed. I'm sorry about that, but reach out to Learn at Traders Accounting. Give them a call. We've been working with Traders Accounting for a long time now, and they do such a good job. And it is always eye-opening to kind of come in and go, okay, well, wow, I didn't know that. And thank you for that comment, Lon, out of YouTube. I did the same thing. That I was like, wow, I hadn't even thought about all the stuff that's involved around this, and kind of, yeah. Thanks for coming in, Jerry.
Very important. You're very welcome, and I hope everybody has a great day. Thanks for having me.
All right, absolutely. Okay.
All right, take care.
Bye.
Bye.
Okay. Great session. Appreciate everybody. Oh yeah, okay. I'll repost the info. Just give me just a second here, Tom, and I'll repost it for you. Let me do this real quick. Okay, so I do want to say thank you to Stocks and Commodities Magazine for sponsoring the festivities today. I also do want to ask you guys for a favor. Would you give me a number between 1 and 12,977? We're going to do another prize drawing in just a second here. If you give me a number, you can help me pick the winner. So let's do it. Thank you, Stocks and Commodities. Great sponsors, been doing it for a long time. We appreciate all the work that they do. I do also want to kind of highlight an offer that we did just a couple of days ago with Go No Go Complete. This was on Monday. They basically came in and talked about the trend, the oscillator, the icons, the squeeze. A fantastic add-on and very, very beautiful. Features English explanations of trend states on every 10 states on every bar. It was a great presentation. And it has been a very, very popular MetaStock add-on. Here at the conference, normally the normal cost on it is $14.95. Here at the conference, it's going to be $9.97. We do include a bootcamp training to help you get started, a 30-day money-back guarantee, and it's just one of the many cool products that are available to you right now at metastock.com/conf promo or metastock.com/sales chat or 800-882-3045. 40. So there you go. Okay. And let's see. Of course, we're MetaStock. There's the information. Let's go ahead and do the prize drawing. Raj in GoToWebinar gets the number of 8888. And I'm going to do something just a little bit different. You know, we love audience participation. It really helps when you're typing in answers and participating. And so, Raj, instead of using the number 8888, I'm going to make you the winner of the next prize. So I appreciate your guessing and picking a number. Everybody that picked a number, we're going to have you be the winner this time, Raj. Congratulations. What did you win? Let's find out. Let me go to the list of prizes here, and we'll pick a good one for you. So let's see. Okay, this is a good one. We're going to give you the Alpha Brain course by Alla Plucker. Alla came in. She does a lot of work with Fibonacci's. She was in here a little bit earlier this week, and we kind of talked to her. She's going to give you how to optimize the trader's brain with 15 recorded classes on video. And that's a value of $3,000. We'll reach out to you, Raj, in terms of how to get that prize. But thank you for guessing a number, and I bet you didn't think you'd win, but you did just because you gave us a number. So there you go. Let's go ahead and get moving on with our next presenter, Dan Passarelli. Dan has been a frequent guest at MetaStock events. He's been here many, many times. I wonder if he's going to share his green room with us or not. I really like the coloring of this green room, but we love having Dan in. He always talks. He always does a really, really good job, and you're going to be impressed. So Dan, let's go ahead and bring you on here. How you doing?
Hey, I am doing super great. How are you, Jeff? Haven't talked to you in a month, couple weeks anyway.
Right, yeah. I'm doing really well. Been a little bit busy this week. But I will tell you, the conference is going great. We're very happy with everything. Everybody's been on point. It's been great. So there you go. How are you doing? More importantly, how are you?
Hey, I am not too bad. Can't complain. Can't complain. Just, you know, trade the markets and living the dream over here, my friend. Living the dream.
All right. Well, I can see you, and I can hear you, and I can see your screen. So, dude, I'm going to get out of the way. It's your turn.
All right. Hi, folks. How you feeling today? I am really excited to share with you this new trading system that I developed. Before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading, and you can get a copy of that by emailing investorservices@theocc.com. Now, I'm just going to jump right in here. Think of your usual trade size. Maybe it's a 5 lot, maybe it's a 50 lot, maybe just a 1 lot or a 2 lot. If you knew that a trade was going to be a winner, would you, just trade your normal trade size? Or would you trade bigger? What do you say? Bigger, of course, right? The more confidence you have, the bigger you can trade, and that's how you make money. Now look here at the screen. On February 1st, 400 put credit spreads traded in Microsoft. 2 days later, at expiration, the person who made that trade could have locked in a $25,200 winner. Now, that's a nice day. It's a big trade. It's a lot of confidence in this trade. Who is making these sorts of trades? It's Wall Street traders, the professionals, the guys who people are always saying are taking their money. These are the people we love to hate. The professional traders that trade for the big institutions. Institutions like Goldman Sachs, who made $21.64 billion in 2021. How is that remotely possible? $21 billion. These institutional traders are the same people who, made billions leading up to the 2008 financial crisis that left a lot of people out of work and at risk of losing their homes. And in fact, a lot of people did lose their homes. When you are in Chicago or New York, you see that 27-year-old pull up to the valet at the steakhouse in the shiny new Ferrari. Guess what they do for a living? And then there's the high-frequency traders whose firms pay $10 million to build microwave towers so their order gets to the exchange before yours by 3 milliseconds, and you're left out in the cold. How do we compete? But one thing that is undeniable is that they're smart. You don't get to that level without having figured some stuff out. We still don't have to like them or trust them. We can still disparage them every chance we get, but they make money because they know exactly how to do it. The bad guys. Are these institutional traders our friends? Yes, actually they are. Why? From today forward, these traders are going to help us with our trading every day on a daily basis. Imagine that for a minute. There's a way to have institutional traders share the trades they're making with us real time. They'd do all the work. We'd see their trades and we'd trade those trades right along with them. This is my promise to you. I am going to share with you a way to trade high probability trades so you can boost your win rate by up to 53% more than your current win rate by actually seeing the trades professional traders are trading real time without them even knowing. Wow, sounds great, right? And at the end of this presentation, I'll share how you can take the next step so you can start getting results like these right now. Is that a fair deal? Yes? Hit that questions box again for me and give me a big old yes if you're liking that. Go to the GoToWebinar control panel, hit the questions box. Give me a big old yes if all that sounds great by you. Let's see here. Oh, I think Jeff sees the questions. Jeff, do we got some yeses in there?
Yeah, and you know what? I'm going to make you an organizer so you can see the questions.
Oh, hey, that's even better. Okay, thanks, my friend. To see
there
some
feedback. Now they're piling in.
Yeah, all right, that's awesome. Holy cow, you weren't kidding. Yeah, Goran, Brian, Claudia, Pierre, Benedict, Blake. Holy cow, we got a whole bunch of yeses there. Tim, and a whole bunch other I deleted. Elena, Priscilla. Elena gives me exclamation points too. Oh my goodness. All right, great. Now look, also be sure to stay till the end of the presentation. The most important things I will share come later. And to keep the focus, I'm going to hold all questions. If you have a question, write it down. I'll get to it later. So that said, let's keep it positive and let's have some fun. So once again, I'm Dan Passarelli. I traded for years down on the floor of the Chicago Board Options Exchange, wrote 2 of the most popular books on option trading, worked with every major options broker and options exchange in the US and abroad, and I get to be on TV a lot, which is kind of fun. But this is also a slide of who I am and what I do, and these are the important things. The most important thing to me is my family. My kids, my wife, Kathleen, who many of you know, she's been part of the Market Taker team for a few years now. Previously, she was a copy editor, what you might call a proofreader for some well-known publications. And now she proofreads our articles as well. She catches our mistakes. She's the person who makes authors look smart because anyone can make a mistake, right? Now, in addition to Kathleen, there are 2 adult children, Sam and Isabel. And one of the things we like to do together is travel. We enjoy new cities, learning about new cultures, nature. We enjoy food and wine and all that. We've been all over the world together. We're also a musical family. We enjoy listening to music and playing it as well. These are the things that are important to me, and trading helps me be able to do them. So now let's talk about you. I know some of you are just starting out, and some are already doing pretty well, and some of you have been struggling for a while. Whatever your success level is now, you believe you can always do better, right? And maybe that means having a little more freedom to take some time off and play golf. Or actually taking that 3 to 5 day vacation to a dream beach home at an Airbnb with friends and family. Maybe being able to give more to your family members or put your kids or grandkids through college. Listen, here at Market Taker, I will never preach about how trading can get you that brand new Ferrari, because that is just not us. But what if you could learn a life skill, trading, that allowed you to be able to go purchase that Mustang convertible for you to joyride in on a nice summer day. All of this is possible. And I know Mustangs or Corvettes or whatever, are not for everyone, right? Many people like practical cars, the simple workhorses, right? In fact, even the folks that I know who have a fun, sporty car also have a practical one too. Something to drive the kids and all their equipment to soccer practice in. Something to get you from here to there that's reliable, that'll get you 200,000 miles over the years, right? That you can consistently use over and over again through rain, sleet, or shine, or whatever. Maybe you love the flashy stuff, and maybe that's not your thing. But either way, life is easier when you have one thing you can rely on, that one vehicle that provides consistency that you can count on. Now, what I'm going to share with you today is exactly designed with consistency and reliability in mind. This is not a get-rich-quick scheme. I mean, we're not trying to do it slow either, don't get me wrong. But maybe we can call this a consistent wealth-building activity. It's about drastically increasing your win rate with high probability trades to produce consistent profits over and over again, so you have that one part of your overall trading strategy that you can rely on no matter what. Consistency is not guessing. It's measurable. It's using probability to increase your odds of winning and produce a positive return over and over. And in order to do that, we've got to put multiple criteria on the side of every trade. And one of those things is time. So first, we've all heard the phrase time is money, right? But in fact, one is more valuable, I'd say anyway. What would you say? Hit that questions box for me again, please. What do you say is more valuable? Time or money? Please go to the GoToWebinar questions box and type in what to you is more valuable, time or money. Goran says time. Blake says time. Cheryl says time, and Robert says time, and Steven says time. Great, because look, you know what? I say time too, because you know what? You can always make more money. That's not the hard part, but you can never get your time back. And this is what I love about this, your commitment. You invested your time in being here today. You took the first step. Warren Buffett says the best investment you can make is an investment in yourself. And you've already invested your most valuable asset, time, in yourself today. Keep moving forward and reap those returns. So speaking of which, let's talk about options. In option trading, time literally is money, or at least time becomes money. The reason is because options provide more ways of making money, and one of the most important of which is time decay. As time passes, options lose their value. This helps certain traders who know how to put time decay to use. Time passing creates money. And that last bullet point might seem counterintuitive, that time passing creates money, because a lot of traders buy options. But hey, I like to say, if you can't beat them, join them. Put time on your side. Instead of buying options and being at a disadvantage, many traders sell them. In fact, selling options is actually more popular than buying them, because it's a way to make money by time passing. Now, one thing about selling options is that if I just sell an option, I could end up with a small profit potential, but much bigger risk. So we want to be strategic. There are two limited risk, very strategic option spreads that are at the heart of all option trading. So much so that I call them the mother strategies of option trading. The mother strategies of option trading are credit spreads and time spreads. If you can master these two strategies, you will have all of option trading mastered. The reason is because nearly every option strategy is made up of one or both of those strategies. It's important to get credit spreads and time spreads. Right now, I will share the inner workings of credit spreads so that you can walk along the path of putting them to use. So there's two types of credit spreads: call credit spreads and put credit spreads. A call credit spread is when I sell a call, usually at or out of the money, and I buy a higher strike call with the same expiration on the same underlying. A put credit spread is when I sell a put, usually at or out of the money, and I buy a lower strike put with the same expiration on the same underlying. An important takeaway is that because there are both call and put credit spreads, this method of trading works in both up and down markets. Now, to be clear, these are not directional trades, not bullish or bearish trades. These are what many traders call a line in the sand trade. They're forgiving. As long as the stock stays on this side of the line, it wins. So let's go through an example so you can see what I mean. Let's say a trader's studying this stock, Citigroup stock, and thinks it's not likely to rise above a certain point. Maybe there's resistance at $54 a share. The trader can position him or herself to make money as long as Citigroup doesn't go up above $54 a share over the next 10 days by selling the 54 strike calls that have 10 days to expiration, and at the same time, as part of the same trade, also buying the 55 calls in that same expiration. So if they sell the 54 calls at 49 cents and buy the 55 calls at 28 cents, so this trader collected a net credit of 21 cents of option premium. 21 cents of option premium is $21 of money. This is a 10 contract trade, so that's actually collecting $210. As long as the stock stays below $54 a share for the next 10 days, this trader can make up to $210 on this 10 lot and do so with limited risk because we're protected by buying the 55 strike call. So think of it this way. The short option is where one makes or loses money. If the stock is below it through expiration, you get the max profit. If it goes above it, you could start losing. And the long option is the protection. It's what limits the losses. This is a probability curve. The horizontal axis is the stock price, and the vertical axis is the probability of the stock being at that price. What I have here is a bell curve, and most finance professors who love to get technical and use fancy terms will say that stock prices are actually normally distributed. So this graphic being a bell curve is not technically exactly correct, but it's a close enough artist rendition. To make it simple, here's what this shows. The middle is where the stock price currently is. The higher part of the curve here says smaller moves are more probable, have a higher probability than bigger moves. If we look at the past 30 days or whatever closing prices, or if we're forecasting the future, if here is today's stock price in the middle, the most recent or future prices would fall here close to where today's stock price is, but a small number would have closing prices farther away from where the stock is now. Another huge implication that this has is that finance professors assume that the stock has about a 50-50 chance of heading higher or lower. There's a slight interest rate component there, giving a small bias to the stock going up, but this is basically how finance professors think about it, 50-50. That said, we're going to talk about how we can change those odds more in your favor during this presentation. Because in this case, the stock was at $52.61 when the trade was put on, and we sold the 54 strike calls, we have a head start in making money. Let's go back to that professor math. If the stock is at $52.61 and there's about a 50% chance of it being lower at expiration, well, that 50% chance of occurrences would be winners, right? For the other 50% of the time when it goes up, some of that time the trade would be a winner too. Only if it's far enough above the strike price at expiration does the trade lose, and that's why credit spreads are naturally high probability trades. And that has huge implications. First, the objective is not to do this once, to make one trade. It's to make these trades that have a much better chance of winning over and over again every day. More wins compounded over time can grow your account exponentially. And that's great if you have a small account and want to grow it into a bigger account. And even if you have a big account and want to grow it yet bigger. Question, what if you had only 30 minutes a day to trade? There are some trading styles that would be impossible with that time constraint. Day trading, gamma scalping, momentum trades on short time frames. Those are all impossible to trade for people with busy schedules. But credit spreads make money as time passes. They're not urgent like momentum trades or day trades. They're ideal for traders with busy schedules or for traders who have time but like to spend it more effectively. With our trades, we have to look at more than just the win rate. We need to talk about risk. Every trade's a balance between probability of success versus risk reward. Let's look at that Citigroup trade again. If a trader sold this credit spread and collected $210 and held it all the way until expiration, and Citigroup ended up below $54 at expiration, the options would expire and the $210 would be the final profit as shown by this blue line here. Now, if the stock rises above $54, the trade might still be a winner. The credit from selling the spread was 21 cents, so the actual break even is $54.21. Below 54.21, the trade wins. Above there is where the trade loses. And we'll talk more about losses in a second. So first, as you see here, the stock's currently at 52.61. There's about a 50% chance of it going down. If it does, and it's trading lower at expiration, that leads to maximum profit. Then there's a 50% chance of it going up, and some of that 50% would also lead to a maximum profit. Up until we get to $54 a share, that's when the trade starts getting worse. So your odds of success are overwhelmingly in your favor. But I do want to be very clear about something. You do stand to lose more than you stand to win. While the maximum win is 21 cents of option premium or $210 of money on this 10 lot, the maximum loss is 79 cents. We calculate the max loss by taking the difference between the two strike prices, so 55 minus 54, minus the credit. So that's $1 minus 21 cents is 79 cents. So in this case, the risk is more than 3 times the profit. Now, like I said, there's a balance between probability of success and risk reward. So we need an edge above and beyond just the probability of winning. And this is what's different about our approach to trading credit spreads. We get the edge, so the odds are overwhelmingly in your favor above and beyond the simple approach everyone uses on credit spreads. What if we could find a bunch of credit spreads that are high probability trades to start out with? Then we take all of them and see which meets certain criteria that would make it an even higher probability trade of winning above and beyond the simple professor math. And then we take only the trades with the best probability versus risk reward of those trades. That would be powerful, wouldn't it? Now, remember those professional traders? Let's talk about this guy again, the professional trader. I used to be this guy, or at least a guy like him. That was before I chose to work with you to beat guys like him. In fact, I know this sort of guy so well, I actually have a picture of him from when he was a kid. Ready? Wait for it. Yep, that's probably him, right? They take your lunch money, eat your lunch, make you do their homework, and now they dominate the financial markets. Are they mean? Absolutely. Some of these guys will take and take and take. Do they cheat? I don't know. Maybe they do. But you know what? Like I said before, they're smart. You can't be a professional trader, not for very long anyway, without having figured some stuff out. Say what you will about them, and you're probably right, but they know how to make money. So I have a question for you. What if you knew what the professional traders were doing? They'd find the good trades, they'd do all the research, they'd trade them, and you know exactly what they were doing the moment they do it, without them even knowing. You know, that is kind of like having the bully do your homework for you. Wouldn't that be great? But one thing we know is that sometimes even the smartest people make mistakes. So after the bully does our homework, we're going to proofread it to make sure it's right. This whole system is predicated on them being right. But you know what? They're not always right. But you know what is always right? Methodology. Our methodology proofreads what they're doing, so we not only have trades from super smart people, but we are only taking the best of them. This is what I call the genius method. After seeing what professional traders are trading, we verify the technical setups using support and resistance, that we can sell options only that are overpriced, that there are no planned announcements that can cause the stock to lose. And this is how we gain an unfair advantage. We see what the professional traders are doing right there on our computer, so we're getting all of their unfair advantages. Plus, we screen them with our time-tested methodology to take only the best of the best. This does what no computer or human can do alone. This combines algorithm technology with hands-on screening. Now, before I get into how to see the trades the institutions are making, let's first look at what this looks like in real life. On January 4th at 11:57 and 54 seconds in the morning, in MicroStrategy, symbol MSTR, a big institutional trader sold 300 of the January 20th 140, 145 put credit spreads at $1.30. So that means that the trader sold short 300 of the January 20th 145 strike puts, and at the same time, as part of one trade, also bought the 300 of the January 20th 140 puts. That is a put credit spread. Same expiration, two different strikes. Because the 145 puts are a higher strike, they had more premium. Thus, the trader took in a credit when the trade was made. In this case, that was $1.30 per contract. $1.30 of option premium is $130 of actual money times 300 contracts. This is a pretty big trade. 16 days later, expiration came along, and this trader could have made $39,000 at that time. Now, what if you were alerted about this trade the very second it happened? Well, a small trader following along and trading just 5 contracts could have added $650 to his or her account. Now, $650 might not look like a lot compared to $39,000, but imagine doing this many times over and over again. This is what leads to this being a wealth building activity, even and especially for small traders. And bigger traders might consider trading somewhat bigger trades. A 10-lot trader could have brought in $1,300. A 20-lot trader could have made $2,600. And in fact, this trader could have actually taken a profit even much sooner before expiration. Another example in PDD on January 13th at 9:45 and 26 seconds, 499 of the regular monthly January 100-105 call credit spreads traded at $1.33. So this trader sold 499 of the 100 calls, and at the same time, as part of one trade, also bought the 105 calls. This trader took in a total credit of $1.33 contract. So this is a call credit spread. Its advantage is that it's a not very bullish trade, okay? As long as the stock is below 100 at expiration, which in this case was 7 days later, this trader would have made a $66,367 profit. Imagine you see this trade the millisecond it happens. A trader trading just a one lot spread could add $133 to his or her account. A trader who typically trades 5 lots could have brought in $665. 10 lot traders could have made $1,330, and that would be $2,660 on a 20 lot. In Apple, on February 9th at 3:53 and 34 seconds, a big trader traded 500 of the February 10th, 152 and a half, 155 call credit spreads at 39 cents. Pretty big trade. Then about 5 seconds later, at 3:53 and 39 seconds, the trader sold another 4,085 credit spreads at 38 cents. Then within another 2 minutes, they sold 2,124 more at 32 cents. Now, again, these are not super time-sensitive trades like day trading or anything. The price often doesn't change all that much over short periods of time. Remember, you make money by time passing. If you miss the first trade here, even miss the second or the third one, and happen to notice it an hour later, it's still possible to participate in this trade. If the trader held this to expiration and the stock stayed below $152.50 at expiration, he or she would have made $242,698. Pretty great day trading, huh? And that was actually in just one day, overnight. Even a small trader following along, trading just a 5 lot, could have added $160 to his or her account. 10 lot traders could have made $320 profit, and on a 20 lot, that would have been $3,200. These are just a couple examples so that you get a feel for how this works. And I have dozens of examples of how all this works that I'll be sharing in even greater detail in a bootcamp video class. In just a few minutes, I'll share how you can get access to the video recording of a half-day bootcamp that we have already recorded for you. By now, we've covered quite a bit. Have you found today helpful? Do you think today was time well spent? Do you think that you could use what you learned today to grow your portfolio and provide you and your family with a better quality of life? Would you like to get results even faster? Do you want to get consistent daily results? And everybody answer this last one for me. Is it okay, hit that questions box, is it okay if I show you a way to go even deeper to get consistent results even faster? Give me a yes if that sounds pretty appealing. Sandra says yes, all caps, exclamation point. Blake says yes. Cheryl says yes. Stephen says yes. William says yes. Brad says yes. Cam says yes. Good. Now look, any professional athlete or anyone who's really ever done anything great for that matter has to get up 2 hours before everyone else and get in their practice. And traders do that too. But look, I don't want to get up at 4 a.m. to get all the trade data that I need from the CEOs, do all the research, model out all the trades and such. The one thing that I know is that the big institutional traders are already doing that. Why double up efforts? So I discovered a way to get institutional traders trades sent to us live real time. And look, if you're like me, you get a lot of messages, and some of them are important. If you didn't open the email or text you got about this training, you could have missed one of the best trading opportunities that I've ever shared. But you get some noise too. What if you could get just the most important messages and skim them over on your lunch hour or break and get all the information you need all in one place without the noise? You just see what's important. What I like to call purposeful notifications. Wouldn't that be great? Well, that is what I'm about to share with you right now. Credit Spread Genius is officially here. Every day, you'll get real-time alerts when traders are trading a large volume of credit spreads to open a new position. You'll be the first to spot these trades so you can participate in the biggest trades in the market using my proprietary trade triggers to see exactly when the trade is happening real time, and then follow a simple checklist to proofread it. And it's all extremely simple. I'm sharing this now so you can start getting the results that you deserve. Like this one, on January 13th in Starbucks, a trader could have followed the institutional traders and traded a 5 lot of the January 27th, 108, 113 call credit spreads, and could have made $415 holding it until expiration. A 10 lot would have made up to $830 in profit. In Tesla on January 27th, a trader could have traded a 5 lot of the 180, 185 call credit spreads expiring the same day and made up to $485 on just a 5 lot. A 10 lot could have made $970. In Alibaba, on January 1st, a trader could have done the February 3rd, 113, 121 call credit spread and made up to $800 on just a 5 lot. That's $1,600 on a 10 lot. Meet Chris from Mobile, Alabama. Chris was one of the first people to use Credit Spread Genius. Chris says, as a busy professional, I like the credit spread alerts because they save me time in researching the trades. The nature of credit spreads also means that these alerts are not as time sensitive. I can check the alerts in between patients or at lunch and then quickly formulate a plan to execute a trade. Let's first talk about who this system is not for. Just to be clear, this is not for people looking for a get-rich-quick scheme. It's not that kind of strategy. This is about having a system that drives consistent overall profits. And this is not for people who like spending hours going through thousands of charts to hopefully find a halfway decent trade. This is designed to save you time. Your time is valuable. These trades can literally be made with a couple of minutes, not hours, because all the information pops up in a browser window. And this is not for wishy-washy procrastinators, overthinkers, wishy-washy people who see a good investment but can't make a decision to save their lives. They don't make good traders. But I know that's not you because you have invested your time in being here today. Because let me tell you who this is for. This is for you. If you want a true edge over the market, this is for you. If you want your trading to be easier and less time consuming, this is for you. If you have a busy schedule and can't look at the market all day long, and this is for you if you can follow a few simple steps and if you're willing to invest in yourself. Are you? I want to invite you to join us and start using the Credit Spread Genius system right away. So first, you're going to get the Credit Spread Genius scanner. So every day, you'll get real-time alerts when the big institutions are trading high probability credit spreads. This simple scanner searches the universe of over 5,000 stocks for the setup and makes it possible to find trades you would never have access to without it. This is my easy-to-use alert system that instantly alerts you to big institutional credit spread trades. You'll be following the smart money, so you never have to second-guess yourself in the market again. You get password access to real-time trade triggers sent directly from the Chicago Board Options Exchange. I have pulled some strings for you. I've negotiated a contract with the Chicago Board Options Exchange for you to get professional trade data that you can't get from any other source. I repeat, you literally cannot get this from any other source. I, as a professional in this field, pay for the data because not only is it expensive, it's about $7,000 a month for professionals, but it's not available to non-professionals at any price until now. And the best part is it's all legal. When you sign up, you'll sign up as yourself, a non-professional trader, and get access to these signals through this deal I made with the exchange on your behalf. This is both powerful and simple. The closest thing to what I'm sharing with you today is what you'd call an alert system. This is what one person who used the Credit Spread Genius had to say about his experience. I've used other alert systems before. Mostly those are alerting naked long calls or puts, mostly way out of the money and seem like a lottery ticket. I never gained any ground with those. This credit spread alert seems different somehow. Like it tells more of what the big dogs are thinking. So yes, what I've created is different. You see, most alert systems simply don't work. Even the few credit spread scanners that are out there, they boast high probability, but they're only doing the simple professor math. They don't have a true high probability once you weigh it against risk reward. They don't have a true edge. So I created a true high probability trading system with real edge that doesn't require constant attention, along with the training to screen, set up, and manage the trades. This is something that actually works. I talked to my friends at the CBOE about how to get this data. They built an algorithm just for me that scans the market every millisecond for trades the smart money is making, and then pushes them out to our traders in a password-protected browser window. No one else on the planet has this technology. These alerts are truly different. You can't get these from scanning with your brokerage firm. You literally cannot get them anywhere else. But the other important part of this is the proofreading process and the training on how to manage the trades. So I've created some bonuses for you. Let me ask you, when the plumber comes by for 30 minutes to fix a busted pipe, you're not paying him for his 30 minutes, right? You're paying him for his 30 years of experience. So I decided to save you years of time and put everything you need to know from my nearly 30 years of experience into a few super short, quick, easy videos to get you up and running so you can start using Credit Spread Genius right away. This video training course reveals step-by-step exactly how and why the Credit Spread Genius system works. Because every step is laid out for you, trading the Credit Spread Genius system removes the emotion from your trading, making it easier to get the results that you want. So what this means is, first you're going to get the Credit Spread Genius trade triggers, and then you're also going to get the education, the Credit Spread Genius Accelerator video course to get you up and running right away. The bottom line is, we know it can work for you because we're going to make sure you have all the training you need to make it work. Today, you will also get access to the archive of the Credit Spread Genius half-day bootcamp. You're going to get a complete half-day's training video on every single aspect of trading the Credit Spread Genius system to maximize your chances of success. In the bootcamp, I share how to easily confirm the technical setup to put more probability of winning on your side, how to read options data to identify high probability credit spreads, how to use volatility analysis and skew in your credit spread analysis, how to maximize your exits to even further boost your win rate, and how to make all this really simple. Even if you've never traded an option before, you'll understand a simple approach to trading credit spreads so that you can trade with a high probability of success right along with professional traders. Bootcamp is already recorded for your convenience or just to review, and it covers everything you need to know to truly master the system. The Credit Spread Genius Bootcamp is a $3,700 value. So what this means is today you're going to get the Credit Spread Genius trade triggers pop up right on your screen, the Credit Spread Genius Accelerator video course, and the Credit Spread Genius half-day bootcamp. That's a $7,750 valued package. Now, this is a bonus I'm super excited to share with you today when you move forward with the Credit Spread Genius package. This is the MTM Spreadsheet Trade Tracker. This is my personal spreadsheet for making sure that I follow every step on all my trades. I've put it into a template that now you can use too. Its formulas are designed to easily calculate the trade criteria you need to analyze, trade, and manage your credit spreads, as well as other MTM proprietary trade setups. I've made it so simple to track your trades, it's like cheating. This is a $500 value, and it's yours today as part of your Credit Spread Genius Traders package. This amazing value is not just because of all the months of work I put into this based on my 30 years of experience. Not only that, but if you can manage your trades more effectively, make an extra couple $100 on your winners, lose a couple hundred less on your losers, and increase your win rate. This simple framework has the power to massively increase your bottom line. So what this means is, first you're going to get the Credit Spread Genius trade triggers. You're going to get the accelerator video course. You're going to have it mastered with the bootcamp video, and you're going to get the spreadsheet trade tracker to make sure you're hitting every step. Total value of $8,250. Credit Spread Genius works on all platforms. Open a simple browser window to deliver your trade triggers real time. There's no special software. Trade on your platform of choice. But do you know what the best part of this is? It's the working leverage. And here's what I mean by that. Typically, more leverage means more risk. In this case, less work means more return. You're leveraging your time. Look, it took me months to build this based on 30 years of experience. We've done over 50% of the work for you. And then the trades just pop up on your screen. Institutional traders do 48% of the work. You just do 2% and you get to keep 100% of the profits that you earn. Buy now. You can see why the Credit Spread Genius trading system is a steal even at $8,250. If all this did for you was identify high probability trades to take your trading from where it is now to boosting your win rate so you can be consistent and not have the huge swings that all too many traders experience, wouldn't it be worth it just for that? But today, this is not $8,250. Because you've made the investment of being here live on this training, and for being one of my action takers, you're the elite. You deserve to be rewarded. You're better than millions of other traders out there. And I want you to have the results that you deserve. Get started today for a small, easy investment of only $497. But you have to take massive action by going to markettaker.com/go. 1, 2, 3, go. So that's market as in stock market, taker as in take what is rightfully yours, 2 T's in a row, markettaker.com/go. Now, a lot of times I say, hey, this is limited to the first 20 people or something like that. In fact, my marketing guy said I should limit this to 20 people, but I don't think that's necessary. You're smart. I'm not going to do this. I want as many people to have this as possible. Now, why would I give such a huge discount? Admittedly, it's for a somewhat selfish reason. We found that the overwhelming majority of my traders are what you'd call repeat customers, right? So I know that if this is an awesome class and you're massively successful with it, you'll probably want to invest further in some of our systems in the future. And this is the best thing that I ever created. And I was not kidding. These trades come directly from the Chicago Board Options. As soon as you go to markettaker.com/go, you're first taken to the CBOE subscriber agreement from the exchange. Again, that's because of the deal that I worked out with the exchange so that I pay for the data. And because you're a non-professional, only through me can you get this data. So they require everyone to complete this form first. This should be what you're seeing right now. If you're not, please go to markettaker.com/go. And as a reminder, when you join right now at markettaker.com/go, you're going to get the Credit Spread Genius trade triggers in a password protected browser window, pops right up on your screen. You're going to get up and running fast with the Credit Spread Genius Accelerator video course. You're going to truly have this mastered with the Credit Spread Genius Bootcamp video, and you're going to make sure you're hitting every single step with the MTM Spreadsheet Trade Tracker. There's one bonus that's not on those slides, and that is the MTM Community Chat Room. You are going to be in the best online community of traders ever created. This is your support group because trading can be a lonely, lonely game. And for you to succeed, I need to put you in a group of traders who are going through the same struggles that you are, or some that have gone through them already and have made it through to the other side and are now massively successful. I'm going to take some questions in a minute, but one question I often get is, hey, Dan, I have a small account. I see this as a great way to grow it, but I might have a hard time coming up with the 497 right now. Can I finance it? That answer is yes. You can use PayPal and PayPal credit. We have a deal with PayPal to offer you both PayPal as a payment option and PayPal credit, so you can lock in Credit Spread Genius today. When you check out using PayPal and choose PayPal credit, just go to markettaker.com/go, click the PayPal button, and get started right away. Now, do you mind if I over deliver? I'm going to give you one more bonus. I'm going to give you a complimentary strategy session. This is a 30-minute phone call with our trader success team. They're going to get you on the phone, talk with you to overcome what's been holding you back in your trading, and develop together a plan to get your trading to the next level. Now that is a $500 value, so that makes this a total valued package of $9,047 that you're going to get today for just $497 per quarter. And the best part of this is, after the first quarter, you get to keep this massive discount as your quarterly renewal rate, as long as you choose to stay in the Credit Spread Genius program. Now, I'm going to open this up to questions. If you have any questions about Credit Spread Genius, go ahead and drop them right in the questions box. It looks like I've got about a couple of minutes. While you're putting your questions in there, let me answer some frequently asked questions. What if I can't install it properly? Well, there's nothing to install. You simply click a link in an email, type in your password into a browser window, and it displays your trade triggers live in real time. Is this time consuming? No. You'll watch the accelerator videos, get up and running right away. I know you have a busy schedule. I've designed Credit Spread Genius so you can literally trade this system in just a few minutes per trade. What if I can't figure it out? You get both the short videos in the accelerator video course for reference, plus the half-day bootcamp video sharing everything you need to master the system. And you also get to ask me and our other traders questions in the chat room. What if I have a small account? Well, you want to grow it into a bigger account, don't you? I think I just saw a couple of questions, but I believe my time is up. If you have some questions, you know, go to markettaker.com/go. Join us in the Credit Spread Genius Traders package. Oh, I think somebody said, do I give sell signals? I give you the education in the accelerator video class and the boot camp so that you can set your sell, you know, your closing prices accordingly. So yes, you get the entire trading plan with that. And that, I'm going to leave it at that. I believe my time is up. I think Jeff has some more really great speakers today, and I don't want to overstep my boundaries.
All right. Very good. Tavonda in YouTube says, I'm learning about stocks at CBO. I always enjoyed Dan Passarelli. So
thanks.
So good job. Felton wants to know if it's a one-time cost.
Yeah. So Felton, so here, what this is, you know, like normally what people do, like I invest in a lot of online classes and in-person classes as well. And I know that when somebody gives this a massive, massive discount, they call it a trial price, right? So that you can see how great it is. And then the normal thing is that the next quarter, once that expires, then you pay full price, right? But I don't believe in that. I don't believe in that for me. I don't believe in that for you. So after this first quarter, 3 months, let's say you made $5,000 trading Credit Spread Genius. Well, you will get to renew for just another $497 a quarter. And by the way, we don't actually even offer this anymore. We've since raised the price, but we got recruited for this webinar a while back. So so this is a per quarter investment, and you can cancel anytime. You know, but if you decide to stay in this, if you're making great money, you're making $1,000, you know, thousands of dollars a month, you can keep this and keep renewing quarter after quarter for life.
Sorry for that giggle. That was unrelated.
Oh.
Very good. Very good, Dan. Thank you very much. We're just having just trying to. Well, anyway, it's not worth even explaining. Dan, great job. Really, really appreciate you coming in, and good job as always.
Thank you, and thanks for attending my session today, folks.
All right. We'll see you again soon. Okay. All right. Really good. There we go. Let's go ahead and do this, and we'll do this. And we will talk. Okay. Dude, that's a little, I just can't get the lighting right in the afternoon. That looks a little too dark, but if I go too light, anyway. I need a professional in here. All right, want to say thank you to Stocks and Commodities for sponsoring today's event. They've done a great job. Are an amazing partner. We really appreciate all the work that they've done over the last 11 years in supporting all of the events that we've done. So if you do a subscription to MetaStock today, you get 5 months of Stocks and Commodities for free. And if you spend $300 or more, you'll actually get a 2-year subscription. Big, huge thanks to you or to Stocks and Commodities. So hold on just a second. Okay. Let's see. Give me half. All right, there you go. Just working on something behind us here. Also want to say thank you to CMT. CMT's been a sponsor of the event for about a year. CMT is a great organization. They deal with accreditation, and they do risk management, quantitative systems development, portfolio management, and applied behavior finance. You can actually kind of reach out to them at cmtassociation.org if you want. So cool. We're just and then while we're kind of waiting for the next presenter, I do want to highlight one of the offers we did a little bit earlier the week. Silas Peters came in and talked about 3S Code. 3S Code is a really, really cool add-on that helps you identify 1, 2, 3 tops and 1, 2, 3 bottoms. I think it's incredible the amount of stuff that he includes as part of his add-on for a one-time cost of $397. So for $397, you get access to his private Telegram room. You're going to be able to define the user parameters in terms of the 1, 2, 3 codes. You'll get chart patterns course, as well as a chart pattern cheat sheet, 25 top option strategies, VIP support to help you get set up, monthly trading strategy. And if you don't have access to MetaStock, we'll actually give you a free trial as part of that. So there you go. Really, really good product. 30-day money-back guarantee. Here at the event, it's going to be $397 with a 30-day money-back guarantee. So you can give us a call, 800-882-3040, or you can do metastock.com/sales-chat, or you can visit us at metastock.com/conf promo. So there you go. Of course, we are MetaStock. We're going to give away a small prize, right? Or actually, we're going to give away a valuable prize. So we did pull the number, and I got one. We actually kind of were soliciting. We're going to pick a number that was picked for us from YouTube. So Jonathan gave us a number of 11,888. I'm just going to jot this down here, 11,888. And let me figure out what the prize is that we're giving away this time. So, oh, here's a good one. Actually, I'm going to go ahead. The prize that we're giving away is a complimentary 1-hour strategy session with Dan Passarelli. This is a 1-hour discovery call with the MTM Trader Success Team. You might remember Dan Passarelli. He just got done talking like 2 minutes ago. And in this particular course, he's going to talk about how to overcome what's holding you back and carve out a plan to get your trading to the next level. It's a $500 value. Let's figure out who the winner was. It's again, that was 11,885. Hold on just a second. And let's go ahead and look at that. Okay. And the winner of that prize is Jim M. With an MSN address. So congratulations. I'm going to go ahead and jot you down as the winner of that prize. What happened is within about a week or so, we will actually kind of reach out to you and give you the prize. So there you go. One other question that came in, Franklin wants to know, are all of these webinars recorded? Absolutely. So we're almost done. Doesn't feel like we've been kind of in here for about 40 hours, but we have 2 more sessions coming up. And once we're done with the session today, about 1 hour after the sessions, we will send you a link to all of the playlists that are available. So there you go. Yes, they are recorded, but they are available for you. So there you go. Our next presenter is Marco Gomez. Marco is joining us for the very first time in the GoToWebinar MetaStock conference. In this particular one, I'm kind of excited because he's going to talk a little bit about fundamental analysis, which is something that we don't talk a lot about. At least that's what I think he's going to talk about. In any case, though, let's go ahead and get him in here and get him talking. Marco, let's go ahead and see if we can get your video to work. I can't see you. Thanks for joining us. Push this button, and it should ask you if you want to share your microphone. There we go. Try
yes, hi. How are you, Jeff?
I'm
Can you hear
it's
me?
good to see you. Yeah.
Perfect. And you can see me fine.
Yeah, you look great.
Thank you.
I'm just I like it. I like the glasses on. But here,
I keep them on. You know, it makes me look a little bit more intellectual. So I keep them on. They're definitely help with all the screen time.
Whatever makes you, whatever you're comfortable with. I'm gonna go ahead and make you the presenter. So you should get a pop-up that says, "Do you want to share your screen?"
Yeah, perfect.
All right. And now what I can see is the join GoToWebinar screen.
Okay.
Okay.
Can you see this? Is that good?
I can see that. Yeah.
All right. Perfect.
I'll go ahead and get out of the way. It's all yours. Thanks, Marco.
Okay. Perfect. Thank you very much. Hello, everybody. My name is Marco Gomez. Let me just start off here with let me just start off here with the presentation slides, and I'll give a little introduction about what I'm going to be talking about today, as well as I'll be taking questions. So feel free to ask questions if you need to. So essentially, let me just start off here. So, I'm here to talk about the impact of interest rates and central bank decisions on financial markets. I'll be discussing a lot of things that you'd be surprised how little is known in the trading community about how impactful or how much interest rates and central bank decisions matter on essentially every market around the world. But before I get there, let me give you a little introduction on myself. So as I mentioned earlier, my name is Marco Gomez. I graduated from the University of Toronto. I have a degree in economics and finance. I started out my career at CIBC Mellon in Toronto. Before that, I actually started trading when I was 18 years old. I would, when I was in university, I would skip classes and started trading internet stocks back in 1997, 1998. All of the wireless internet stocks were very, very, were very hot back then. And I actually got on the .com wireless wave way before it turned into a bubble. I started buying internet stocks when nobody really was buying them, and essentially I took a student loan. I took the money from my student loan, and instead of paying my tuition fees, I put it all in a trading account when I turned 18, and I started day trading internet stocks back then. This was back in 1997, 1998. And then I would skip school. I would go to the library. I would put two screens together, and I would start trading internet stocks. It was fun, and I brought an account up from a few $1,000s to close to $1 million at 18. So you can imagine the type of I thought I was a hero. I thought I knew what I was doing, and then when everything crashed, I lost everything. I ended up with zero. So that taught me a very, very important lesson about risk management. But I also knew from that moment that trading was the thing I wanted to do. I just didn't know how to do it properly. I was self-taught back, when you're 18 years old. At the university or high school, they don't really teach you anything about how to properly trade, especially about risk management and the psychology of trading. So after bringing in a few $1,000s into almost $1 million, back down to zero when the bubble popped in 2000, 2001, then I decided to get serious about trading. So I finished my degree at the University of Toronto, and then I took on a financial job downtown Toronto. I was at CIBC Mellon. I started out in the back office, moved to the middle office, and eventually ended up in securities lending and also as an analyst. There, I started looking for trading jobs and got hired by the largest non-bank futures broker at the time named Refco out of Chicago, and they gave me a job as an interest rate derivatives trader. This was the time when the Chicago Mercantile Exchange and pit trading was transitioning away from the pit into electronic trading. So they wanted to make the transition from hand-based trading, pit trading, to screen-based trading, electronic trading. At the time, there were a lot of trading platforms that were facilitating this transition. And I was one of the first traders to really be trading futures on the screen. The Chicago Mercantile Exchange still had their trading floors, but screen-based trading was taking off. And they hired thousands of traders to focus on screen-based trading. I started trading fixed income derivatives. I started out in the short end of the curve, trading Eurodollar futures, 2-year notes. I went on to the belly of the curve, 5-year futures, 10-year and 30-year bond futures at some point. I started doing spread trading, and I was focusing on really interest rate derivatives. But when you trade interest rates, you really affect the world, right? You affect equity valuations, you affect Forex. Nowadays, I mean, back then we didn't have cryptocurrencies, but today you also affect the cryptocurrencies market. So it taught me really everything about everything. Being an interest rate derivatives trader, knowing how bonds reacted to information like macro data, as well as commentary from central bank members around the world, and then seeing the implications of that onto other markets, equities, Forex, even commodities to a certain degree. So I think that was the best thing that could have happened to me, learning about how to trade interest rates as the beginning of my trading career, because from that moment on, I felt that I could trade anything and I could understand pretty much anything. So we did really well. As you can imagine, back then, it wasn't really difficult to, it really wasn't difficult to make money, to be honest. I mean, there was a huge discrepancy between what was happening on the pits at the Chicago Mercantile Exchange, and you have to remember that the London pits at the live exchange had closed, and everybody was moving on to electronic trading in London. And Eurex started out as an electronic-only exchange. So all of the European interest rate derivatives, as well as European equity futures, etc., were all being traded electronically, and nobody really knew what they were doing. So we essentially dominated that market. It was relatively easy to trade back then, and we were getting in and out all day. A lot of day trading, a lot of swing trading. And we were able to make a lot of money for Refco. I was a prop trader there. I was trading their own capital. And then we all know what happened to Refco. Well, if you don't, that means you were born after 1982 or 1983 probably, because Refco essentially ended up going bankrupt. And that was the best thing that happened to me, because I was able to partner up with a few of the traders at Refco, and we started our own high-frequency trading firm in Montreal. We became one of the best companies to work for, an amazing company that we built using technology to trade, primarily futures, but then we went on to trade the spot market and many other financial markets around the world. I did that for about 10 years. The company was sold, and I was lucky enough to essentially retire. And I founded the Institute of Trading and Finance as a passion project of mine to essentially teach traders how to trade. It is a passion project. I do it because I love teaching. In fact, the way I got into teaching was after selling my company. I was really bored. I didn't know what to do. I was traveling the world. I was having fun, investing in other things like real estate and venture capital, etc. But I really missed the markets, and I started my own trading firm again. This time, by the name of Okram Capital. So essentially, he manages my own money. We don't take outside capital. But aside from trading, I really wanted to do more in the field of trading, and I never understood why people would go from playing soccer to becoming soccer coaches. And it was then when I realized why they do that, or hockey or football coaches. And I realized that there is great satisfaction in teaching what you know to others. So I got invited to teach at the University of Toronto as a guest professor there. And I taught trading to the Masters in Financial Economics students. I was not essentially an employee of the University of Toronto. I was just a guest speaker, guest teacher, and I loved it. I love being in front of an auditorium with hundreds of people that just wanted to learn how the financial markets really work. How could you make money trading markets when it is essentially a zero-sum game, right? And then I realized, okay, what I really want to do, aside from trading my own money, aside from investing in venture capital and real estate, etc., I wanted to teach as a fun project, and what started as a fun project ended up being an amazing project, right? IOTAF was founded in 2016. My goal was really to help traders become successful. The idea was that I would be trading during the day. My trading company would be trading during the day, and then at night I would stick around and I would have lectures for new traders. All the new traders that would come in, I would pick the best traders and have them join my trading firm. That was a great system, a great model. And then the school started growing and growing and growing. And I went from having only a few students in my first class to having 20, 30, 40, 50, 100. And now we have over 500 students and traders. And I am very, very glad to say that we have taught and trained some of the most successful traders today. And I love it. Every single day I meet with the students, the traders. We trade together. It's fun. I love it. And then my trading firm, Open Capital, continues to trade. We had an amazing year in 2020, amazing year in 2021, and obviously I've had an amazing year trading since for the last decade. But right now I trade my own capital with my own trading firm, Open Capital, and then I teach others how to trade as a hobby, as something that I do as a passion. Okay. But then, we got really, really big. IUTAF got really, really big, and we got over 500 student traders. And then we decided to create our own app. And that's when we created the Agora app. It is essentially a trading education app designed to make traders successful. We provide real-time news, research, live audio, squawk, and market commentary. And we have daily classes, daily webcasts. So, for example, this morning we were trading live the PCE core numbers that came out. And we have daily classes. We have faculty members that teach anything from technical analysis to risk management, to psychology, to macro fundamental, and all the videos that we have ever recorded, the thousands and thousands of hours that were recorded at our school have now been archived on this app called Agora. So that's enough about me and about what I'm doing right now. And let's start off with the topic of today's webinar. Interest rates matter, okay? And they matter a lot. And if you don't really understand where interest rates are going, a lot of people think that, understanding interest rates only helps you when you are trying to get a mortgage and you're trying to figure out whether you're gonna choose a fixed rate or a variable rate mortgage. And that's not true at all, right? Interest rates go beyond that. And in 2021, we got really, really famous because we were one of the few people that were very clear and outspoken on social media and everywhere about how we shorted the market at the top. And people thought we were geniuses. People thought we were geniuses shorting the market at the end of 2021, at the beginning of 2022, and we shorted all the high-flying stocks like Carvana and Peloton, et cetera. And after the markets crashed, everybody looked back at us and said, "You guys are geniuses. How do you do it?" And we are not geniuses. We just understand the impact that interest rates have on financial markets. And if you understood how interest rates impact financial markets, and if you understood how to read commentary and how to react to central bank commentary back in 2021, you would have made a lot of money because you were giving the heads up that a massive market correction was about to begin. And it had everything to do with interest rates. It had everything to do with quantitative tightening, which I will discuss in a second, and it had everything to do with central banks' actions to remove some of the monetary policy accommodation that had been put in place to combat the 2020 pandemic. And they were very, very clear about their intentions to raise interest rates. They were very, very clear about their intentions to reduce the size of their balance sheet. I'll explain all these terms in a second. And had you just been listening to policymakers, you would have shorted the top and you would have probably gotten near the bottom, because we did. We bought the most recent bottom and we enjoyed a beautiful 20% rally in equities. And most recently, we've been short. And people think we're geniuses, and we're not. We really understand technical analysis. We understand macro fundamentals, but most importantly, we understand the impact that interest rates have on financial markets. Okay. Now, the way my style of teaching is very conversational, is very practical. I hate big PowerPoint presentations, boring presentations where everybody's just reading what I wrote. So for those of you who don't know me, It is very conversational. It is very practical. Okay, and there is not going to be any big PowerPoint presentations. We essentially focus on really getting down to the nitty gritty of what you really need to know. Okay, so let's start off with the stock market. Okay, the stock market is essentially a big, ginormous circus of buyers and sellers trying to figure out where the price is going to go. For every buyer, you have a seller. But the most important thing about the stock market is that essentially is the most proven way to hedge yourself against inflation over the long term. When you look at the returns of the S&P 500, NASDAQ, etc., over the long term, there is a reason why they say time in the market beats timing the market, because over time, nothing really beats the performance over a very long time frame of the equity indexes, such as the S&P, the Dow, NASDAQ. Obviously, if you take a very short period of time, let's say you take a very short period of time, and what you do is you take 1 year or you take 2 years, you will obviously see that equities are dangerous, are risky. In some years, you may be down 20%, as we saw in 2022. You may be down 30% from the top. So, sure, when you look at it very short term, equities are risky. But when you look at over the long horizon, 20, 30, 40, 50 years, equities continue to be the best hedge against inflation. Now, that really matters because inflation, as we know, has been non-existent over the past 20 years. And, we can talk about that for hours, but one of the main reasons why inflation hasn't been there is because China, obviously, as they grew from a third world country to some of the one of the most powerful countries in the world, they've been keeping the yuan low to be able to produce and manufacture goods in China very, very cheap and export that deflation around the world. So everything that we've been buying over the past 20 years has been cheaper and cheaper and cheaper and cheaper because a lot of it comes from China. You also have technological innovations, right? We're able to send an email instead of mailing something. We're able to have a meeting on Zoom instead of flying or driving somewhere to meet with people. And we became more productive. Technology has been used to produce things more in a cheaper way, and that has also helped. It has helped inflation from going above 2% for years. Add to that the way they calculate inflation at the Bureau of Labor Statistics, and that's just more technical. But you have many things such as technological innovations and substitution effects, etc., that made it very, very difficult for us to have any official inflation. So we didn't have inflation for years, and the market kind of just was very, very comfortable with 1.5–2% inflation. And central banks around the world liked that inflation wasn't too crazy, but also didn't like the fact that they couldn't get inflation up to 2%, which is what the Fed wants to do, bring the PCE core to a yearly rate of 2%. And the same with central banks around the world. They want to leave inflation. They want to have some tiny little inflation. Let's call it 2% per year on the core numbers. Now, when we look about interest rates really is the price of money, right? How much does money cost? If you really, really need money, how much does that money cost? So let's say you need $100,000. How much does that cost? Well, the price of money is what you're going to pay to borrow that money. So if you borrow $100,000, how much are they charging you every year to borrow that money? And that is the interest rate. So obviously, the higher the interest rate they charge, right, the more valuable money becomes, because if you have money, then you can charge more for that money. The price of money is expensive, right? And we try as traders to figure out where interests are going to go, because if we have a view that interest rates are going to go up, then we know that money is going to be more expensive, and that affects everything, right? Number one, if money becomes more expensive, having money, right, pays you more. So instead of you putting the money in the stock market, for example, you just put your money in a bank account that pays you 4 or 5% per year, and you don't have to worry about the volatility in the stock market. Now, short term, that is going to be an okay strategy if there's some kind of uncertainty about the economy. But over a long horizon, even with a 2% interest inflation rate, your money is going to be worth 2% less every year. And even if you're getting 4% now, some years you're only going to get 1% because interest rates are lower. So over time, you're really not going to be hedging against inflation. So it is a short-term strategy to keep your money parked if inflation is high, if interest rates are high, because there is money to be made in the very, very short term. But over a long horizon, you're always better off putting your money somewhere where you can hedge it against inflation, such as the equity market, that can return anywhere from 8 to 15% over year over year over a very, very longer time horizon. So we, as interest rate traders, we try to say, okay, where are interest rates going? If they're high, the price of money is high. And if the price of money is high, there's going to be less money going into equities. And less money going into equities brings the demand for equities lower. That's just one of many reasons. Second reason, higher interest rates makes it very expensive for companies to borrow. So if you're a company, you're borrowing $1 billion or $2 billion in the bond market, you're issuing your own bonds. The higher the yield on those bonds, the higher the rates on those bonds, the more interest rate payments you're going to be making to your bondholders, and that will impact your profitability. So you obviously have an interest expense going up. Companies that are highly leveraged get impacted more than companies that are not leveraged at all, right? So we look at companies that have high levels of leverage, and when you have inflation, interest rates going up, those are the companies that are going to be impacted the most because they are going to be paying more in interest payments. And then the third and the most important one for high-flying stocks like NASDAQ is the whole concept of the dividend discount model or present valuation, right? When you look at a company like NASDAQ, that it would be a technology company that would be in an index like NASDAQ, they are usually not very profitable when they're on the early stages. We'll remember Amazon, when I was trading the internet stocks back in 1999 and 2000, none of these companies were making any money, yet they were worth billions of dollars because investors were thinking, well, in 10 years, in 20 years, they're going to make billions of dollars. Sorry, I got cut off there for a second. So,
hey, Marco, that was my fault. I wanted to make sure you knew that you weren't sharing your screen anymore.
Oh, but I'm
Did you
just
do that
sharing
on
my
purpose?
stuff, right?
We can't see your PowerPoint anymore.
Yeah, that's fine.
Okay. I just want to make sure you were aware of that.
Yes, but they can see me, right?
Oh, yeah. Yeah. You look,
okay, perfect.
You're looking great.
Thank you. Yeah, so when you have the technology stocks that are not making any money right now, but they're expected to make money in the future, you are going to discount all those future cash flows to today, and you're going to give the company a valuation today. Well, how you discount all those cash flows to today is dependent on the interest rate, the cost of money. So if a company like Amazon in 1999, 2000 was not making any money, but was expected to make billions and billions of dollars 10, 20 years from now, that came out to be true. By the time you bring all those future profits to today, to come up with a valuation today, you will have to discount them at an interest rate. And that interest rate, the higher the interest rate, the lower the valuation for those particular companies. So technology stocks depend on waiting for the money to come in from dividends, from profits. And the more you wait, the more the interest rate that you're discounting all those future cash flows to today matters, because the minute those interest rates go up, the valuation takes a huge hit. And that's what happened with technology stocks. They were priced really, really high post-pandemic because interest rates were essentially at zero. So if you had to wait 20 years, well, you could, because the price of money was low, was zero. So you could wait 10, 20 years for your billions of dollars to come back. And the valuation of those companies would be really high. The minute the price of money became expensive, interest rates went up, all the valuations for those internet stocks would come down quite aggressively. And that's why NASDAQ was the underperforming during this interest rate hike cycle by the Federal Reserve and other central banks around the world. So now, understanding that higher interest rates are bad for stocks and lower interest rates are good for stocks is obvious, right? I just explained it. But then what happens then with inflation, right? Because when you have inflation, you usually have tightening, monetary policy tightening. You usually have central banks that want to bring inflation down to the target. Now we know that post-pandemic, we had this ginormous printing of money in the way of quantitative easing, where the Federal Reserve and Bank of Canada, the European Central Bank, Bank of England, etc., they would print money and buy their own bonds to bring the value of the bonds higher and bring the long-term yields lower. So printing all that money, bringing all that liquidity was obviously going to create inflation. And it didn't really create much inflation in 2008. So the central banks around the world were comfortable that they could get away with it. They could print all this money. And, you know, in 2008, 2010, 2012, we really didn't see inflation accelerate. But in 2020 was different. We had supply chain disruptions. We had other issues that essentially, employment shortages, etc., dislocation of capital that caused inflation to skyrocket. And then the Federal Reserve had to go from 0% interest rates to what they are today, and now we're expected to go above 5.3, 5.4% as how high interest rates are going to go. So during that whole period, during the whole interest rate hike period, obviously valuations were going to come down. So the Federal Reserve in 2021 told us what they were going to do. They said, we are going to start raising rates. We don't feel inflation is transitory anymore. And by us raising rates, we also have to remove liquidity out of the market. We have to do quantitative tightening, which is the opposite of quantitative easing. And we have to not sell bonds yet, but not reinvest when those bonds mature, and essentially start letting the balance sheet go down. That was going to be negative for equities. So all you had to do was listen to central bank officials, the Federal Reserve, the Bank of Canada, the Bank of England, the European Central Bank. And when they told you that they were going to raise rates, and when they told you that they were going to remove liquidity out of the market, you just had to get out of equities. And if you were in a long-term equity position, you should have bought put options and hedged yourself against the downturn. But now they've been raising rates because of inflation. And a lot of people ask me, well, Marco, in the past, the Federal Reserve has raised rates and the market hasn't crashed. We saw that after 2004 when Alan Greenspan and eventually Ben Bernanke started raising rates at 25 basis points every meeting, and they brought rates from 1% to 5.25%, and the stock market didn't crash. Why? Because there was no inflation. So when you have inflation, the Federal Reserve tends to overhike to bring inflation down, and that would have economic repercussions. But most importantly, the market didn't crash in the most recent tightening cycle in 2004 because the economy was expanding. So as the economy is expanding, even if there's a little bit of inflation, the Federal Reserve can remove accommodation and the economy can absorb that. The economy can absorb all of that tightening. But this time was a bit different because all of the tightening from the Federal Reserve was being done to bring inflation down. But then the worry was, well, valuations are going to come down, and that's what we saw. NASDAQ underperformed the Dow, for example. At some point, the Dow was only down 6% from all-time highs. Companies like banks would benefit from higher rates, right? But technology companies would be underperforming as rates went up. So the first thing to know is that, okay, which one matters more? Marcos said stocks are the best hedge against inflation. So if there's inflation, shouldn't stocks go up? And the answer is yes. In the long term, the stock market is based on nominal valuation, not real valuations, nominal valuations, which means that if inflation is 10% per year and your revenue is based on selling goods that have gone up 10%, your revenue is going to go up by 10%. And even if your costs go up by 10%, as long as you're profitable, you have a gross profit margin, you will make more money in nominal terms. Your valuation will be higher in nominal terms. So the stock market tends to go with inflation over longer periods of time. But in the short term, as central banks try to fight inflation, they hike rates, and that causes stock market valuations to go down. The big question mark is, when does that discrepancy end? When do we get back to being an inflation hedge? And the answer is when the Federal Reserve and central banks around the world stop raising rates aggressively, right? And that's why over the past few months, we've seen a huge stock market rally, because the Federal Reserve essentially said, we are almost done hiking rates. After we get to 5 to 5.25, we're gonna take a break. The Bank of Canada said the same thing. And that caused the market to feel very, very comfortable about the prospects of future interest rates. And a lot of money went into equities. And there was a short covering rally. And then people felt, you know what, rates are not going to go up anymore, that much more. So I'm comfortable going long equities. And that's why we bought equities near the lows and we held it, because we believed that the Fed was almost done raising rates. But now, the most recent data, especially the PCE core inflation number today, and we have the, if you have MetaStock, Zenith, you can see it on the economic calendar, you can see the data come out in real time. And the PCE core month over month and the PCE core year over year came in higher than expected. Inflation is showing its ugly head again, which means the Fed will have to raise rates further than the markets were anticipating, and that brought equity markets lower. So all you had to do was look at your Zenith platform today. When the inflation data came in higher than expected, you would have just shorted equities, and equities went down, and you would have made any type of money you wanted, right? It was very simple. Higher inflation means the Fed will raise rates more than the markets anticipate. Therefore, equity valuation should come down because of the reasons I mentioned earlier, right? Now, we also got very strong retail sales last week or 2 weeks ago. We also got very, very strong non-farm payrolls report and very strong ISM manufacturing report after falling into negative territory. So all of this data has been coming stronger. And that was a complete shock, because by now everybody thought the economy is just going to slow down. So the Fed will be done raising rates. But now that the economy is not really slowing down, it became a surprise for the Federal Reserve. And now the bond market and interest rate markets are pricing in much higher rates. And that's why now you're seeing that ginormous downtake in the stock market. So you could almost just trade equities based on your outlook for interest rates. And if you look at, and I'm going to share my screen again here. So I want to share my screen right here. So when we look at very straightforward charts, yeah. So when you look at something like NASDAQ, and you guys can see my chart screen, right? Okay.
Yes, we can see your charts.
Okay, perfect. Okay, so when you see what's happening here, this was a period of raising interest rates. So that's where we had this ginormous downtake. Then this is a place when the Federal Reserve said, we're not going to raise rates that much further. And the market was able to rally. Also, inflation came down a little bit, not too much, but the market felt comfortable that that was the case. And now recently, we've now had higher than expected macroeconomic data and inflation that essentially causes the markets to expect higher rates, and that's why the markets come down. So throughout this whole period, the same applies during COVID. When COVID hit, you had this ginormous downtake, and then the Federal Reserve said, we're going to keep rates at zero for a very, very long time, and we're going to print unlimited amounts of money. We are going to buy bonds to support the economy. You could have bought on that day when that announcement came out, knowing that the Federal Reserve was just going to keep the price of money at zero, and that was going to bring all the money to the equity market, and the unlimited amounts of liquidity that the Federal Reserve would print by buying bonds and keeping long-term yields low was going to make equity valuations go up. and we bought the stock market at lows, and we had actually call options with a 3,500 strike price on the S&P 500. And everybody thought we were crazy that the stock market would make an all-time high at the end of 2020. And it was just because of our understanding of how interest rates work. The minute you cut interest rates to zero and you make a pledge to print unlimited amounts of money to bring bond yields lower and increase liquidity, all the money was going to go into the stock market. And that's why we saw that ginormous leg up. This was now a period at the end of 2021 and the beginning of 2022 when the Fed changed its course. And the Fed said, now we're going to raise rates and we're going to do the opposite of quantitative easing. So obviously the market went all the way back down. Then they said, okay, we're going to pause interest rates, and the market went back up. And now they're saying we're going to have to hike rates more than the markets expect. And a few central bank members like Bullard and Mester even said that maybe we'll go back to raising rates by 50 basis points. And now that is clearly why the stock market went down over the past few weeks. So now that's the impact that interest rates have on equity markets. Now, what impact does it have on other markets like FOREX or gold or bonds? So let's start off with bonds, and that's where, that's my main domain as a bond trader. So the bond market, let's look at the 5-year bond. This is the 5-year notes, 5-year bond futures. So this is the 5-year bonds. So 5-year bonds have gone down, yields have gone up as the Fed started raising rates. And that's a very obvious trade. Bonds care about 3 things. They care about what the level of the risk-free rate is, they care about inflation, and they care about default, right? If you raise rates, yields are going to go up, bond prices are going to go down. That is a mathematical calculation. So if you can predict where interest rates are going to go, you can be the best bond trader in the world, because all you have to do is go with the flow. If the Fed is hiking rates, you go short the bond market, especially at the short end of the curve, the 2-year and the 5-year. But if you are expecting rates to be cut, you would go long the short end of the curve. And then you can start playing around with spreads, right? The 10-2-year spread, the 32-year spread. And then you can get into flattening of the curve and steepening of the curve. And that gets a little bit more complicating for people that have never done it. I do spread trades all the time. And, I'm always either on a flattener or on a steepener. And recently, the bond market has flattened because over the past few weeks, with the strong jobs report and the strong PC core report, strong PPI report, and strong retail sales report, the expectation is that the Fed will have to do a few more rate hikes than originally thought. And that was going to cause the short end of the curve, the 2-year notes, or even the Eurodollar futures to go down, Fed funds futures to start pricing in higher rates. And the short end of the curve would move down. The long end of the curve does also cares about interest rates, but think about it. If you're a 30-year bond, you don't really care much about what happens in year 1 or year 2. You still would have 28 years left in your life. So the bond market, the 30-year long bond, cares less about interest rates and more about inflation. So if the Federal Reserve starts raising rates aggressively, the short end of the curve is going to be affected more than the long end of the curve, because the long end of the curve, the 30-year, will say, well, if you, and we can put a chart here of the 30-year bond, say, well, if you raise rates aggressively, you're going to bring inflation down, which will be, and you're going to create a recession, which will actually bring bond prices higher. Bonds love recessions, right? And at the same time with equity, another reason why interest rate hikes are usually bad is because when you raise rates, the consumer spends more to borrow. They cannot really afford the house that they wanted. They cannot really afford the car that they wanted. And there is usually a slowdown in consumer spending. And that also brings equity valuations lower as revenues go down, because the consumer is not all there. Now, we have seen the past few weeks that the consumer still remains very strong. So as the Fed hikes rates more and more and more, eventually it will crack the consumer and will cause a recession. and then the recession, is essentially negative for stocks until the Fed starts cutting rates, and then a recession becomes the best thing that could happen to stocks, because with a recession, you have lower rates. With lower rates, you have money printing. With money printing, you have a big inflow into the equity market, because you are also creating some inflation after that as well. So all the money goes into equities. But going back to the bond market, understanding the difference between the short end of the curve and the long end of the curve is very important. And during an interest rate hiking cycle, you want to be short the short end of the curve more than you would the long end of the curve, even though the long end of the curve will still go down. And during a tightening cycle, an easing cycle, you want to be long the short end of the curve more than the long end of the curve, because the curve will steepen, right? That's another thing, that understanding the 10-2-year spread is very, very important. The difference between the 10-year bond, the 10-year note, and the 2-year note is also one of the most important things that you can learn about, because every time the difference between what a 10-year bond pays you and what a 2-year note pays you matters. Look at this period right here, 1989. Yields on a 2-year note were higher than yields on a 2-year note. The curve was inverted. What happened in 1989? We had a market crash. Then rates were cut. Then rates were hiked to the point where in 1998 we had an inverted yield curve again. And what happened then? We had a huge crash. Especially in 2000, we had an inverted yield curve right here. And then we all know what happened a few months later. We had a huge crash in 2001. So 1989, it preceded the crash. 2000, it was able to forecast the stock market crash. 2007, the yield curve was inverted. A few months later, the market crashed. And now, this one is interesting. 2019, the 10-2-year curve was inverted. I guess nobody could have predicted COVID, but 10-2-year spread predicted it somehow. And he knew for some reason that the market would crash, and it did. It was able to forecast the 2020 crash, which is crazy, right? And then in 2022, the curve is massively inverted. Now, this massive inversion means that you get paid more by putting your money in a short-term bond than you do putting your money in a long-term bond. And that is not sustainable. You cannot have all this money parked in cash, getting all this interest, because then money doesn't go and gets invested. It doesn't go for hiring workers. It doesn't go for buying machinery. It doesn't go for buying anything. It just sits there. And by money sitting there, getting all this high interest, it causes a recession. Also, it's very, very expensive for consumers to buy things, and that causes a recession. And people start getting laid off, et cetera, et cetera. So it's just a matter of time before we have a recession. A lot of people are saying, well, with the yield curve inverted to this magnitude, 1%, why have we not seen the craziest recession of all times? To be seen. We might have the craziest recession of all times coming up. We might. And usually it takes about 6 months to a year before the 10-2-year spread inverted turns into an actual recession. It was already supposed to happen now. It hasn't happened. The labor market is strong. Consumer is strong. Why hasn't it happened yet? No one knows. Could be many reasons. But if one thing history has taught me is that there is such thing as a double dip recession, there is such thing as a double dip expansion. Are we in a period of denial where the economy all of a sudden didn't turn out to be as bad as expected based on all the tightening that the Federal Reserve has done? But now everybody's in denial. Are we going to see rates go all the way up beyond 5.25%, 5.5, potentially 6%? And what damage will that do to the economy? What damage will that do to the financial markets, given the amount of leverage in the system today? Everybody, every company, every individual is leveraged because rates were at zero for 2020 and 2021. money was printed in the trillions and trillions of dollars, handed out to banks to lend to non-financial institutions. There's been tremendous amounts of leverage built into the system. And as rates rise above what most people thought was the ceiling, 5.25, which was the rate that we reached in 2008, before the biggest financial crisis of all times since the Great Depression of 1929. Are we ready for a ginormous crash? And that is to be seen. And how will we know? Well, the bond market will know, right? Right now, the bond market is telling us higher rates, higher rates. The bond market is going down, is going down, is going down. Look at the yield on 2-year notes. It's skyrocketing. We are going to get to levels not seen since 2006, 2007, when the whole housing market crashed. Again, because of subprime worries back then. Issues. We don't have subprime issues, we are told. But could there be other leverage issues? And the issue with rates increasing this high is that people that are over leveraged are going to have a hard time meeting those interest payments. People that are over leveraged are going to have a hard time. They're going to have to start selling assets, or there could be a liquidity crunch. So as you're seeing rates skyrocket, it is negative for the stock market. Okay, and that's why the stock market has been on a massive downtick recently, because rates are just now expected to move higher and higher and higher, right? Rates are expected to move higher and higher and higher. The original expectation was that the terminal rate was going to be 5.25, and now we're talking about 5.5 potentially. And some people are even thinking we could maybe even go to 6%, right? So when you have interest rates going up more than expected, it is obvious that you will have a huge market correction. It is complete obvious that you will have a huge market correction. And for that reason, it's very, very important to understand not only the yield curve, not only interest rates, but also, where are bonds going, and with the implications for other markets. Now, what other markets get impacted by interest rates? Well, an interesting one is gold. Essentially, gold doesn't like high interest rates. Gold is a type of market that competes with money. When gold goes up, and sorry, let me put the price of gold here on a daily chart. When interest rates go up, it becomes expensive to own gold, because you have to store it, and they're going to charge you money to store gold. But most importantly, you could sell all your gold and put all your money in a bank account, and it will pay you 4 to 5% today. So why would you keep your money in gold? So it's very expensive to keep gold when interest rates are high, because it competes with money. So it is normal that during 2022, as rates were going up, the gold price would go down. And as we kind of stop this idea that rates are going to go further than 5.25%, then the price of gold was able to go up. But now we're back to higher interest rates, so the price of gold is going down. So you could essentially trade gold based on your outlook for interest rates. When interest rates are low, you want to be long gold. When interest rates are high, you want to be short gold, right? And when the expectation is that interest rates will go higher, you want to be short gold. When the expectation is that interest rates are going to be lower, or that interest rates are going to be cut, you want to be long gold. Now, gold is also traded in US dollars. So half of the gold trade is the US dollar trade, which also is impacted by interest rates, right? The US dollar will go up when rates are going up, and the US dollar will go down when rates are going down. The reason why, and this is the US dollar index, the reason why the US dollar had this tremendous run up is because the Federal Reserve raised rates. Higher interest rates are good for the US dollar, because people put their money in US dollars to get that higher rate of return, right? You're not going to get US dollar interest rate if you don't own US dollars. So you're going to put your money in US dollars and you're going to get that high rate of return. But the same applies when interest rates go down. When interest rates go down, everybody takes their money out of the US dollar and puts it in currencies that pay a high rate of return, or in other areas like the stock market, etc. And that brings the US dollar lower, right? So the US dollar is heavily influenced by interest rates. And as you can see, the US dollar went up when rates were going up. The US dollar went down when rates stopped. We're not expected to go beyond 5.25 when the Fed said we're going to take a little pause. And now that the conversation is back to hiking interest rates beyond what we originally thought was going to be the terminal rate of 5.25%, now we're thinking, oh, how much further will the Fed need to go? Well, that's causing a breakout in the US dollar index. And finally, Bitcoin as well. Bitcoin is essentially the type of currency, the type of digital asset that will be impacted by interest rates. When Bitcoin prices were skyrocketing in 2020, 2021, the main reason was that money was free. So people could essentially borrow money at zero and put it all into Bitcoin, right? And I'm sure a lot of people did that. But interest rates were low, so asset values like Bitcoin would go up, not only because the price of money is cheap, but Bitcoin is a competitor to money. So when the price of money is cheap, you would want to put it in an asset that would appreciate in value, such as Bitcoin. But also quantitative easing, the idea that the Federal Reserve printed money to have nominal yields lower and buy long-term bonds is also positive for Bitcoin, because the more money is printed, the more the value of the US dollar goes down, and Bitcoin is a hedge against the devaluation for the US dollar, because Bitcoin, unlike the US dollar, is a limited supply type of digital asset. There is only a limited amount of Bitcoin that will ever be mined, and there won't be more. So the fixed supply of Bitcoin makes it very, very appealing when rates are low and when the Federal Reserve is printing more US dollars, because you're buying a fixed supply asset like Bitcoin and gold, and you are selling an asset that is just growing and growing and growing and growing and growing and growing, and the supply is increasing. So Bitcoin is very vulnerable to changes in interest rates. And we saw that at the end of 2021, when the Federal Reserve hinted that rates needed to go up, well, Bitcoin started crashing and Bitcoin started going down, because the lower rates go, the higher rates go, the more negative it becomes for Bitcoin, right? So that is essentially, how Bitcoin is affected by interest rates, how the US dollar is affected by interest rates. And I think I have a question. And Jeffrey, I don't know how much time I have, but I think my time is up, right?
You're getting, yeah, it is. But we do have, I do think it might be a good opportunity to say, what is the website and how people can find out a little bit more about you and what you do, Marco?
Yeah, for sure. So so my website is iotaf.com. So IOTAF.com, Institute of Trading and Finance.com. And we go hand in hand with what the guys at MetaStock are doing. Essentially, we provide the education that shows you how to use all of the tools that they provide, the news, especially the macro, the technicals of the charts. So if you don't know how to use half of the stuff that they provide, it's because you don't have enough education about how to use this stuff. So if you go onto our website, you could sign up to our program. It's a 12-month program, and you get access to our Agora education platform. And the best trader would have Agora and one of the products that MetaStock provide, because those are the tools that we use to trade. All of our traders use those tools. So once you get the education to learn how to use those tools, then you're an invincible trader, because with amazing tools and an amazing knowledge and good risk management and good psychology, you can become a very good trader.
We have a number, like here's just a couple of the comments you got. Camilla says IOTAF student. Bravo, Mr. Gomez. Enrico said also he's a student.
Right.
Leslie says proud IOTAF student 100. And then Z says macro. And then I think a bunch of donkeys. I don't know what those are. Let's see. Anyway, great class today. Do you, one last question, and then we got to move on. Brian wants to know, do you teach how options markets affect indices?
Oh, 100%. And you know what? I mean, I could speak for hours. The options markets are driving equities and equity futures. There is trillions of dollars in short expiry options. We are all over them. We love them. We love those bets. We make those bets every single week. And there's essentially all these crazy bets that you can make where you could get a 10x on these options overnight. Yeah. So yes, we do teach that.
Cool. And then the website, again, we put it in YouTube and we put it also in GoToWebinar. It's IOTIAF.com. Marco, we'll have to have you back. Thank you.
And great webinars, by the way. My students have been joining them. Amazing initiative from you guys to do it. This is great for putting it all together.
Yeah, another great lesson. I really appreciate you spending an hour with us. I really feel like this has been a great side. So,
and you know, people should know that Zenith is the best way to get Reuters for a very, very good price. I used to pay $3,000
for Reuters. Oh wow!
Yeah,
okay.
Yeah. I only used it for headlines and data.
Okay. All right. Well, cool. Well, great to see you, Marco. Thanks for coming in. We'll have you in again soon.
Thank you very much.
All right. Cool.
Bye.
We're going to do this. All right. And we're kind of wrapping up today. Let's thank Stocks and Commodities for sponsoring the events today. Stocks and Commodities has always been a really good sponsor and supporter of the conferences. We sure appreciate them. We'll talk about that again after Ken. Also, another big, huge thanks to cmtassociation.org. And one thing that I do want to highlight is an offer that we did with Jake Bernstein just earlier this week as one of our conference offers. He's got a great collection of technical systems called Setup and Timing Triggers. There's about 7 different technical systems in there. It's $399 here at the conference with a money-back guarantee, a free trial of MetaStock if you need it. Just one of the additional really cool offers we're doing. If you don't have MetaStock, you want to try it, here's the information for a 30-day trial. Now, I need some help from the YouTube group or the GoToWebinar. This is very important because it's going to be the final prize of the day. And so what I want you to do is give me a number between 1 and 13,088. And while you do that, I'm going to tell you what you won, and then we're going to get on to the last speaker. So Gordon says 74.25. Okay, maybe that's the one we'll go with. All right, so the next prize, the last prize, the final prize for the conference is MetaStock. We're going to give you a 3-month subscription to MetaStock real-time. As I've mentioned, maybe a couple times, maybe once or twice, it's won 30 years in a row the best software in its price category. I love the scanning. I love being able to scan markets and finding the opportunities that exist in the market. You can test trading ideas. You can forecast probable price moves with our patented forecaster. You can get real-time alerts, signals, and commentary. So you're going to get that. We just barely talked also about how Zenith is an awesome news platform. They spent $1 billion on it. It's supported by thousands of journalists in 200-300 different news bureaus. Fantastic technical data, fundamental data, macroeconomic data. You'll get that as well. We're going to throw in learnmetastock.com. Kevin Nelson started us off today and he showed you all those good videos about how you can use MetaStock and technical systems and all that kind of stuff. That's going to be included as well. We're going to include Unleash Your Power MetaStock, which is a $99 training disc. It's not on a disc. It's all online. It comes with a workbook. It's going to help you out with it. We're going to have somebody sit down with you, answer questions, help you with any problems you might have. All that's going to be included. It's a very, very valuable prize. And we're going to go with Goran's answer here, 74.25. So the winner, let's find out who that is. Real quick. It is Doreen S. Doreen S. in the USA, who has a Comcast address. So Doreen, congratulations. We'll be reaching out to you to take advantage of that prize. Congratulations on winning. So without further ado. Ken Calhoun. A lot of charts. Sometimes he does a little bit of. Oh, are you sure? Well, that's interesting. Let me go ahead and. Actually, I almost made you the presenter. Let me make Ken the presenter instead. All right. Hey, Ken. Let's see. Let's get you in here. Yeah, let's make you the presenter. Ken? Hello, Ken. Can you hear me? If so, it's your turn. I can see your screen, Ken, but I can't hear you. So we're halfway there anyway. Let me go ahead and do this. Oh, how about now?
Hello. Hey, how you doing?
Success.
Yeah. Hey, Jeff, how you doing, man? Hey, can you see the MetaStock screen with all the great MetaStock charts on it?
I see a bunch of beautiful charts, yes.
All right, and let's see if you can see my smiling face here with the green screen in the background.
Yeah, I can see your smiling green face. And you know what we
My
need to
green
do,
face.
Ken?
What's that?
We need to get you.
You need to get Zoom, but okay, never mind.
No.
Never mind.
Well, maybe. We need to get you on 18. We just released, like about a year ago, a brand new charting engine. And
Okay,
it's awesome.
great.
I'll help you get it on.
Okay, and also what I need to do is work with some of your developers so I can develop a breakout add-on for MetaStock. People have been asking me about that for years. So anyway, maybe you and Kelly can connect the dots with me with one of your developers and we can do it. Anyway, let's move on. I know everybody's eager to get started. Let's get underway. Is there anything you wanted to say or?
No, the floor is yours. I'd love to talk to you about an add-on. We'll take it into next week. We'll talk about
Yeah, I'm serious because that's something that would be a good way to connect the dots. All right, traders, well, welcome aboard. All right, I'm Ken Calhoun from TradeMastery.com. It's a pleasure to be here. Great to work with you. You guys, let's look at your charts. That's always my favorite way to teach is answer questions about your favorite chart. So if you would, type in some tickers of stuff you like to trade. All right, type in tickers of what you want to trade. We're going to take a look at some charts here in just a minute. Was anyone else trading cold on its run up? It did such a good job for me. I bought 21 and I sold 63. And look at these beautiful charts. So this is one of my best swing trades. I think my second best swing trade ever. My best swing trade was I bought TVIX at 54 and I sold 940. This was my second best swing trade ever. I bought 21 and sold 63 in KOLD, the natural gas inverse. Hit me up with your guys' tickers and I will pull those up. What are some tickers that you guys would like to look at? And I will go over them with you and give you some tips and strategies for how to use these great MetaStock charts to identify the best breakout charts out there. Let me establish some credibility first. I did $124 million worth of trades last year. Anyone else in the world can do that? I'm a real trader. I'm not a guy who just blah, 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 blah talks. Are you guys tired of people who pretend to be trading experts, but there's no 1099 proof that they actually even trade? Here's proof. It's my Fidelity 1099. I covered up my social security number and all that kind of stuff. But you can see cost basis. I did $124 million worth of trades, real money trades last year. Who else in the entire industry did that much trading? My point in bringing this up is, I know I've got a lot of experience and a lot of lessons learned. I've made every mistake in the book and a few hundred new ones, I'm sure. And I've made a lot of success too. I have really big wins. The difference is what I base my business on, okay? The difference between how to not trade and how to trade. So I'm a guy who really trades. So I hope that gives you some sense of comfort in working with me. I'm authentic. I'm the real deal. In today's session, we're going to look at how to trade winning gaps and breakouts with MetaStock charts. Bum, 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 bum. So does that hopefully establish a little credibility? A little bit. The guy did 120. I did actually 124 million. Last year, I did 41 million. So I did even more. I was a maniac last year. It was such a good year. It's a good year to trade. So I did 124 million worth of order flow, thousands and thousands and thousands of trades. Anyway, it's fun. I enjoy it. Years ago, I used to show I did 5 million in trades. This was back in 2010. Now I did 124 million. So you may have seen me in Stocks and Commodities magazine. You may have seen me in CBS Market Watch. You may have seen me as a featured Traders Expo speaker. Blah, 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 blah. Calhoun, get on with it. Now, do your trading losses make you say, "Oh," you get upset? Well, let's figure out the difference between how to actually really trade and do well with it, potentially, and everything else out there. The main thing is, and let me ask you guys a question before we jump into the charts. How many of you, it's just one of my pet peeves, and indulge me, but how many of you, show of hands, agree that it would be good to require trading educators to actually show proof that they're actually real traders? I mean, it's amazing to me. You guys probably trade more than your favorite educator, by the way. Most of those people are just internet marketers who pretend to trade. I think there should be some regulation or some kind of certification or some hoops that educators have to jump through to prove that they can trade, that they can trade profitably, and they don't have to do 124 million worth of trades, but at least a few thousand a year, right? All right. Anyway, let's see. Jeff, can I ask, can you please solicit from both the YouTube stream, which I don't have access to, and here, get tickers from people that want to learn how to trade, and I will indulge those. I will cover those charts. I don't want to just cover. I'd rather cover your guys' charts than my charts. So. Okay, let me start off just with this one as a good role model, and then we will jump into them. What are some great tenets? One thing is buying for swing trades, and that's what we're going to cover today is swing trading. Trades that last from 2 weeks to maybe 8 weeks, a couple of weeks up to a couple of months. Go in long over multiples of 10 is a good idea. For example, here I waited till 21. I bought KOLD at 21, and I sold it just about a month and a half later at 63. I tripled my money, and this is in my Interactive Brokers account. I've got accounts with several different places. I like Fidelity best, but I used to use IB all the time, and I still have an IB account. So I bought 21, and I sold 63. Now that's great, but who can tell me what's this candle signal that told me to sell? I can learn candles from Steve Nissen, my colleague. But anyway, this is a shooting star, right? When you wish upon a shooting star, you sell that punk when it loses that. And besides, I made so much money, I thought, take the money and run. I did not expect it to keep going up, by the way. I thought that was kind of it, the 63, 65, and it drops. Now, how did I know to trade? This is a simple bullish cup, and it was over a 20. So what I'd like to do is I combine price action triggers, like going, for example, when I day trade, I go on long right above whole numbers. For example, like BOIL. I was trading BOIL a lot earlier, a few weeks back. You might go in like right over 5 and then sell right under 6, right? Or if you're looking at charts that have good price action for swing trades, go in, say, above 20 and add or scale in every, several dollars. So that's one thing to look at. Now, another thing to look at is the height of the whole real body candles. Oftentimes you get kind of an explosive top. When you've got a chart that's had a steady string of small candles going up and up and up, and that's great, but then you have a blow off top or large candles that have a sell signal, that's usually your great place to exit. So newbie traders might have bought here. I sold here, well, right here, because we had a shooting star, and it mainly because it'd been going up for so long, and I knew it was kind of ripe for a pullback. So that's one thing to look at. Now, let's Jeff, can you give me a ticker? Somebody get me a ticker. Okay, Transocean. And that would be, is that rig.watt in the list here? There's plain old rig, and then there's rig with a bunch of things after. Let's see if plain rig will do it. Okay, that's one of the oil sector stocks. Familiar with it? So let's deconstruct this. First of all, Is it worth trading in the first place? Absolutely. Well, yeah, here's one of the most important things you'll learn from me. There's a lot of them. The most important is range is critical. The most important part of the chart, hint, this is very important. You guys write this freaking down and understand it. I did over 120 million worth of trades last year. The right side of the chart, paradoxically, is more important than anything you see in the body of the chart. The right side of the chart, ask any professional trader, the range is more important than anything. So the first thing to do is qualify whether or not the thing is worth trading in the first place. Step number one, is the range at least a 30, 50%, preferably a double or something? And this is, the range is tradable, 3.5 to 7 or 8. So it is, in fact, a tradable instrument. Now, if the range had only been 4 to 5, the risk reward is no good. So even if the chart looks wonderful, if the range is crap, if there's a compressed range, you're not going to make enough money to make it worthwhile, okay? And there's a flip side too. You want things that are 20-point ranges. What was that one? LUNR is a good example. I played the bounce, or I made bounce calls for my traders in my live room, and LUNR was buy 57, sell 61. And anyway, it went from like 100 down to 20 or something. So that's kind of too much range, but you do want enough range to make it profitable. Now let's take a look at this chart. Is this worth trading here? So the first thing is it a tradable chart? Answer would be yes. Second question is it tradable here? Of course not. It's a horrible place to enter. If it takes analyze later, yeah. But let's deconstruct the trade. How could you have known that this would have been a good trade to get into? Just briefly. The first thing you look for is obviously a break above resistance. So if you have a cut pattern or an ascending triangle or any trading 101 type thing, that's how to get the party started. The most important lesson learned I've had in doing tens of millions of real money trades is you start small and then you snowball, or you position size. Like my colleague, the late, great Van K. Tharpa would tell you, position sizing. So you start small. Whenever I do a swing trade, I start with under $1,000 of the underlying instrument. So for a $5 stock, that'd be what? A couple hundred shares. I wouldn't be buying 1,000 shares. So I start off with $500, maybe up to $1,000 worth of that instrument. And then if it seems ridiculously small, like maybe doing like 30 shares of a $30 stock. It's like, why bother? Well, I martingale up. I always said, and reverse martingale. I double down every 2 or 3 points. I might start off with, say, 50 shares. The next trade is another 50. Then the next trade, though, is 100. So now I'm in 200. The next would be another 200. Then now I'm in 400. And then I just usually increment up from there. So that's how you start small. That gives you a chance to trade often. Like my colleague, the great Tom Sosnoff says, trade small, trade often. And that's exactly the right way to trade. You want to throw a lot of freaking darts at the market and have the ones that don't stick not cost you much. I would much rather take, my average stop loss cost on day trades is always virtually always under $50. They may start off with like 500 shares, but with a nickel stop or something. So I'd much rather take, say, 10 $50 stops. I'd much rather do 10 $50 stops than one $500 stop. So I have 10 chances to get it right. And each trade should be seen as like a seed that you're planning to get in. All right, let's get another ticker. I don't see any tickers in my chat. Which one? Okay, thanks. Not familiar with that, but Kameko, okay. Kameko, okay. So let's see, first of all, is the thing worth trading? Now I'll go through these quickly for you guys. I'm not gonna bibble babble on. Let's see, first of all, is it worth trading? 20 to 30, sure. Now this highlights yet another rule of trading that I've learned professionally over decades. I was one of the original .com day traders back in the 90s. I founded Day Trading University. I had a lot of copycat punks who came up with their own university type. I'm the original Day Trading University. Anyway, the point is, this highlights, if you followed me for any length of time, you know what's one of our cardinal rules? Don't buy nines. This is why. The neat thing is, what I teach actually really works. Test me out. Apply what I teach. You may have seen my articles in every single month of technical analysis of stocks and commodities. The 10 o'clock day trading reversal is on page 6 of this month's issue. I do the trading on momentum column. It's a real honor and a privilege. I wanted to pick up where Don Bright left off when he unfortunately passed. And so I've been a columnist for years for stocks and commodities. And you should read it. And trust me, you should subscribe to Stocks and Commodities at traders.com if you're not already there. And download all my articles and memorize them, because I'm a real trader. don't buy nines. Anything with a 9 in it, you sell, 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 sell. Ding. Johnny, tell them what they want. A new SUV. No, everybody wants to get too much price right. You sell nines, right? This is a good example of a chart. So this is what pops out of the lesson learned. Always sell a 9. Never, ever, for the rest of your life, buy anything. Never purchase anything with the number 9 in it. 9s are targets where guys like me are selling to you guys at the 9, right? I may have bought the 22, the 24, and sure enough, I'm going to tighten up a trailing stop when it hits the 28. If it goes up 29, happy days are here again. Trailing stop at 28, then right under the 29, and sell it as soon as it fades to 29. So that's the one thing that jumps out to me on this chart. The other is one of my favorite patterns that I developed. Other people have copied, but at the right side of a bullish cup, a large green candle is a good buy signal. And I've been teaching traders that for over 2 decades. Certain other people have ripped off my techniques, but that's okay. They're lamers. They can't prove that they trade like I can with $124 million worth of experience last year alone under my belt. Okay, I'm serious. I know how to trade. All right, next ticker. So don't buy 9s. You guys should honestly write these down and test it. Test out what I say. And you'll say, oh yeah, he's right. The proof is in real trades. All right, next ticker. Occidental Petroleum, a Warren Buffett favorite. Another oil sector ticker, and we will take a look. Oxy's been in a drop the last couple of weeks, eh? From what I recall. I know the market like the back of my hand. Actually, better than the back of my hand. Yeah, OXY has been selling. So what would the question be? One would short this punk under 57. By the way, I'm the guy who called Tesla short at 811 2 years ago. I said to short that punk at 811, and now it's down at 100. Trying to climb back up over the 100. I said short Tesla back at 811. Anyway, this is a short chart. I would fade this. I would short this punk under 57. Under no circumstances would I buy Oxy. I would be a seller of this instrument at support. And that's all I have to say about that. It's a horrible looking chart. I would never be long in a million years in this. Price action is all that matters and risk management. So we sell it there. All right, next ticker.
Sure, QQQ.
Okay, well, if you look at our Qs, I like to trade SQ. I'll do one better. I do SQs. Which ticker would this be in this list of a lot of tickers here?
I can't see the list, but if you're looking for the Qs, it's QQQ.O.
Okay, thanks, man.
Yeah.
It's hard to tell if it's the .O or the .K. Okay, .O.
One of the questions that came in, these are daily charts that we're looking at, Franklin.
Right, these are dailies. Okay, let's see if I can get this pulled up for you guys. Okay, so that's our Invesco Qs ETF. I like day trading the S triple Q versus the T triple Q. Here's another quick advanced technique. Instead, the Qs are not worth trading. You'd want to trade either the T Qs, your leveraged long Qs, or the short Qs, the S triple Q, because there's better leverage. For example, take a look at this range, 260 to 310. That's cute, but if you want to play your Qs, you want to play TQs. Not only is it cheaper, same chart pattern, eh? Same chart pattern, but look at the far superior leverage in your TQs. So you never ever trade the underlying index ETF. That's stupid. What you do is trade leveraged ETFs. That's what professionals do. So you would never trade the Qs. That's a dumbass thing to trade. You trade the T triple Qs. I'm not insulting you personally. I'm just educating you guys. No one tells traders these kind of things. So for experienced trader would tell you, why would you hit the Qs when you can do the TQs? So you get triple or whatever the leverage. So the range here is 16 to 28, almost double your money. If you caught the bottom, you can buy 17, sell 25 or whatnot. Anyway, what's this chart telling me? Absolutely nothing. They don't know what they want to do. It went down, then it went up, then it went down. Who knows? Why would I trade that when I could trade something like KOLD that's been going up like this? Or now BOIL. Let me give you guys one of my favorites right now is BOIL. Which one is that? Oh, here we go. Okay. BOIL.K. one of my favorite instruments for a pivot lately. I was trading cold. Now I'm looking for a bounce in oil. Now, does it look like a bounce yet? Not quite. But what's the redeeming feature of this chart? The huge range. Now, if you're considering a bottom fishing play, one of the first things you want to do is, like when I correctly traded cold, that had been going way, way down, and I caught the pivot and I sold on the way up. Same thing here. When something has crashed severely, it's gone far, like from 24 down to 5 or 6, this is not worth trading yet. What we'd want to see is large green candles and a breakout above. Not a trading recommendation, but say over the 7 or the 8 or whatnot. So this is one that's on my radar for a play to the upside if it bounces. And so anyway,
it's come up a lot this week too.
What's that? I'm sorry. What did you?
A lot of questions about UNG this week. It's come up quite a bit.
About UNG?
About natural gas in general. Yeah.
Oh, okay. Yeah. Well, I was trading cold until it got to 60, and it was 65, and I sold the pullback at 63. Natural gas, I'm wildly bullish in oil. That's one of my favorite instruments, by the way. Remember I said that when it's back up at 20, okay? And again, it's not a trade recommendation. Consult with a registered investment advisor. This is for educational use only, but long boil on any bounce. Just like I called cold correctly, I think KOLD is extended. That's the inverse nat gas. This is the long nat gas, which has been crashing and burning. I think they overdid it. I mean, let's take a look. What do you guys think? Do you think they overdid it from 140 it was just back in June to 5? That's a little extreme. And if you take a look at KOLD, which is one way I started the broadcast off today with, that's one that I bought over here. See, look, it looked horrible back here, right? It looks awful. Why would you ever consider buying that, Calhoun? Well, I knew how to triple my money, baby. I'm a trader, so I bought 21 and I sold 63 with P&L proof for real money trade account, my interactive brokers account. Anyway, it looked terrible. I nailed that. All right. What I want you guys to look for is the flip side of that, which is the Boyle chart, because it's been doing the opposite. Okay. All right. Next ticker. Or any questions? Any good questions about risk management or pattern recognition?
He wants to know if you trade options mostly.
No, I trade stocks and ETFs mostly, exclusively. No options, no futures, no Forex. I'm a stock trader. Mostly, actually, I'm an ETF trader. I like ETFs like this because what's one of the big advantages of ETFs? A big, huge advantage is no gaps, no earnings misses, and it's got a 20-point gap against you because of an earnings miss or whatnot. So if you've ever been on the wrong side of that, I remember when I bought Oracle at like 31 back in 2001, I think the year, 20 years ago, I learned that lesson the hard way. And I've never held into earnings since. I bought at 30 and the next morning opened at 15. I lost hundreds at like $600 on the one trade. Pissed me off. How many of you have ever held something and it gaps against you and you get pissed off or disappointed? Me too. So ETFs don't gap nearly as much because there never is going to be an earnings miss by their very nature. So ETFs I like best, and then individual stocks for breakouts and gaps. Next question.
John is hoping you can talk a little bit about your exit strategy.
Absolutely. Exits are everything. I use candles. I love me some candles for pivots. Now, this was a shooting star, but I held steady in this because it was still above the previous support there. So, but the first major shooting star was here, and that's why I sold. And still looked like a strong uptrend, so I didn't punk out right there. I was going to give one more day to bounce, and it did, so I stayed long. But this one, I sold. So whenever you see a shooting star, or you see a bearish engulfing, a red candle wrapped around a green previous candle after an uptrend, or tweezer top, I often use candles. The other exit strategy I use is selling nines. And one of the more important things to remember, you may have seen my stocks and commodities article on this, is use the 2-day high and low to scale in or out, meaning today and previous day. So, for example, if the ranges are like this and I buy up here, my hard stop's going to be right there. So that's the number one exit strategy. You don't have to sell it all, but scale out on the loss of a 2-day aggregate support and scale in on a breakout that holds at the end of the day. You buy, by the way, to add to a winning swing trade, I add any time, but mostly I make my decision as to whether or not I'm going to keep my shares at the end of the day. And if we end at a price that's above the previous day's high, I want you to keep that. That's a green light. If it ends inside the previous day's range, that's we don't know, we'll leave it alone. But if it ends the day under the previous day's low, thou shalt sell some of those shares because that trade is effed up, all right? If you lose previous day's support, don't sell it all, but if I'm in like 500 shares, I might sell 200 there, okay? Or in a breakout, if I'm in 500 and it ends the day up there, I might add 200 shares kind of thing. All right, next question.
Let's go ahead and jump to PAAS.
Sure. PAAS.
And John, while we're kind of loading up that one, John wants to know if you have specific position sizing rules.
Yeah, there's many that there's a legion. This is a horrible chart nobody should trade. Next.
Okay, sure. VIPS, VIPS. Tell us how you really feel.
I'm always honest. If nothing else, I'm a straight shooter. So,
well,
you guys don't take anything personally. See, I like to trade charts that go up because I like to go long. I don't like to swing trade shorts. I don't want the infinite risk of, hey, Microsoft offers a buyout offer for that, and your whole brokerage account's blown up. So I don't ever hold anything overnight short. I never short. I just buy long. And I don't like to buy things that are going down because that means people are selling it. So I like to buy things that are going up because people want more, like the cold, until they don't. All right. Oh, by the way, the best chart is like this, where you've got a clean, focused 45-degree angle breakout in a tight channel. The tighter the channel, the better the chart, as opposed to what I call caterpillar charts that are loopy, which one is something that's like you have a fancy ass Mont Blanc pen, and you draw a nice sharp line or a Sharpie mark or whatever. So if it behaves itself in a tight channel like that cold chart, right? I nailed that one, tripled my money in that trade. It was wonderful. I bought 21, I sold 63. Exactly. No, actually, I think I bought 21.60. So almost tripled my money. Nice clean channels and a 45-degree angle uptrend. Don't ever consider trading the stuff crap that's going up and down. You're just going to lose your money. You want to trade stuff where the odds are clearly in your favor. Kind of like if you're playing blackjack and you want to, let's say you've got 8-3 and the dealer has a 6. That's a good setup, right? You've got 11, the dealer's got a 6. You're going to double down, right? If you've got 16 and the dealer's showing an ace or 10, you're screwed and you surrender, right? All the blackjack. Now I played in Hold'em. I won my first Hold'em tournament in Vegas 7 years ago, and now I'm a poker player. But I used to play blackjack, and the point is, do it smart. Play the hands with the correct odds. Okay, let's take a look at this chart. It was good. Now it's no good. So if it breaks 1650, maybe good up here. This is a downtrend. It'd be a short down here under 13 would be the more likely thing. So not a trade recommendation, but I would short say 12.8. I'd go long over say the 16 and 1660 or so up here, but I'd leave it alone here because this is selling. It had been bought. One of the common patterns is a mean reversion pivot where something runs up like from 5 to 10, comes back down to 7, and then bounces. That's usually a good setup. Little tiny minor pullbacks you don't touch with the 10-foot pole because that's maybe the beginning of the end. Bum, 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 bum. So you want to stay away from that chart. Next up. I've got a question or a ticker.
I was going to give you, I'm starting to give you both. Priscilla wants to look at GDX, and Franklin wants to know what large green candles tell you about the market.
Well, increasing buying. What you always want to look for is an increasing ATR. You shouldn't need an ATR indicator, but if you do, you want an increasing range. So here's one of my favorite patterns. Let's see if I can find an example here. That's not quite it. That's a doji, so that's not good. But what you want is a small candle followed by a larger candle in an uptrend, and then a buy above that's usually a good bet. Let's take a look at our gold here. GDX again. First of all, is it worth trading? It's got enough range, barely 20 to 34. It's okay. It's not great. The range is good, but that's a horrible chart. It's going down. How about let me make a unique suggestion. How about charts that are up at a new high? Things that are actually going up that a professional trader would actually touch with the 10-foot pole. Don't ask me about crap that's in the middle of a chart. I would ask you to please refrain from asking about questions about charts that aren't worth trading in the first place. If it's down in the middle of a range, why on earth would you consider trading? No. Just say no. That's a horrible chart. Give me charts that are up at a new high. That's what professionals trade, okay? Trades that are in the middle are what amateurs trade. Professional traders trade stuff that goes up. Amateurs, not so much. So I hope that's a not a rude awakening, but an honest question. So ask me about tickers. And this time, guys, how about things that are actually going up? So let me rephrase the question. Hit me with your tickers, anything, as long as it's currently up at a new high on the chart, okay? So any tickers with that? Groundbreaking, revolutionary idea. Buy stuff that goes up. I'm not being a smartass. I'm just trying to help, right? You guys have to figure out that I've learned the hard way what's worth trading and what's not, and how to trade it correctly. You want to trade things that are incrementally going up in a steady uptrend and a nice tight channel. That's easy. That's an A chart. Crap like this, it's chopping around. Why would you trade that? It's like, well, I don't know. It's like going to a restaurant and getting the worst thing on the menu instead of steak. Do you want steak or hamburger? Steak or hamburger? Seafood? Do you want lobster or leftover stale shrimp? I mean, you know, what tastes the best? All right, next ticker or question.
Jack wants to know, on your day trading, what time frame are you using?
I use 1 minute charts, and I trade usually within 8 to 15 minutes for most of the trades. They may last up to 20 minutes, but I use 1 minute charts. How about tickers? Does anyone have some other tickers? At this time, let's pick things that are actually going up. Just a wild idea, but we kind of tend to want to trade things that are in an uptrend. So with that as a humble request. Namaste.
Let's take a look at SGN now from Gene.
Okay, what's it? SG?
S, Sam, G, George, M, Mary, L, Lima.
All right, thank you. Sarah, Gulf. Okay, that's going to be the O. So, okay, let's take a look. Let's take a look. You guys are going to make me play blues on the saxophone if you keep giving me horrible charts like this. How about another ticker? Why? I mean, somebody help me understand. Why would anyone trade something that's choppy and a sideways thing? Do you really want to lose money on purpose, or do you want to make money?
Let's try RRC.
RRC?
Mm-hmm.
Maybe I
this
shouldn't
was
ask
for
you.
you too.
Okay, RRC. Thanks, guys. Range resources. Now, I'm not attacking you guys personally, so don't be like little babies and cry like a baby, but next. Okay, let me give you guys a quick tip, okay? Something like, you might want to trade things that actually go up. See, that's a trader's chart. See, something that actually goes up. Something that's chopping in the middle of a range should not be touched with the 10-foot pole. One thing's with wide range, wide profit potential, and a relatively consistent uptrend. Anything less than that explains why you're not making as much money as you want as a trader. If you want to make money as a trader, trade stuff that goes up consistently. I don't know if that's revolutionary or not. Okay, any questions? You guys feel free to call me a wise ass, but you know, I did 124 million worth of trades last year. You guys might not have. I'm just saying. I'm a guy who knows how to trade. So with proof. All right. I mean, okay, first of all, can I ask, does everyone see why that was a good thing to buy it in the 20s or the 30s or whatnot? Do you see how it did a nice clean break to the upside? Consistent, tight. That's like the gold standard for a winning trade for a breakout, is something that goes up consistently. The charts that you guys have been giving me are a role model for how to lose money in the stock market. So let's kind of flip it around. Let's, you know, it's like they say, the definition of insanity is doing the same thing over and over again and expecting different results. What I want you guys to do is make money. And to make money, you have to buy stuff that's consistently going up without choppy ranges. Now, one of the patterns I like to look for, like I said, is small followed by larger whole real body green candle. And hopefully I can get an example. Any questions or another ticker I can look at? Jeff, are you there? Any other tickers?
Yes. Once in a while, I'm mute button challenged. XOM from Penny.
Sure. Okay. I'm trying to help you guys. Tough love. Okay. It's like scare trade. What's the ticker on that? It's XLM. It's an L, a PK, a BE, a BN, a D, a DE, an F, an MU, an SO.
X-ray, O, Oscar, M, Mary. XOM.
XOM?
Mhm.
Okay, I'm sorry. I thought you said XLM. Okay.
No
Okay, there we go. Cool. We are good to go. Now let's see. Let me start finding some redeeming features and be a gentle, well-spoken person here. This was wonderful here. So if you caught that leg up, that's great. We had a small followed by a large overbody body green candle. We got a bullish cup breakout. Another bullish cup. It started to stall. Started to paint red. We had a shooting star here that told you to sell, right? Now, I don't know if you caught that, but if you're trading on the way up and you see a shooting star, that's a shooting star. A box with a stick on top. It's like if you were to map out the data points, it'd make a bearish cup or letter A. So if you're trading this on the way up, that's great. Now, is it worth trading in the first place? The range isn't good enough for me. Something that's 85 to 120, that's only 40 points of range for a $100 instrument. That's not good enough. For a $100 instrument, I'd want likely double the range. So the breakout was good though. The initial breakout was good. Here is terrible, and one shouldn't have traded it since November. So it's a terrible chart lately. But if you did catch the first leg of the breakout, good for you. That was a good play. But I would have sold there on the shooting star. And even if you don't get the exact shooting star because you weren't day trading, but you caught it down there, here would have been a good place to sell. So bullish cup breakout in. So even if you bought the 95, sold the 104, it's still 20 points. So yeah, that's an okay chart on that leg. Here, this would be a terrible chart to trade from here on. So I would not trade it with the 10-foot pole. Exxon is sideways, and chop is a lot of the energy and nat gas and energy sector is probably not good right now. Anyway, okay, next ticker or question.
Let's see. Jerome wants to know if you scan specific candle patterns or another approach.
I look for range expansion and gaps. So the number one thing I look for is number one way to trade the stock market is to buy small gaps up. Small meaning less than 10% of the price or so, usually under $1. So or so. A small gap up above the previous day's high that keeps going up, that's the best entry pattern. Okay, now for swing trades, we like to look for a sequence where you have a small followed by a large whole body green candle like this, usually leads to an uptick. Or here you can see even the doji followed by a large green candle led to an uptick. So increase, or right here, it's another one, smaller followed by large. Increasing ranges in an uptrend is a really good ladder or kind of a ladder rung to hang on to start climbing up. So if you see small followed by large whole body candle, a breakout above that's usually good, especially if it's on higher volume. So there's a lot of mini patterns. The other quick tip is don't trade anything that's inside the previous day's range. Just like when you trade the stock market, focus on out days, which means days above the previous day's S&P high, right? When you trade stock and ETF charts, mainly focus on things that are above the prior day's high. So for day trading, I use 2-day chart where I look at the previous day's range, open range breakout, length of the run, the total range, and then I look for plays above that in our current day. And that makes sense. That's a really good way to trade. So yeah, smart question. Thanks. Next question.
Leo wants you to take a look at C, Charlie, G Golf, B Bravo, D Delta.
Sure. Charlie Golf, Bravo, Delta. Yeah, that's right. That's our phonetic alphabet.
Yeah.
Alpha, Bravo, Charlie. Alpha, Bravo, Charlie, Delta, Echo, Fox, Golf, Hotel, India, Juliet, Kilo, Lima, November, Oscar, Papa, Quebec, Romeo, Sierra, Tango, Uniform, Victor, Whiskey, X-ray, Yankee, Zulu, Sir. Boom. That was an RO. So that's your phonetic. Or drop it.
Where did you learn it, Ken? Just curious.
ROTC. ROTC. I was captain of the rifle team. Bam.
Yeah, I learned it. Army Reserves.
Baby. Oh, good call, man. Yeah, I'm an Army qualified sharpshooter too. I got my sharpshooter medal and all kind of stuff. But now this is a wonderful chart. Yeah. This is a great chart. Yay! We finally got a good chart. Johnny told them what they won. That's a wonderful chart. I like that chart. So thanks. We're learning is occurring. I'm starting to see some smart charts. That one's actually worth trading. I'd hit that. I'd trade that over the 1570 or so, or 16. So that's good. It's got enough range, 11 to 15, barely, but it's good. And it's got the perfect kind of pattern that I like. It's a nice clean uptrend. And by the way, one pattern that I used to teach live at money shows, and I will be speaking at Money Show Las Vegas in April, is a acceleration ramp. And that's simply where you got a nice, beautiful looking chart like that, then hockey sticks up. That's usually a good, you don't want straight up, but a nice 45-degree angle. So it's been going steady like this, then angles up. That's a really good breakout pattern to follow. But yeah, that's a wonderful chart, man. It's a good job, sir. I appreciate it. I applaud you for coming up with the best chart of the day from all the listeners today. So gold star for you. All right, next to the ticker. That's a good one. And it also has my favorite long candle pattern, which is small candle, large candle. All right. You guys are going to have me play the blues, and I am going to play something here in a second because I play horn is what I do. But
Franklin wants to know, how do you know if it's going to trend?
You never know for sure if it's going to trend. That's what stops are for. But if it's in a consistent, the longer it's been in a trend, the more likely it is to continue to trend. The more brief it's been in a trend, the less likely it is. This has been a very long trend since October. So I love this chart. It's a consistent uptrending chart with a tight channel, and it looks beautiful. That's a good chart. So the longer it's been in a trend, the more likely it is to trend. All right.
A Oslander wants you to look at ALG.
All right. Alpha
Lima Golf.
All right. Let's look at that one. See, if you don't trade right, you get the blues. That's good too. That's actually not a bad chart. That one doesn't suck. It's the range is good. It's the first thing I look at. First, train yourself, guys. You have my word. This is very important. This is one trader to hundreds of others, or one trader to another. The bigger the range, the better the chart. The tighter the channel, the better the chart. The longer it's been in an uptrend, the better the chart. And hopefully that helps you guys sort through the charts and stay away from the junk charts and get in on the good stuff. So this one, a really good chart. I like the 115 to 160 range. I like the, even though it's been in a trough for the longest time ever, it hammered out a base there. It held the hammer low, which is good. It took out, popped its head up here, and then boom, back down. But now it's taking out a successive new higher highs and higher lows. So it's in the definition of an uptrend. Here's another quick tip. Look for the ratio of green to red candles during the last couple of weeks. And you want to focus your energy on charts that have like a 2/3 or something, a majority green candles. So if you look at all these, what's the story of the stock? I was to ask myself, what's the story of the stock market? And what's the story of the stock that I'm trading, or the ETF? This one is mostly buyers. It's a very valuable technique. You guys have my word on that. It actually works. So keep an eye on what's the ratio, meaning the percentage of green versus percentage of red. Don't get anal and write down the numbers. Well, there's 16.4. No, is it mostly green, mostly red, or is it Christmas tree half and half? If that's the case, leave it alone. But you have 2/3 green candles or so, like this one has. That's good. That's a good chart. That'd be another top chart to focus on. So I like Alamo Group. It's good. All right.
John wants to look at Tango Golf, Tango X-Ray.
All right. Let's see. And would that be there's a B in, there's an O, I'm assuming, right?
The O one is one to go with.
Hint, I would simplify that for everybody and put the most frequent one at the top and all the variants. That's a great chart too. I'm proud of you guys. You're actually freaking getting it. So hats off to you guys. You're getting great. That's a beautiful chart. I love that chart. 4 to 20. Wow, I should have traded that one. So thanks. I will trade that one up at the higher, like 20 point. By the way, a quick quiz for the sharp among ye. Which of my rules did I tell you guys about that this one follows exactly right? And by the way, hint, learn from a guy who really trades and make sure that his rules hold up steady across the board for anything that you're trading. And that's the person you want to learn from. Now, I'm available at www.trademastery.com. Bum, 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 bum. Anyway, it's a great chart. Which of my rules? Jeff, is anyone posting a good answer for which of the rules we're following here?
Frank said, good point. But I'm not seeing anybody posting the rules.
Guys, the answer is don't buy nines. Thou shalt sell nines. This holds up perfectly on this chart, right? It stalled at the 9 and dropped. So if maybe these guys, whoever was trading this heard me, right? Or collectively the world heard me. Anyway, it validates my approach. You sell nines. So if you've ever gotten stopped out buying stuff with the 9, that's why you just simply shouldn't buy anything with the 9. You cycle your trades, right? You buy 11, sell 18, 19, then buy over the 20, say at 21 or 20.7. So that's a good chart. All right, let me, because otherwise you get the blues, you know. Anyway, back to our regular scheduled station here. I play horn for fun. It's one of my many hobbies. Anyway, that's all.
You have a website called Trader Sacks, right?
No, that's a tradingjazz.com.
Tradingjazz.com. Okay. Yeah, we should put that up there for you too.
Yeah, sure. If you want to watch me play, I even sing badly moon dance, but I can play halfway. The Pink Panther video is the best one. Got that. I've got more views on my sax playing videos than I do on my trading videos. So whatever that says. Anyway, this is a great chart, and it was good for a good run for the money. I would never buy it here, but if it does break over the 20, say 20.7 or so, have at it. But yeah, it's a good chart. Yeah, thanks. You guys are getting some good charts under your belt. That's good.
Neil wants to know on YouTube if this one has enough volume.
I like at least 1 million shares a day or so, so volume's not great. But for swing trades, price action is the most important thing. But yeah, as a general rule of thumb, I like trading things that have at least 1 million shares a day for volume. And for day trading, I like 15,000 shares, 15000, 15,000 shares per minute or more. And that way you avoid the front running, like those clowns who run chat rooms where they want you to trade low float under $10 stocks that have no volume, and then they buy a bunch and they front run it into their members. The safety net for that is avoid that kind of crap altogether. It's best to day trade stuff, usually between $5 and $30 or $40 a share, with at least 15,000 shares a minute for swing trades. 1 million shares and up per day in volume will do the trick. All right, I guess we got a few more minutes left. Any other tickers or questions for me?
Yeah, actually, Neil wanted to know, I read the question wrong. Neil wanted to know if TGT, Target, had enough volume. And that's Tango Golf Tango is a symbol there.
Yeah, let's take a look. I didn't know you were in the Army Reserves. Thanks for your service, man. That's great. It's good. I have so much respect for people who are military and law enforcement and teachers or whatever. It's this is a horrible chart. No, this hopefully we're not backsliding. The previous charts are good. How about another one? It's up and down. Why would we trade it?
Sure. John says COTY.
Okay, sure.
Charlie Oscar Tango Yankee.
Right, that is it. And we'll do the point K on that, I think, right? The point K.
Yes, dot K.
Okay. I would filter that for users, but okay, just stay. Yeah, that's a wonderful chart. So now we're back to great charts. So I salute you. So I'm glad. And I hope that my work is done here, Grasshoppers. In the short time I've been here, you guys are actually posting rock star charts compared to the ones at the beginning of the presentation, which all sucked. Not that you guys suck, but the charts you picked were suboptimal. Now lately you guys are posting rock star charts, which I salute, and I would actually trade this. So that's good. Yeah, it's got an almost 2-to-1 risk reward ratio. What I don't like is the shooting star 4 days or 7 days back. So we have a shooting star. When you wish upon a star, you're screwed. So don't buy it here. But if it gets over the whole, again, I'm the whole number guy too. So when in doubt, just go in something 20 cents or so above the nearest whole number. So not a trade recommendation, but I would buy COTY at 12.20. How do you forecast an exit target? It's another, I'm glad all of you asked, or no one did, but 50% of the range of what you use to make the decision is, so the range on this guy is 6, let's call it 6 to 12. 6 to 12 is a 6-point delta, so that gives us a target of around 3, like a Darvas box, 3 points on the upside. So if I buy right over 12, my exit target is 15-ish, right? So half the range. That's a very smart technique too. Remember I said that, at least tighten in a trailing stop. Once it's gone 50% of the range of that chart, that's going to be your target. You're not, don't be overly optimistic and amateurish and all that, thinking, oh, I'm going to get the whole 6 points again. No, half of the range. Be happy with half. So if I buy 12, I'm thrilled to sell 15. That's fine. So 12 entry, exit up near, or at least tighten a trailing stop near 15. And we wouldn't buy here because there's a shooting star overhang with the bearish upper shadow, the tail up there near 1180 or so. So go above the whole number over 12. But yeah, that's a wonderful chart. Illustrates exactly what I talked about. So I wanted to thank all of you for listening and learning. I really appreciate those of you who paid attention and are volunteering great charts. Those are the kind of charts that are tradable and make sense. And those are the kind of patterns that you want to look for in your trades. Now, quick tip too. I have Saturday free webinars every Saturday, except tomorrow I've got a big multi-speaker event, Shindig, but I do have the first 3 Saturdays of every month, absolutely free, just to get to know me. I've been doing them for almost 15 years. Over 7,000 people have registered during that time at www.trademastery.com. Or you can type in my name, Ken Calhoun. Well, no, it's trademastery.com. That'll get you my site. And there's a Zoom link at the top, and you can join me every Saturday, except tomorrow we're doing a multi-speaker event. All right. Any other questions or tickers? We got about 5 minutes left, and
let's
thanks.
do IPAR. India Papa Alpha Romeo. I had to think about that one for a second.
IPAR.
Mm-hmm.
It's Indigo Papa Alpha Romeo. Okay, IPAR.O, and we'll pull that up. So this is a great chart, rockstar chart. Salute you for asking about that one. Hey, another great chart. Okay, so now let's this is the right appearance of a chart. Now I don't like trading things this expensive because it eats up a lot of capital. I like to trade wide, not deep. So I like to throw a lot of shots for less expensive charts. So that's the only nit I'd have about it. But overall, it's a great chart. It's a good uptrend. I'd go long over, say, 125.30 or something. Another quick tip. I never enter add whole numbers because market makers know that that's resistance, and they'll shake you out at a whole number. One tip that I found really helps avoid false breakouts is to wait until at least, say, 30 cents or so above the obvious resistance before entering. And that's very valuable. I've written dozens of articles on the topic, but how to say, never buy at the high. Never buy at the high, because market makers are going to shake you out. They're gunning for stops there. I know that because they used to send, some of Wall Street's top firms used to send me market makers to train back when I was doing live seminars in Vegas and New York and Dallas and California. And I talked with these guys, after hours and in the hallway and breaks, and they shared a lot of their secrets with me, so to speak. And one of them is you never buy at the high. So that's dumb money. That's what they say. It's not what I say. The Wall Street guys say that, well, your dumb money is going to hit the high. You want to wait till at least say 3.3 or a little bit like that, 0.3 above the previous high before you enter to avoid the false breakout, which always occurs at the high. So that's a very valuable rider downer, as my colleague Dan Kennedy would say. But yeah, great chart, and thanks. Yeah, you guys are coming up with some really good charts, winning charts. So that's good. I'm proud of you. It's good. All right. Any other questions? My time is about done. So if you guys have questions, let me know. Yeah.
I had a question. I like how you said you like to trade wide, not deep. I kind of share the same philosophy. Is there an upper limit to kind of like the pricing that you're looking for?
I specialize in stuff under 40. I like 30-ish a share. I like between like $7, $8, $10. My specialty though is like $15 to $30 a share. I like charts in there, frequently less. So 5 to 10, up to 20 or 30. I don't want to spend all the money for $100 a share stuff because I could trade 5 stocks that are $20 a share for the same capital outlay as something at 110 a share. So even though it's a great chart, it's going to soak up a lot of my money that I could sprinkle into break it into cheaper, similar charts, or identical or even better charts at lower price. So the flip side of that is you have, and this is something nobody tells traders, the cheaper the chart, the less consistent it is, because professional traders, the hedge fund managers that feed the big charts don't touch that. They can't. They're not allowed to trade stuff under $5 a share anyway. So charts under $5 are for morons. Nobody should ever trade charts under $5. That is for fools and morons. Professionals, we always trade at least 5, and that's like the tail end of the distribution. A minority of what I trade is 5 to 10. A lot of what I trade is like maybe 12, 15, 18, 22, 27. That's kind of my playground. That's what I like. I play the stuff usually between 7 or 8 and up to about 25. That's a really good price range because you find a lot of charts with good consistency and good leverage. The really cheap charts, the the guys who say to play penny stocks, well, you get more leverage. Yeah. How many of you have had pop and drop charts or gap and crap charts? Or it went up pre-market and in market it just crashed all day. So avoid the junk charts. Professionals will tell you that. Amateurs won't. So charts under $5 are not things that professional big money traders trade. So you will not see this nice, beautiful, consistent pattern. That's extremely valuable intel. You guys need to know that. That's really the truth. And think about it. The haphazard random cheap charts are gamblers charts and they're stupid. Don't do that. It's like a stupid tax is trading charts under $5. You want to trade things that are consistent, and those are usually charts that are 8, 10, 12, 15, 20 and up per share. So good. Okay, any other questions?
Yeah, we have somebody looking for redemption in the YouTube channel. Neil wants to know if Papa Charlie Golf will redeem him.
Papa Charlie Golf. Not one I'm familiar with, so probably not, but we'll take a look. PCG, PG&E, probably too expensive, I think, right? Oh, no, okay, PG&E. No, that's a perfectly terrible chart. Why would you ever trade someone that only has a 3 point? Oh, calm down, Ken. This thing does not have enough range, and it's a sucky chart anyway. So it fails the range test. It only goes 12 to 16. At 12, I'd want it to go to 20 or 12 to 18. So range fails. Is there a trend? No, that sucks. That fails. Is there any observable pattern that's consistent? No, it fails. So epic fail.
Let's see. Franklin asked, do you have any insight on stock index, commodity, or currency trends? Is there anything that you're kind of looking for to happen?
No.
Okay.
Next question.
PANW, Papa Alpha November Whiskey. This is coming back. I'm remembering all these.
Yeah. You know what I like best about the military is the SOPs are so well written, right? The SOP manuals it's like unambiguous. It's very extremely well written. In fact, I met a woman who used to write, the technical writer for the Army, who used to do the field manuals and SOPs and their FMs, right? They're really well written.
Yeah, I actually still have mine. So
you did what? Did you keep yours?
I still have some of those from way back when. So
yeah, they're like a light yellow kind of tan with black. Yeah, they're great. Their best technical writing in the world is Army field manuals, surprisingly. This one, what about the chart? Palo Alto Networks. The range is not good enough. It's okay. It's a good uptrend. I like the fact that it's trending up, so that's good. The redeeming feature is it's in a nice tight channel going up. The not so redeeming feature is it's $1,400 freaking dollars a share. Are you nuts? All right, next question. Calm down, Ken. I mean, I don't know about you, but I would never pay $1,400 per share when I can buy things that have better chart patterns for $15 a share or $20 a share. So, but I like the fact that the silver lining is it's a nice tight channel up. I would buy not a trade recommendation. I'd buy 1454 hard stop at 14. Or I should say 1454 hard stop at 1400. So it is a good tight channel on the last leg here, but it's too expensive. The leverage isn't good enough. All right, any other questions? I know.
Yeah, Franklin says, so you want a range of at least 8 and the price above 5? Question.
No. It's all dependent on the individual instrument. I like a range of at least 30%. How to say something has like a range of like 10 to 20 on the right side is good. A 2 to 1. The best, how to say, the gold standard. The best ones to look at are a 2 to 1 ratio. So if the bottom number is 10, the top number better be 20. Here it almost meets that. 850 would be 1700 on the, but it's not quite there. If you look at the cold example, that I bought 21, sold 63. Look at the right side of the chart, 10 to 80. I made a lot of money. I tripled my money in the trade, buying 21, selling 63. I didn't get the exact top or the exact bottom. I got most of the middle though. So range is everything with the tight channel to play. All right, I think our time's up. So I wanted to thank Jeff and Kelly and the folks at MetaStock. Great charts, as always. They're clear, they're easy to read, and they've got so many different studies you can do. You can, study the charts to your heart's content. The main thing is learn how to trade with trade management, the proper entry and exit parameters. And, and again, you don't have to do any. You don't have to trade 124 million a year like I do, but do trade correctly, and the MetaStock charts can really help with that. So hopefully you'll be seeing a breakout scanner from me and some partner from MetaStock at some time toward the end of the year, maybe. We'll see, but I'd certainly like to get that in the books. Join me every Saturday for free webinars on Zoom at noon Eastern. They're 30 minutes, they're quick, and we go through charts of people's choice at trademastery.com. So thanks, Jeff Gibby, one of the hardest working men in the business, and Kelly and the team at MetaStock. And it's been real. Thanks for being here, and you guys have a great weekend. Relax and take it easy.
Thanks. Appreciate that, Ken. Good to see you. Thanks for coming in.
Sure thing, man.
And we'll see you again soon.
Yeah, see you next time. Have a good one. Thanks.
All right. Yeah, you bet. All right. Go ahead and do this. Show my screen. We'll just wrap up. All right, cool.
All right.
And as we go on, I want to say thank you to all of our great speakers. Ken, that was really, really good. We appreciate that. Everybody, all of our speakers this week, all 40 of them have been just top notch. Really appreciate everybody for spending. A last thank you to Stocks and Commodities for being awesome sponsors of the event. If you do any of the offers, you're going to get free magazine sent to you. We really appreciate that partnership and their sponsorship. Same with CMT Association. You can find out about CMT Association at cmtassociation.org. The last offer I wanted to highlight before we kind of end up today is one of our most popular add-ons, the Vince Vora's Victory Method. It's $1997 normally. If you get it at the conference today, you can get $9.95. As with all of the add-ons that we do, we're going to do a 30-day money-back guarantee. They threw in a year of membership of their video alert service from Vince Vora. It was amazing. We give you a 30-day money-back guarantee on it. We'll give you a trial of MetaStock if you need it. You can do that and all of our great offers if you go to metastock.com/conf-promo, metastock.com/saleschat, or if you give us a call at 800-882-3040. Thank you, Franklin. I appreciate that. For everybody that, again, thank you. A big thank you to our sponsors, our presenters, Kelly, for being stuck in the little room all week. Great. Pierre says, thank you all. Appreciate your hard effort. See you back in Montreal. Pierre, we'll see you in Montreal. Neil says, after hearing all these presentations, I want to know what is your go-to? I showed, if you like breakouts, actually, there's a scam built into MetaStock you should play with that's called DT support and resistance breakout. It does a really good job of actually identifying breakouts for you. It's kind of said a couple of times in the thing. Jerome says it's been a great week. Many thanks. Thank you everybody for coming. We've set some records this week. We've had some awesome views, some awesome comments, a lot of fun. I hope you enjoyed it. Make sure if you're watching this in the future on YouTube to like and subscribe. It does help a great deal. If you haven't yet, you should try out MetaStock. 30 years in a row, #1. Metastock.com/conf-promo, metastock.com/saleschat, 800-882-3040. I really appreciate everything. I hope you guys enjoyed the session. Have a good weekend. We'll see you again soon. Stay healthy.
For MetaStock. I hope you enjoyed today's video, and I hope you found it instructive and informative. If you did, what I'd like to invite you to do is go ahead and like and subscribe. Like the video, subscribe to the channel. It helps us a great deal, and it helps us bring you more awesome content like today's video. So go ahead and like and subscribe, and keep on watching.